Welcome to our course in corporate finance and welcome to Module 1. You can see the title, Cash Flows and the Financial Statements. Our course in corporate finance in general is very interested in the future cash flow of a business, of a financial instrument. It's sort of, we value financial assets based on cash flow. And one of the most valuable tools we have in finance is financial statements produced by accountants. Now, accountants are not as obsessed with cash flow as we are here in finance. And so as a consequence, we have to take accounting information and make sure we understand it well and convert that over to cash flow information. So that's a fundamental concept that we're covering here in Chapter 1. You will hear in your finance course, in this one, in your classroom, if you're taking the course at a university or college, you'll hear this phrase all through finance course. The phrase is present value of future cash flows. That's the value of any financial asset, the value of anything really, the present value of the future cash flows. And I just thought I'd pose a pretty straightforward dilemma. And this is a question that finance seeks to answer. So if we have a friend, let's just say we have a good friend and they say, I promise to pay you $1,000 in 365 days. 1 year from now, I'm going to give you $1,000. And it's a friend we love. It's a friend that we trust. And we believe them when they say that. And they say, how much money would you give me today in order for me to fulfill that promise? So in other words, what is this $1,000 promise? By the way, I know what you're thinking. We're living in an age of AI. You're probably thinking, oh, this guy, he had AI draw a portrait of Grover Cleveland here, the person on the $1,000 bill. No. I know it's what it looks like, but I did that all by hand. But you might not believe me, but I'm telling you the truth. So in any event, our friend promises to pay us $1,000 in 365 days. What's that worth to us today? Well, that's a question finance seeks to answer. But I hope you're saying, well, it's got to be less than 1,000, right? Like put a number on it. Imagine your best friend says, I'll give you $1,000 a year from now. How much would you give that person today in order to cash in on that promise? Would it be $950? Would it be $900, $800? How much would you discount that? How much of a discount would you need in order to say, okay, I'll take the deal? That's the question fundamentally finance is obsessed with. And if you say, well, I'd only do it for $600, right? I don't really trust my friend. Well, imagine there's a market full of people and your friend's putting it out to lots of offers. Maybe somebody else will do it for $7. Maybe somebody else will do it for $8. What's the right price, right? What's the right price on this promise? That is the fundamental question of finance. Now, this is a pretty simple thing to value, but you can imagine it gets much more complex. And in fact, it gets much mathier. When I was a kid, I always wanted to get into something that involved math and money. I chose accounting. I should have chose finance. Finance involves a lot of math. And I would suggest to you, your professor, if they allow it, you're going to want to learn how to use a financial calculator. It'll be very useful for your test. Now, I'll show you how to do all the exercises we do by hand, but you'll see how much quicker it is. So we'll do it by hand. We'll also do exercises in our financial calculator. So when you want to learn finance, my suggestion is get very good with a financial calculator. I'll use the BA2 Plus and I'll show you how to use that through our videos. But, if you have a Casio or some other brand, they're all very similar. They certainly all produce the same results. So find out what your professor will allow or not. And if they allow you to use a financial calculator, for goodness sakes, it's a great tool that you ought to use. I'll show you how to do everything by hand, but a financial calculator will help. So with all that having been said, I'm so excited that you're with me. Module 1, we're going to learn how to convert financial statement information and to understand financial statement information and how to convert it into something more useful for finance, which is cash flow information. Let's get started. I can't wait to get going. See you in the next video. Welcome to Module 1 of our class in corporate finance. And this is the very first problem, Problem 11A. You can click the link in the description to download a copy of this workbook for yourself. This problem has us looking at operating cash flows. Now, I want to explain why we're going to look at operating cash flows. If you just want to solve the problem, probably skip ahead 4 or 5 minutes. We'll work through the problem. It's a very quick problem, but I feel like at the very start of the class, we should explain like why are we doing this? So I want to discuss just the concept of cash flow and why it's so important in finance, and that'll sort of set the table for the rest of this chapter. So if you take a finance course, you're going to find your instructor very obsessed with cash flows. Just about every problem we look at in a finance course in some form or another is going to discuss the cash flows of an investment or of a company or something like this. And it's a really important concept in finance. And the idea is to value a company, to value an asset, to value an investment, value its cash flows. Now, I come at this from the perspective of an accountant. I'm an accountant. I'm a CPA. I'm not a CFA, so I do want to let you know that I am not a finance professional. I'm an accounting professional, an accounting educator. I'm making these videos because students have requested that I make them, and so I've had to work closely with a friend and colleague who helped me develop the material, but he's the expert, not me, in any event. In finance, cash flow is a crucial concept because it's very real. In accounting, a lot of things are based on estimates and projections. Oh, how many debts do I think are going to go bad next year? Or how many years do I think I'm going to use this building? They're all guesses. And finance folks say, well, the realest thing you can have is money, right? The company generates money. They pay it to you, the shareholder, as a dividend. That's real, and that's something of value. That's what we want to base all of our work around, is the cash flow that the company is generating, not some accountant's estimates that are ingrained in the profits. So what our first chapter has us doing in this course is just going from those accounting numbers, which are definitely useful in accounting, to cash flow numbers, which are much more useful in finance. So you'll find in most finance classes, you'll be doing calculations like this early on, taking accounting income statements and balance sheets and moving them over into cash flow information, not cash flow statements. That's another accounting financial statement, but cash flow information, converting accounting information into finance information. So a few more concepts, and then we'll jump into the problem. The first thing is just this concept of, okay, a company uses its assets to generate money, right? It uses its assets to generate money. And what can it do with the excess money it generates? Well, it can use it to buy more assets and to sort of satisfy its own assets. So it can use it all on the left side of the equation. But if it has extra money, it will often pay money out to creditors or pay money out to shareholders, or likely both. Well, from finance perspective, we're often playing the role of creditor or stockholder, right? We buy bonds in a company, that's we're creditors, or we can buy stocks in a company, then we're investors. So we're very interested in how good the company is at using its assets to generate cash flow, because that's money that's going to come to us potentially. So we're very interested in the cash flow of the company because, you know, it's important to us as investors or potential investors or lenders or potential lenders. So how do I figure out the cash flow from assets? Well, this can get further broken down. And this is question 1 of our class, has us looking at operating cash flow. We'll get to that in just a minute. Question 2, we'll look at capital spending. 3, change in net working capital. And these are 1-1, 1-2, 1-3. Question 1-4 has us looking at all 3 of them. So let's focus in on operating cash flow. This is the cash flow the company generates from its day-to-day business. So Walmart sells stuff to us. That's their cash flow, from their day-to-day business. They pay their employees money. Maybe they buy goods from their suppliers and they sell stuff to us, right? Those are the operating cash flows, the main operating cash flows of a big retailer like Walmart or Home Depot. So operating cash flow is just the company basically doing what it does to make money. Capital spending is them buying capital assets, like buying a new store or buying a new equipment to go in the store. And obviously that's one way they could use their cash flows. And lastly, change in net working capital is a little more technical, but it's basically the short-term assets and short-term liabilities, current assets and current liabilities, how much money they have flowing in and out of those accounts. But this video is focused on, or this problem 1.1 is focused on operating cash flow. So with the preamble out of the way, let's get down to business. So we're figuring out how much money the company's day-to-day business is generating, and the starting point here is an accounting income statement. So let's read the question and see how we do. Stranger Company has sales revenues of $30,000. The operating expenses are $21,000, including depreciation of $3,000. Company has interest of $1,000, and the tax rate is 25%. What's the operating cash flow? Okay, to figure this out, basically they've given us an accounting income statement. Let's prepare that income statement. So we have sales of $30,000. And the income statement is the summary of revenues and expenses, and take your revenues, your amount your company earned minus your expenses, your costs, and that tells you how profitable the company was. So let's figure out the accounting profits of this company. Sales are $30K. Operating expense, what does it say? $21,000, but it says including depreciation of $3,000. I want to split out the depreciation. It's going to become relevant later. So our operating expenses excluding depreciation, 21 minus 3, are $18,000. Our depreciation expense, I'm being very short-handed here because we're just asked to calculate something, calculate operating cash flow. We're not asked to prepare in good form an income statement or something like that. If they'd asked me for good format, I would, spend more time on dollar signs and underlines and things like this. But in any event, sales minus operating expenses minus depreciation is 30 minus 18 minus 3, 30 minus 21. That's $9,000. And that is our EBIT. Now, EBIT stands for earnings before interest and tax. In accounting class, I would call this operating income. But in a finance class, we're going to call it EBIT. But we're essentially referring to the same thing. There's maybe some small differences here or there, but for all intents and purposes, we're talking about the same thing. So earnings before interest and tax, well, then let's take away interest, which was 1,000, to get us down to 8, which is our earnings before tax. Take away the I, because we did take away the interest. And that brings us down to our taxes. Our taxes were 25%. 25% of 8,000 I can do in my head. It's 2,000. A quarter of 8 is 2. And that brings us to our bottom line, our net income, our earnings, our profits. This company made $6,000. Okay, so there we have a beautiful sort of income statement. But we haven't answered the question, what are the operating cash flows? There are so many ways a person could calculate this. I'm going to show you the one that I've seen most commonly in finance textbooks. And it says, start with EBIT and work from there. So that's what we'll do. We'll start from EBIT and we'll work from there. So if I have my EBIT, which was $9,000, now I need to look above EBIT and below EBIT. I'm going to look above EBIT and I'm going to say, is there anything up there that should have been excluded? Well, sales, typically that involves cash flow. Most of my operating expenses involve cash flow because, so again, think of Walmart. They sell stuff to you. Well, they get money from you when you buy a bag full of their stuff. Operating expenses, they pay their employees, they pay them with money, so that involves cash flow. The one that sticks out, though, is depreciation. There's no cash flow with depreciation. Depreciation is called a non-cash expense. So it's a special expense, and we're going to deal with depreciation throughout the course, so it's just worth knowing, okay, depreciation never involves cash. So EBIT isn't cash flow because it includes depreciation. So we want to know cash, right? So let's take that depreciation out of our EBIT. Now, how do I take it out? Well, I went 30 minus 18 minus 3 is 9. Well, let's pretend I didn't have that. It would be 30 minus 18. It should be 12. So this should be 12. So I'm going to actually have to add back depreciation. So I add depreciation of 3,000. So now my subtotal is 12, right? So it's, again, there's many different ways we could calculate this. This is one of them. Okay, let's look below the line. We got two more expenses. We got interest, because it's earning before interest and tax. We got interest and tax. Interest can involve cash, but it's not considered an operating cash flow. It's not considered part of the day-to-day business of the company, and it's a payment out to creditors, right? So it's something different. It's a different kind of cash flow. Taxes, though, are operating cash flows. This $2,000 in taxes is a $2,000 deduction from our cash. So minus 2,000 equals 9 plus 3 is 12 minus 2 is 10. That is my operating cash flow, which we will abbreviate in this course as OCF. So the formula is EBIT plus depreciation minus taxes. Now, later in the course, we will go through so many different ways to calculate this. You can really calculate OCF in myriad different ways, but it becomes a really useful and powerful number. Right now, okay, we're just we're calculating it, going through like an intellectual exercise. Later in the class, we will use this number to do powerful things. So I hope you'll stick with me because I want to do powerful things together. And just, if you're planning to stick with me, I hope you'll hit one of those buttons. Thanks for watching. Have a great day. See you in the next video. Bye-bye. Let's examine problem 128, net capital spending. Let's actually take a look at the lay of the land. At the start of the chapter, I had said, well, we're very interested in a company's cash flow, particularly their cash flow from assets, which is composed of operating cash flow, which we tackled in problem 1, capital spending or net capital spending, which we're tackling now, and in problem 3, we'll look at change in working capital. So we are here. This is what we're working on. And so it's just a type of cash flow a company may have. They have to buy assets. So let's contemplate what that looks like in terms of the math. When I'm solving these, I like to tell a story. I'll do it the slow way, which is the storytelling way, and then I'll do it the fast way, which is there's a quick, easy formula. But I actually wouldn't memorize the formula. I would just know the story. So we're interested in this account on the balance sheet. Let me read the question. It says a comparative balance sheet for Sleepy Company is shown below. Here we have our balance sheet, which summarizes the assets. That's the stuff of value that the company owns. Liabilities, that's what they owe. And the equity is what's left over. That's the shareholders' piece of the pie. We're interested, though, just in this line in this question. A review of the company's income statement showed depreciation of $30,000, and it says, what is the net capital spending? Okay, so I like to tell the story of this line item. Here's the story. I had $180,000 in assets last year. This year I had depreciation of 30. So I would think, barring any capital spending, right? If I didn't spend any money, I would have $150,000 in assets. But I don't have $150,000 in assets. I actually have $200,000 in assets at the end of this year. So again, last year, started at 180. I depreciated them by 30. I would expect to end up at 150, but I didn't end up at 150. I ended up in 200. Well, what happened? I must have bought $50,000 in assets. So my net capital spending, I'm answering the question now, is 50. Done. That's the answer. Okay, so that was solving it. I don't even think it's that slow, but that's the way I think of it. When I read textbooks, they often will give a formula here. I don't think the formula is as useful, but maybe it'll be useful for you. So here we go. Here's how you solve it by formula. You say change in fixed assets or net fixed assets. So the change in net fixed assets was plus $20,000, right? It went from 180 to 200. That's plus 20. Plus depreciation. That's the formula. So 20 plus 30 is 50. Okay, so we got it both ways. I think this way makes sense, though. When I think about it, I don't think of the formula. I think about what really happened. And what I would love to really happen, what a segue, is if you like this, hit one of those buttons. All right, thanks for watching. Bye-bye. Let's take a look at problem 1.3a. We're computing the change in net working capital. And I just want to give you the lay of the land. Remember where we are and where we're going. In problem 1.1, we learned how to calculate operating cash flow. In problem 1.2, we learned how to calculate capital spending. Problem 1.3, we're looking at cash flows related to changes in net working capital. And when we get to it, problem 1.4 is going to combine them all. And when we combine them all, we get cash flow from assets. But this problem is all about change in net working capital, and it's probably the easiest of the three components of cash flow from assets. Let's get down to business. A comparative balance sheet for Ignite Company is shown below, and there's a balance sheet that says, what's the change in net working capital? Well, what's the net working capital? And net working capital is current assets minus current liabilities. That equals our net working capital. So this company's current assets for, let's do 2029 and 2028. Let's do 2028. Current assets are 20,000. Current liabilities, so there's the current assets, there's the current liabilities. Current liabilities are 12. So the net working capital is 8. And it's just sort of a number that's used to like, how much money do I have to work with, right? If I took all my assets, sold them off, paid off all my current debts, how much money would I have to play with? And it's a useful number to know. So the net working capital of this company is $8,000. And in 2029, it's going to be 15 minus 10. 15,000 minus 10,000. Is $5,000 in net working capital. Okay, what was the change in the net working capital? Well, it went from 8 down to 5. The change was it decreased by $3,000. The change in net working capital is it decreased, not by 30,000, but by $3,000 decrease. Okay. We've solved 1.3a. What was the change in net working capital? It went down by $3,000. An easy or easier problem than most. And what else is easier than most? Hitting one of those buttons for me. Thanks so much for watching. Have a great day. Goodbye. In this video, we're going to work on a problem you can download from tonybell.com. Go to the website, click the PDF link, and you'll notice there's no sign in, no sign up. The PDF just pops right up. You'll scroll down and find whatever problem it is that we're working on. As you scroll through the problems, you'll notice many are free and open, like the one you're watching now, but some are members only. I think the free and open ones are enough for most people, but if you can't get enough of me and you'd like to join and get access to those members only videos, click the join button underneath the YouTube play box. All right, thanks so much for watching. Let's get started. Let's have a look at problem 1.4a. We're calculating all kinds of cash flow. The first three parts are just review of what we've already learned in previous problems, so I'm going to jump right into them. So the question gives us financial statements, an income statement, and a comparative balance sheet, and it says compute OCF, operating cash flow. Okay, we're going to learn so many different ways to calculate this during the course, but the way we introduce in chapter 1 is one of the more simple and straightforward. It says we start with EBIT, and this is going back to problem 1.1, so you can flip back to that if you want a more detailed explanation here, but we start with EBIT, which is $350. We add back the depreciation because, of course, depreciation is included in EBIT, but it doesn't involve cash. So we're going to add back $100,000. And then we deduct interest. Or not interest, pardon me. We deduct taxes. What was I thinking? Deduct income taxes. So I'm going to minus $85,000. And remember what we're calculating. Operating cash flow is the cash flow generated by the day-to-day business of the company. I got a cough. I'm going to mute my mic for half a sec. That's better. Okay, so let's sum these up. 350 plus 100, that's 450 minus 85. Oh dear. I'm going to have to use my calculator. 350 plus 100 minus 85. 365. That's our operating cash flow. The day-to-day business of our company has generated $365,000 in positive cash flow. It's possible this could be negative, like We could have negative EBIT. That's very possible, but in this case, it was positive, and that's what you're hoping for if you're certainly running your own business, unless you're some sort of weird tech startup that's burning money initially. You want generally to see positive operating cash flows out of a business. Okay, so there we are. We've generated $365,000 in operating cash flow. What about capital spending? How have we used that money? Well, one way we might use our money is to buy assets, right? And so this has us analyzing the change in net fixed assets. I always tell myself the story of net fixed assets. You can see it started at 550, ended at 600. Well, it started at 550, but it would have gone down by the amount of the depreciation. So if I had 550 and I depreciated them for $100,000, I should be sitting at 450 to end the year, right? Just math of it says I'd be at 450 if I didn't buy anything new. But I'm at 600. How did I get from 450 to 600? I bought a bunch of new assets. How many new assets did I buy? 150, right? Just the difference there. That is our net capital spending. All right, on to the next. Cash flows from the change in working capital. So this is working capital is the difference between current assets and current liabilities. So for 2028, our working capital is 503 minus 235, current assets minus current liabilities. It is 268. For 2029, and this is our working capital, I'm just calculating there, 785 minus 387, just the difference there. 398. So our working capital went from 268 to 398. Our change in working capital was a positive here, 398 minus 268. A positive 130. Our working capital went up by 130K. Okay, so we've solved the first three. Just reminding you what's happening here. Operating cash flows from the day-to-day business. Our day-to-day business generated $365,000 in positive cash flow. Net capital spending is us buying fixed assets. We bought $150,000 in fixed assets. And change in net working capital, probably the trickiest of the three to explain. If your working capital needs go up, it means it's actually negative for your cash flow. Just like capital spending, you're buying fixed assets. Well, that's negative cash flow. Working capital increasing as it did here, also negative cash flow. I'm going to mute my mic for another half second. Okay, let's continue on to cash flow to creditors. So this involves debt, right? It's debt repayments, interest payments. That's really what we're looking at. So debt repayments and interest payments. Let's take a look at what happened here. So I have long-term debt that went from 575 to 610. Oh no, there's not a debt repayment. My debt's going up. Let's take a look at our interest. Our interest is 50. Okay, so we've actually got some work to do. This is more challenging. If debt went down, it's actually really easy to say, oh, well, how much did debt go down? That's a repayment. Well, debt going up is like a negative repayment. It's new borrowing. So I didn't give cash to my creditors. I got cash from my creditors, right? They gave me or loaned me $35,000. But I also had to pay off $50,000 in interest. Now that is being paid back. So $35,000 coming in from my creditors minus $50 going back to my creditors gives me cash flow to creditors of just $15,000. Again, I want to stress this one because it can be a little confusing. My long-term debt went up. If it went down, it means I'm paying it back, right? Your debt goes down because you paid it back. Your debt goes up, you're borrowing money. So this isn't cash flow to creditors, this 35. This is cash flow from creditors. So I have $35K coming in from my creditors. I have $50K to my creditors. So this one is like a plus cash, right? They're giving me 35. The 50 is minus cash. I'm paying them 50. So on net, 15K to creditors. And that's what we were asked to solve for, cash flow to creditors. So that one could be a little confusing, I suspect. Let's do cash flow to stockholders and see what happened here. Our common shares, so shareholders' equity accounts here are the relevant ones. Our common shares, paid in surplus, and dividends. So common shares went up by 10 grand, paid in surplus by 30. That's money coming from my shareholders. So on total, that's 40K from shareholders. 110K goes to the shareholders in the form of a dividend. So on net, 110K in dividends to shareholders. And then there's 40K in investments from shareholders. And the idea there again is common shares goes up and paid in surplus goes up because shareholders are contributing money into the company. So on net, I paid 110 out in the form of dividends, 40K came in from them in the form of investments. On net, 70K went out to shareholders in total. Okay, so our cash flow to stockholders is $70,000. Okay, so the final piece of the pie, maybe I'll take a bit of a step back here. So in calculating cash flow to creditors, it's just about the change in debt and the interest, right? If there's more debt, it means we're taking money from our creditors. If there's less debt, we're paying off our creditors, and then you add interest to that to figure out cash flow to creditors. For stockholders, it's all about common shares, in this case, paid in surplus. The changes there track with investments from our shareholders, and dividends are also the other way you might pay shareholders or stockholders. So there we have it. We've solved E. Let's move on to F. Show how OCF, net capital spending, and change in working capital are related to cash flow to creditors and cash flow from or to stockholders. Okay, so I want to go back to like one of the first slides we showed this chapter, and we sort of said corporate finance is obsessed with cash flow. It is, and we got to manipulate or move cash flow from our accounting financial statements to get figures that are useful in corporate finance. So that's just what we're doing here. Okay, so let's actually use this first sort of set of formulas, and we'll figure out our cash flow from assets. It wasn't asked specifically, but that's sort of what this question is driving to. You wouldn't know that your first time through, though. Our cash flow to creditors, we calculated down here, of 15, and stockholders is 70. So 15K, 70K, and that's just what we calculated. So our cash flow from assets is $85,000. So again, a really important number in finance is just cash flow from assets. It's just a useful number for a lot of our calculations later on in the course. So there we have it. We've figured out our cash flow from assets. Now let's sort of show how that's related to those other three numbers we calculated. So we had operating cash flows of $365. This is positive cash flow for the company. We had capital spending of $150. Well, spending, it's on the name there. That's $150 negative to the company's cash flow. And we had said working capital changing by $130, going up by $130 is also bad for cash flow. It means more money tied up in working capital. This is not good for cash flow. So 365 minus 150 minus 130. And I end up on 85. So I combine all three of those, I get $85,000. And if I scroll back up, you can see I got $85,000 up there, $85,000 down here. These match. That's the idea. And so there are some, I think, tricky corporate finance problems where they'll give you like all but one of these, and you have to be able to say, oh, I know these combine to get cash flow from assets, and then I can solve for the missing variable on one side of the equation or the other. I think that's a little bit tricky, but it certainly is a plausible type of question. I think this way of asking is more reasonable, though. So show how OCF, net capital spending, and change in working capital, the answers from A to C, are related to the answers D to E. The answer is they both combine, A, B, C, D, or A, B, C. You combine those answers, you get cash flow from assets. D and E, you combine, I think I got these back. No, that's right. D and E, you combine the answers to also get cash flow from assets. That's the idea of that final piece. Just wanted to show how they all kind of come together. All right, I hope this video helped. I hope it helped things come together for you a little bit. And if it did, I hope you'll give me a thumbs up. Thanks for watching. See you in the next video. Bye-bye. Let's take a look at problem 15A. You can download this and all of my problems in the workbook. It's just linked below, or go to tonybell.com. You'll find a PDF file, no signups, none of that stuff. Let's jump into the problem. Consider the following personal tax brackets. And there's a bunch of tax brackets. It says, assume a person governed by these tax brackets earns $175,000 this year. How much tax do they owe? Okay, the rookie mistake is you find 175 on the table. You'd say, oh, it's somewhere on this line of the tax bracket. We would earn 175K. Therefore, 175 times 45%. That's how much I owe in taxes. That's not how tax brackets work. For our first $50,000 we earn, we pay 20%. For our next 50, 28%. For our next 50, 37. And so only 25,000 of our 175, the last 25 is taxed at 45%. So it's 50K at 20%. It's 50K at 28%. It's 50K at 37%. And then it's just, to get to 175, it's our last 25K at 45%. So let's do some math. 50 times 20%, that's $10,000. 50 times 28%, $14,000. I did it quick in my head there. I should have trusted myself. 50 times 37%, $18,500. And last but not least, 25,000 times 45% is 11,250. Okay, so then our total tax bill here is going to be 10,000 plus 14,000 plus 18,500 plus 11,250. Our total tax bill is 53,750. But we've answered it. Question 1, how much tax do they owe? 53,750. What's their average tax rate? Well, you take that 53 grand and you divide by how much we earned, 175 grand. So take 53 divided by 175. And on average, it's 30.7%. What is our marginal tax rate? Our marginal tax rate is the tax rate on the next dollar we earn. So if, let's just say we got a consulting contract and we were able to make $10,000 more dollars, right? Some extra contract. So we weren't going to make 175, we're going to make 185. What's the taxes on that new $10,000 we make? The tax rate is 45%. That's sort of where we're sitting on the tax scale. So the marginal tax rate is any new money that comes in. What's the tax rate going to be on that? 45%. Which rate, the average or the marginal, should we use when doing project analysis in corporate finance? The answer here is marginal. I'll just blurt out the answer. Let me explain why. When we're looking at new projects, we're looking at typically additional projects. So it's like that new consulting gig. If I bring in $10,000 extra dollars, what am I taxed at? The number 30.7% doesn't mean anything to the new project. All new dollars that this company brings in are going to be taxed at 45%. So that's the number you use in project analysis. That's the most appropriate number to use. And there'd be one more thing that's appropriate to use. I hope you use one of those buttons as you click away from this video. All right, thanks for watching. See you in the next video. Bye-bye. Let's take a look at Problem 19A, Computing Common Financial Ratios. This is our first and I think only ratio question of the course. Ratios are very useful in financial analysis, and I just want to caution you, if you're ever doing financial analysis, you never just want to compare one ratio. You want to compute our ratios this year and compare to last year, or, as we're going to do in this video, compare the ratios of one company to the ratios of another. So it's always a comparison point that we're after here to really get information about the company. So here we go. Below is condensed information for the balance sheet and income statement of June Enterprises, and there's our balance sheet and there is our income statement. Some additional information there. It says the CFO has required a list of key ratios from company's big name competitor and would like to know how June Enterprises compares. Compute the ratios below and comment on the liquidity, financial leverage, turnover, profitability, and market value of June Enterprises. Okay, so we've got a big long list of ratios to compute. We've got our competitor numbers here. We're obviously going to be filling in our own numbers in the space provided here. Let's get after it. First, the current ratio. The current ratio measures the short-term debt paying ability. Do I have enough current assets? Those are things of value that are either cash today or going to become cash within the next 12 months. Or do I have enough to pay my current liabilities, my short-term bills? Let's take a look. Our current assets are right here. Our current liabilities right there. Oops, no, that's other. Sorry, our total current liabilities are there. 3,600 divided by 1,500. 2.4. So I have 2.4 times the current assets as I do current liabilities. I am liquid, right? And how do I know? Well, compared to my competitor, I'm more liquid than them. I'm more able to cover my short-term debts. Let's do the quick ratio. The quick ratio is just a tougher version of the current ratio. It's also called sometimes the acid test ratio. It just says, listen, do the current ratio, but take inventory out of your current assets, because if our company's in deep trouble, a lot of times when companies are in distress, they have a hard time selling their inventory. So it doesn't really count as an asset when you are in real distress. So take that out and see how you're doing. And so 3,600 minus 1,200 gives us 2,400 as our numerator, divided by 1,500. So we're at 1.6. Little rule of thumb here is if it's 1 or more, you're doing okay. Even 0.8 or more, you're doing all right. So we are quite liquid as far as this goes. The cash ratio says, do you have enough cash to pay the bills? We're not expecting this to be covering all of our current liabilities. So in our case, I can see that it is. 2,000 divided by 1,500, 1.33. So if worse comes to worse, we don't collect any of our receivables, we don't sell any of our inventories, we still just can pay all our bills for the next year just with cash. Interval measure. This says, are we able to cover our costs? I almost treat this like a burn rate, in a tech company that's burning money. This is a measure of how quickly we're burning money. How quickly are we going to burn through our current assets given our costs? And our operating costs would be, our cost of goods sold is an operating cost, and our operating expenses. I exclude from this interest because it's not operating, and taxes, again, not day-to-day operating costs, and I exclude depreciation, and the reason is this is a cash burn. So depreciation, although it's a cost, it's not one that's going to cause me to be illiquid, right? Liquidity is like cash-like stuff, and depreciation, we're not burning cash here. So it's COGS plus any operating expenses. In this case, our numerator is our numerator is current assets. Let me highlight that. Current assets. There you are. 3,600. Maybe I'll highlight it yellow. And I'm going to divide by those costs that I've highlighted on the other side, which is 3,400. So current assets divided by, I've missed one key step. I was like, I'm going to get a crazy number here. Daily. So this is yearly costs divide by 365 to get daily cost. So 3,400 divided by 365, my daily cost 9.315. And again, this is in millions, so this is a big company, $9 million a day in costs. So 3,600 divided by 9.315 gives us 386.5. 386.5 days. This is, again, it says, well, if I was not making any sales, not bringing in any money, I could pay my costs, I could pay my bills for over a year, 386 days. And again, every ratio so far I've compared favorably to my competitor. I'm doing better than my competitor. Net working capital to total assets ratio. So net working capital is current assets minus current liabilities. So current assets not divided by, but minus. So 3,600 minus 1,500, 2,100, all divided by total assets, which in this case is 7,700. So I'm going to divide by 7,700, and I get 0.27, 0.27, oops, 0.273, I suppose. And this is just a measure of what percentage of our assets is working capital, is short term. So it's a liquidity measure, and we are bigger is more liquid. We're more liquid. So I can just conclude on this. We are significantly in a significantly more liquid and therefore better position than our competitor as far as, again, liquidity goes. Okay, I'm going to slide over, and we're going to do the same thing with leverage ratios. So I just scrolled the leverage ratios up to the top here, and let's get after it. Total liabilities divided by total assets. Total liabilities, where are you? Okay, I got current liabilities. I got long-term debt. There we go. So current plus long-term is total liabilities. And we're going to divide that by total assets. So 1.5 plus 1.8 is 3,300 divided by 7,700. And I get 42.9%. 42.9%. So this is a measure of leverage, how much debt we're using. And I generally think smaller is better here. Certainly smaller is less risky, and we are less leveraged than our competitor. And I view that as a good thing. And that's debatable, but I do view that as a good thing. Okay, next one is total liabilities divided by total asset, not total assets, divided by shareholders' equity. So again, 3.3 million was our total liabilities. Our shareholders' equity, 4.4 million. So it's 0.75. Now you can see the big difference here with our more leveraged competitor, right? We've got more equity than we have debt. They've got way more debt than they have equity. Those two things should go together. We have less leverage. Equity multiplier, another measure of leverage. Total assets divided by equity. So here is our total assets, 7.7 million divided by 4.4 million. And we get 1.75. Now you're going to notice something, and you'll see this if you do the B version of the problem, and you'll see this if you continue on this chapter in future questions. The debt to equity ratio is one less than the equity multiplier. Equity multiplier is one more than debt to equity. I show in a future problem sort of algebraically why this is true, and it is true. I'm not going to show it here, but there's, it's just simple math because assets equals liabilities plus equity. So the way that works together is makes this possible. Okay, long-term debt as a percentage of long-term debt plus equity. So, okay, here we go. Long-term debt divided by long-term debt plus equity. So 1.8 million divided by 1.8 plus 4.4, that's 6.2 million. So 1.8, oops, missed a zero there, 1,800 divided by 6,200, 0.29, 0.29, 29.03%. 29.03%. Next, EBIT divided by interest. There's my EBIT. There's my interest. Well, I can do this math in my head. It's 10. All right, EBIT divided by our interest is 10. This is interest coverage ratio. It's a measure of how able we are to pay our interest. Well, we just with EBIT can cover our interest 10 times over. Now, the next ratio says, well, EBIT includes depreciation. I don't have to worry about depreciation if I'm paying bills because depreciation is a non-cash expense. So let's take that out of the equation, add it back into EBIT. So I end up with 600 as my numerator divided by 50. 600 divided by 50 is 12. So again, 500 plus 100 divided by 50. I get 12 here, 12 times. Now, as far as leverage goes, I am less leveraged than my competitor, right? I have less debt overall. Interestingly, though, they, even though they have way more debt, are able to handle their interest load better than I am. And I think this is a harbinger. I think this is a sign of things to come. I don't know if I pronounce that word right. I don't even know if I use that word right. Harbinger. Harbinger. Harbinger? I don't even know what it means. I'm gonna look it up. Harbinger of things to come. Skip ahead. Let's see. Oops, I don't want you to see my email. Harbinger. There we go. Harbinger, a person or thing that announces the approach of another. A forerunner of something. Yeah, this is a forerunner. This is a harbinger. Did I pronounce it right? Let's see. Yeah, I pretty much hit the nail on the head. Okay, I'm feeling better about things. A harbinger of things to come. And all that means is it's a forebearer of the fact that I think this company is going to be way more profitable than our company because their EBITs have got to be way higher because I would think their interest bill is higher too. They have way more debt. They must be more profitable than us, but let's see how that goes. So as far as debt paying ability goes, I would say we have a nicer looking balance sheet. We have less financial leverage, but they kind of tip your hat to them for interest coverage. But I think we are doing better at the top. So this one may be a minus for us. This one is a plus for us. And I would say overall, as far as leverage goes, we are less leveraged than they are. Okay, turnover ratios. So this is these are all efficiency ratios. How well do we sell through our inventories? How well do we collect our receivables? Any turnover, you're going to want to see bigger. Bigger is better. So let's do the first one, COGS divided by inventory. Again, if you've taken this with me before, if you've done ratios with me before, you'll know I calculate this slightly different in accounting. I follow along with just textbooks in the field, and in accounting, they will say COGS divided by average inventory. You take the average from 2 years, and in my finance textbooks, they just give you 1 year of data, and you just use the 1 year, and so be it. As long as you're being consistent, I don't think it's a huge deal. 2,200 divided by 12. 1,200. 1.83 times. So we're very close to our competitor here. Not a huge difference, but they're doing better than us. They're collecting more regularly than us, and I think that drives home in this next ratio. 365 divided by the inventory turnover. 365 divided by 1.83. 199.5 days. This is saying how long is it taking us to sell our inventory? How long is it sitting on the shelf or in a warehouse somewhere? For us, it's about 200 days. For them, it's 187. They're selling quicker than us. That's better. So we're doing worse. Sales divided by AR for receivables turnover. There's our sales. There's our AR. 4,000 divided by 300. 13.33 times. Bigger is better, and I think, again, this next ratio will drive it home. Divide 365 divided by 13.333. I get 27.38. What does this tell us? It tells us on average when somebody owes us money, it's taking us 27 days to collect the money. Our competitors 45 days. Again, a measure of management efficiency and maybe policies. Sales divided by net working capital. So let's see how we do here. Sales 4,000. Net working capital is again current assets minus current liabilities. So 3,600 minus 1,500 is 2,100 is my denominator. 2,100, my numerator 4,000. 4,000 divided by 2,100. Bigger is going to be better here. 1.9 times for us. 1.905 times, and our competitor 6.67 times. It means how effectively are you using your working capital to generate sales? And they're doing a much better job. As we predicted, their income statement, I predict, is way better than ours. That's just the vibe I'm getting from the ratios we've seen so far. Next, sales divided by fixed assets. How well are we using our fixed assets to generate sales? Sales divided by, where's our fixed assets? There they are. So 4,000 divided by 4,100. 0.975, 976, 0.976 times. So for every dollar I have invested in assets, I generate 97 cents in sales. My competitor generates $1 in sales. So they're doing marginally better than us. This is interesting that it was close. Okay, let's keep going. Sales divided by total assets. Our sales are 4,000. Our total assets 7,700. 4,000 divided by 7,700. 0.519. 0.519. For every dollar I have invested in assets, I generate 50 cents in sales. That's what we're learning here. And again, the competitor is doing better, marginally better. Total assets divided by sales, capital intensity ratio. How many dollars worth of assets does it take to generate a sale? This is just the inverse of the previous one. Sales, or assets rather, 7,700 divided by sales, 4,000, and I get 1.925. So it takes me $1.90 of assets to generate $1 in sales. You would rather this number be lower. So almost across the board, outside of receivables collections, my competitor is doing better here. So relative position, we're doing worse as far as this goes, as far as turnover ratio goes. And this is measures of operational efficiency, right? Are we using our assets efficiently? Are we selling through inventories well? Are we stocking the right amounts of inventory? Are we collecting receivables well? That's what we're measuring here. Okay, one last page of ratios. We got 3 categories though. Let's start with profitability ratios. I predicted we'd do worse. Maybe we aren't going to do worse. Let's see. Net income divided by sales. First one is our profit margin. So for every dollar I sell, how many dollars in profit do I produce? 325 divided by 4,000. Okay, yeah, we are significantly worse than our competitor here. 8.125% versus 17%. They're double, right? Like for every dollar they sell, they make 17 cents. For every dollar we sell, we make 8 cents. This is way worse. Return on assets, net income divided by total assets. So net income divided by total assets, 325 divided by 7,700, 4.22%. Oops, wrong pen. 4.22% versus 11%. We're way less profitable again, right? This is how effectively you're using your assets to generate a profit. You know, how many dollars worth of assets does it take for you to generate $1 in profit? So for every dollar I've invested in assets, I generate 4 cents of profit. Not great compared to my competitor. Net income divided by shareholders' equity, 325 divided by 4,400, 7.4%. We'll call it let's call it 7.39%. and that compares very unfavorably to our competitor at 44%. So you're blowing the doors off us as far as profitability goes. We're not nearly as profitable as our main competitor. Okay, market value. How much does the stock market like us? That's what I consider this first one, and it's market price divided by earnings per share. Our market price is $45. Our earnings per share, now the market price is just right there. Our earnings per share is 2, so 45 divided by 2.17. They're giving us a 20.7 times multiple. So we don't earn very well, but the stock market seems to like us for some reason. This is, I'd buy the competitor stock if I were looking at an investment. They're much more profitable, but there could be some other reason, right? We might be based in a country that's politically more stable, where they're in a less stable country. There might be, regulators taking a good look at their business and maybe threatening lawsuits against them. Who knows, right? There's myriad reasons why one company might have a higher price to earnings ratio than other, but all else equal, you're happier if the stock market values you. It means there's something that investors think you have going for you, and hopefully you do. Okay, the next ratio, market price per share, $45 divided by book value per share. So same $45. Book value per share is our equity divided by the number of shares outstanding, 4400, divided by 150 million shares outstanding, and it's 4400. This is in millions, so that's why we can just do that straight calculation. Our book value per share is $29.33. So 45 divided by 29.33333, 1.53. So ours is a little bit worse here. Our book value is maybe higher than that of our competitor. Last one, and this is just trying to figure out why ROE is so much worse or so different, right? It explains the difference in ROE and does it in an interesting, I think, a very nice way. So we take the pieces of ROE. This is called the DuPont identity. So let's take those pieces for us. Profit margin. So our profit margin is right here. 8.125%. We're going to multiply that by asset turnover. So let me find the asset turnover. Total asset turnover. Here it is, 0.519. And we're going to multiply that by the equity multiplier. And our equity multiplier is right here, 1.75. So there we go. And let's multiply those through. 0.08125 times 0.519 times 1.75. And what we find is we get 7.38%. This is our return on equity, right? It's off by 0.01%. 7.38%, and that's off by, again, 0.01%, even though it should match. It should be ROE. It's just some roundings going on. So let's look at the pieces and see if we can piece together what's happening. Our profit margin, 8%. Competitors' profit margin, 17%. So that's one reason their ROE is higher. Their profit margin's way higher. Asset turnover, 0.5 versus 0.6, not that different. But then equity multiplier, way different. Ours is 1.75, there's 4.03, theirs is double ours. So the two reasons that we're doing worse than our competitor. One, they're just better at generating profit than us, right? They're when they make $1 in sales, they generate a higher profit margin, double ours. And the second is, and this was a choice, they're more highly leveraged than us, right? They have more debt, less equity, and that means they have a higher equity multiplier. So the leverage thing might be a choice, but you can certainly see they're outperforming us financially to result in double the profit margin. Okay, we have done all of the ratios, and for goodness sakes, where are we in the video? 24 minutes. If you've hung in there for 24 minutes, I hope it's been useful to you. And if it's been useful to you, for goodness sakes, if it hasn't been useful to you, please watch some other channel. I'm not trying to waste your time here. But if it has been useful, don't be shy about smashing one of those buttons for me. It's a huge favor to me. All right. Have a great day. Thanks for watching, and I'll see you in the next video. Bye for now. In the first lecture of any corporate finance class, your professor will say something like, the goal of a company is to maximize shareholder value. And in fact, it's not just your professor. If you read the textbook, your textbooks will say things like, and this is pictures I took out of my own textbooks, the primary objective of the corporation, value maximization. Or another textbook, goals of the corporation, shareholders want managers to maximize market value. And it's not just your professors and it's not just your textbooks, it's also our AI chat overlords. I asked one, what's the main goal of corporate finance? It answered, the primary goal of corporate finance is to maximize shareholder value. So you hear this phrase over and over and over again when you're beginning corporate finance. And if you're like me, it kind of rubs you the wrong way. At least it rubs me the wrong way. I think, oh, it's, feels like a evil, greedy person wearing a monocle holding a satchel full of money made up this phrase. And it bugged me. But the more I understand business, the more I understand that this is, I would say, neither good nor bad. It is just a reality of how businesses operate. And it's more to do with the mechanical way a business works. And so in this video, I just hope to explain why it is the way it is. So this will be a video all about the why we always say the goal of a company is to maximize shareholder value. Is it good or bad? I'm not going to make that value judgment here, but it is, and it's important to understand why. And it's not greedy capitalists with monocles underneath it all. It's a logical outcome of how businesses operate. So how do the businesses operate? Well, here you are, a potential shareholder in a business, and you decide, yes, I'd like to buy some shares in that big fancy tech company I've been hearing so much about, Apple or Amazon or Meta or Netflix or something like this, and you decide, yes, I will buy a share in that company. And when you buy the share of the company, there you are in the corner, you of course join a diverse group of shareholders, thousands, tens of thousands, hundreds of thousands of other shareholders are also owners of the company. And what you quickly realize, and if you've ever owned anything where you owned a part of something, so my brother, sister, and I, we all share in a vacation property. We all take turns and take a week or two at the vacation property each summer. Well, what you learn very quickly is, like, our vacation property, there are 3 owners. We disagree on everything. We can't get along. It's very difficult to own something together with other people. And that's with people I love. When I own Apple, I don't love all the other shareholders. I don't even like them. So how are we supposed to work together? And the answer is, well, we don't agree on much of anything. We don't agree how Apple should be run, yet we're the owners of the company. When you're the shareholder, you are the owner of a company. So because this group simply can't be expected to agree on anything, what happens is the group, and we'll go through the mechanics of this in a future chapter, the group has to elect a small group to represent their interests. So what they do is they'll run an election to choose a board of directors. And this board of directors should be experienced in business, similar to the business you're investing in. They should be smart, ethical people that will protect your interests as shareholders. Now, the question the board has to ask is, well, what do our shareholders want, right? Okay, we've been chosen to represent their interests. What do the shareholders want? And the answer could be, you imagine Apple. Oh, should we make bigger iPhones or smaller iPhones? Well, I want smaller iPhones. This is a mini iPhone. They don't even make them anymore. It really chokes me. Maybe more people want larger iPhones. Who knows what people want, right? And this shareholder group's not going to agree, oh, we should make smaller or larger iPhones. In fact, this shareholder group's not going to agree on much of anything. So that leaves the board in a weird spot. They have to represent the interests of a group of people that agrees on nothing, right? They can't get agreement on strategic direction or small details that the company might be interested in. Well, what can this group agree on? So the board would be wise to ask themselves, like, what would this group of shareholders agree on? And there's one thing every single one of these shareholders ought to want, and I would argue does want. 100% of them would like to see the stock price go up. Why do they want to see the stock price go up? Well, they bought stock, right? All you have to do, just do it once in your life. Buy a share of something. Buy a share of Apple or Amazon or Facebook or whatever company you want to buy. Buy one stock and you'll see it in yourself. You'll say, I'd like to see this stock price go up. So every single one of these people, they don't agree on anything. They don't agree, should we make small phones, big phones? They don't agree, should we build a factory here, there, or anywhere? They don't agree on any of that, the design or anything like that. They all agree the stock price should go up. And that's what's at the root of the introductory question. So the shareholders, the group that owns the company, these are, again, you own 51% of the shares. It's your company to run. This group of diverse people with totally different interests are in 100% or close to it, 100% alignment in one thing. They bought the share hoping the price would go up. So they elect the board of directors, and the board of directors goes, well, the shareholder group doesn't agree on anything, but they all agree that the stock price, they'd like to see it go up. The board then, this is the mechanics of how a company works, the board has the power to hire and fire the CEO, the chief executive officer. The CEO's job is to run the company. The CEO hires and fires, the marketing manager and the HR manager and the product designers, all that stuff. The CEO is the top person in the company that's able to do that. But the board can hire and fire the CEO, and the CEO oversees the company. So again, just to sort of reiterate this relationship, hopefully that all fits on a screen and is reasonably visible to you. You, this little guy in the corner, are a shareholder of the company because there's thousands, potentially thousands of shareholders with diverse interests. Even if there's 2 or 3 shareholders, they can't agree on much. The shareholder group will elect a board of directors. The board of directors' role is to advise and help the CEO in representing the shareholders' interests. So the shareholders select the board represents shareholders' interests. How do they do that? They hire a CEO that they think will help shareholders do the one thing they can agree on, which is maximize the value of the shares. Now, at a functional level, though, the board is really important. The board helps the CEO run the company. And I thought I'd show you Apple's current board of directors. So the CEO of the company is Tim Cook. Tim Cook sits on the board of directors, but the name I actually wanted to hone in on is this person on the board of directors, Al Gore. If you don't know who Al Gore is, he was vice president of the United States. He was very nearly president of the United States, missed by maybe hundreds or a few thousand votes in Florida way back when. Anyway, a very politically connected figure. Well, why do you think Al Gore is on the board of directors advising Apple? Because Al Gore surely doesn't know more about chips or phone production than you or I do. But the reason Al Gore is there is because Apple is such a huge and powerful company. They're important to the United States government. So wouldn't it be useful to understand, or to have somebody on your team who understands lawmakers and regulators, how they're going to behave? That's why Al Gore can give advice to Tim Cook, not on what chips to put on the phone, but on how to operate within government, right? How to maneuver the U.S. government. They also have the CEO of Boeing. Well, Boeing, it's one of the few companies that would be similar to Apple in terms of supply chain and ordering parts and needing parts to be very specific specs. So again, that's why a Boeing CEO can give Tim Cook advice. This Susan Wagner of BlackRock. BlackRock's one of the biggest investing companies in the world. So she can advise Tim Cook on what investors are looking for, right? And so all these people can give their expertise and lend their advice to help the company run better. And ultimately, if I can zoom properly, oh, there we are. Sorry, I was having a hard time finding it. Ultimately, the idea is this board represents the shareholder group and advises the CEO as to how the CEO should run their company better. That's it. So at the end of this, I hope you're seeing, and again, I'm not trying to make a judgment call as to whether this is good or bad. It just is. This is the reality of running a company. The shareholders are the owners. They elect a board to represent their interest, and the only thing the shareholders agree on is that they'd like to see the stock price go up. Now, it can be done in any way, right? It doesn't have to be, oh, we need to maximize profits, we need to cut costs, we need to be mean to our employees or something like this. It just means these folks would like to see their stock price go up, and they hire people to represent them. That's why the goal of a company is to maximize shareholder value. Welcome to Module 2 of our Corporate Finance course. As you can see, the title of the module, Projecting Financial Statements. I just want to remind you, and this is a phrase I'll repeat over and over again, and I'm sure your professor will, when we're valuing something, it's the present value of future cash flows to figure out the value of a bond or another financial instrument, or when we're determining the value of a company, if we want to invest in the shares of a company, which finance people are interested in doing, it is all about present value of future cash flows. Well, a question that might occur to you is, well, future cash flows, right? We're trying to figure out the money that's going to come in to a company or as a result of a financial instrument in the future. And so we use accounting information, but accounting information is all based on the past. We get financial statements for last year. We don't get financial statements for next year. And so something we have to do is take those past financial statements and project them forward. That's what Module 2 is all about. And it's not as simple as it might seem. So if I take this balance sheet and I go, okay, let's just say next year everything's going up by 20%, say, right? So last year my assets were 200. Well, if they go up by 20% this year, they're going to be 240, right? Just multiply that by 20%. You get 40 and then add it. Okay, it went up to 240. Liabilities up 20%, so that's 150 plus 30 is 180. And equity up 20%, so that's up by 10, right? 50 times 20% is 10, so that goes up to 60. And sure enough, our balance sheet balance is 240 on the asset side. Assets equals liabilities plus equity, of course. 180 and 60 is 240. Yep, our balance sheet balances. You might think, oh, good job by me, right? My balance sheet balanced. Okay, I'm done the exercise. But what we learn in this chapter is it's actually more complicated than this. If we just do a projection in this way, right, where we just go, oh, plus 20% to everything, all done, the financial statements break down because they depart from reality. So what are ways this financial statement might have departed reality? Well, the first one is the liabilities. What if we can't borrow any more money, right? We're at the top of our borrowing capacity. Well, that's a problem. And when we project forward, we have to say, oh, are we going to need to borrow new money? Can we get new money? And so this represents likely new borrowing, the fact that we go from 150 to 180. The other thing that breaks down is the equity, because of course, equity involves the income statement. It links the income statement and the balance sheet through an account called retained earnings. And if you just project forward 20%, well, it's going to depend on what happened on the income statement and how many dividends we wish to pay. And so it's not so simple as just to go everything plus 20%, everything plus 10%. And so what we'll learn this chapter is those complications, right? We want to figure out the present value of future cash flows. Our accountant friends who prepare financial reports give us past transactions. We've got to project them forward to figure out the present value of future cash flows. That's what Chapter 2 is all about. I'm looking forward to getting into it. Thanks for watching. See you in the next video. In this video, we're going to work on a problem you can download from tonybell.com. Go to the website, click the PDF link, and you'll notice there's no sign in, no sign up. The PDF just pops right up. You'll scroll down and find whatever problem it is that we're working on. As you scroll through the problems, you'll notice many are free and open, like the one you're watching now, but some are members only. I think the free and open ones are enough for most people, but if you can't get enough of me and you'd like to join and get access to those members only videos, click the join button underneath the YouTube play box. All right, thanks so much for watching. Let's get started. Let's take a look at problem 21A. This has us doing pro forma financial statements, just projected financial statements, a really useful skill to have, right? To be able to say, okay, next year, what happens if our sales are up by 10% or 20% or 15% or whatever? What will happen to the rest of our accounts? What will our financial statements look like then? And what are the implications of it? So let's go through for 1A. Liam Company's financial statements are shown below. And there we have an income statement and a balance sheet. And it says, assuming sales are projected to increase by 20% and that all items on the income statement and balance sheet, so all items that we're seeing above, will also increase by 20%. Not the greatest assumption, some things will go up by more or less than sales, but this is a good starting point, right? Just to learn what financial statements look like with this type of change. Okay, so if our sales are going to go up by 20%, how do we make them increase from 5,000 to a, plus 20%? What does that look like? Well, 5,000, you're going to add 20%, so you're going to add 1,000 to that. The way you do that in terms of a calculator is you go 5,000 times 1.2, right? 120% is 1.2. They're going to be $6,000 next year if they increase by 20%. Costs, if they're expected to move with sales, which is a pretty reasonable assumption for most companies, costs go up again by 1.2. They're going to be at $5,400. Sales minus costs and expenses gives us our income before tax. 6,000 minus 5,400 is 600. And you can see this is also a 20% increase from the year before. Taxes are 20% of that. They're going to be 120. And 600 minus 120 is 480. Okay, there we have it. Everything has gone up by 20%. Let's look at our balance sheet now. If everything goes up by 20%. Current assets going up by 20%, what does that look like? Well, they're going to go up to 1,200. That's 20% more than 1,000. The fixed assets are going to go up to 3,600. And again, that's just 20% more, 3,000 times 1.2. So pretty straightforward what we're doing so far. I hope it is anyway. 1,200 plus 3,600 gives us 4,800. There we have it. Our current liabilities going up by 20%, 500 plus 20%, well, that's 600. Our long-term debt, 2,600 going up by 20%, so multiplied by 1.2 is 3,120, and 900 multiplied by 1.2 is 1,080. Adding this up, hopefully the assets equals liabilities plus equity, hopefully our balance sheet balance is 600 plus 3,120 plus 1,080. That gives us 4,800. Yes, indeed. Oh, good feeling. Our balance sheet does balance. Okay, so we've answered the first part. Prepare pro forma statements. We did that. Now, again, how useful is this? How realistic is this? It's a good starting point for us. But in reality, we could be a lot more surgical about this. We could say, our revenues are going to go up 20%, but maybe our costs are only going to go up 15%, right? Because there's a lot of fixed costs or whatever, right? And we could make various estimates, but it's a useful skill to have. So we get to the end and it says, part 2 here, compute the amount of the dividend required to make the balance, to balance the statements if dividends are the plug variable. Okay, this is often confused by students when they're beginning. If I get students to project financial statements, they often will plug their shareholders' equity to make a balance sheet balance. Like they sort of go, okay, I know what assets are and I know how they're going to change. I know how liabilities change, but equity, I'm just going to plug and make it work. And that's essentially what we've done. We've plugged the equity by plugging dividends. So let's think about how equity works. And this is something you need to know. Our beginning equity plus net income, I'm going to say equals just a subtotal minus dividends. Now, I don't need the subtotal. It's just going to help me discuss this. Equals our ending equity. So our beginning equity was $900. We're expecting it to go up to $1,080. So our beginning equity was $900. We add net income. Our net income is $480. So 900 plus 480 gives us $1,380. Now, if we did not pay a dividend, then our ending equity should be $1,380. But our ending equity isn't $1,380, it's $1,080. So we must have paid a dividend because we know our ending equity is $1,080. That's known here. Our dividends are the plug variable. Well, what's the plug that makes this work? We must have paid, under this scenario, a $300 dividend. Okay, so to answer the question, it says compute the amount of the dividend required to balance the statements if dividends are the plug variable. Well, $300, that would be the dividend. Now, let's look at part 3. It says, do the pro forma statements in part 1 make sense if the dividend payout was 30%? So the company, and remains unchanged. So the company always pays a 30% dividend. Does this work? Well, what is a 30% dividend? It's 30% of net income. That's what they're talking about. So 480 times 30%, 480 times 0.3, it's 144 dividend. Does that work? Does that make our statement work? If we plugged in 144 here, would we match? No, we would have higher equity and our balance sheet would no longer balance. So the question is, do they make sense? No, they don't make sense. If the dividend's only $144, then the pro formas no longer work. So that's a problem. Out of curiosity, what is our dividend payout ratio at 300? Well, it's a $300 dividend on $480 in net income. 300 divided by 480. That gives us a payout ratio of 62.5%, way higher, double, more than double the 30% payout ratio. So what does this mean in practical matters? It means probably our financial statements are going to look a little bit different from this because we probably won't pay out a 60% dividend. If we're going to be consistent and pay out a 30% dividend, it means we'll have more cash, more current assets with which to play, right? You can do something, invest in long-term assets, or you can, do something else. But the bottom line is we'd likely have higher than $1,200 in current assets if we paid a smaller than 62% dividend. Okay, that's it for part A, 1, 2, and 3 there. Let's move on to part B. Has us looking at the sort of same set of statements but doing different things here, slightly different things. So it says instead of part A, assume a 20% increase in sales. So actually that was the same. A dividend payout ratio of 40%, so not the 62% or the 30% that we had in the previous version. So just a different scenario here. Costs, expenses, current assets and current liabilities, and net fixed assets will vary directly with sales. Okay, so as we're projecting a 20% increase in sales, all of our costs and expenses, current assets, current liabilities, and fixed assets are going to just go up by 20%. Long-term debt, I can't cross that out. Long-term debt and shareholders' equity don't vary directly with sales. Okay, so it's a different task we've been assigned here. Same task, but they've given us different information, I suppose. Let's see if we can solve it. So we'll start with the income statement, and the income statement is identical because sales, costs, and expenses, that's all that's on an income statement, all go up by 20%, exactly as they did in this previous version. So we're going to prepare the same income statement. So sales up by 20%, so 20% increase here gives us 6,000, 4,500 times 1.2, 5,400. 500 times 1.2 is 600, and the math works going down. 100 times 1.2 is 120, and 480 is our number here, 480. Okay, so we've done the income statement rather quickly. Let's just remember what else goes up. Current assets and current liabilities. Current assets and current liabilities go up by 20%. So current assets goes to 1,200. Current liabilities goes to 600 under this scenario. Net fixed assets also goes up by 20%. So 3,000 goes up to 3,600. Now, this is important. We now know our total assets is 4,800. And something you should be doing immediately if you're pretty confident, and I am pretty confident in that total assets number, write it over here as well, because the balance sheet has to balance. And that's going to become a key to sort of help us solve this problem, right? That's a piece of the puzzle that you might miss, is that if you know your total assets or you know your total liabilities and equity, you know the other, because the balance sheet's got to balance. Okay, so what are we left with? We don't know our debt and we don't know our equity, except we have the tools to figure out the equity, because we know the dividend payout ratio is 40%. So let's figure out our equity. Our equity starts at $900. We're going to use the same formula as above. Let me just remind you of what it is. Beginning equity plus net income, we subtotal minus dividends to get ending equity. So beginning equity was 900 plus net income, add net income, and our net income is 480. 480, we subtotal. And 900 plus 480 is 1380. We deduct dividends. Now we know our dividends. Our dividend payout ratio is 40%, and our projected net income is 480. So 480 times 40% will give us our dividend amount. 480 times 0.4 is 192. That's our dividend. 192. So our ending equity is 1380 minus 192, 1380 minus 192. It's 1188. Okay, so our ending equity is 1188. Oops, could put the comma in the wrong spot there. 1188. So now I know, okay, I'm just missing one number, right? I know my total liabilities and equity is 4,800. I know my current liabilities are 600. I know my equity is 1188. I just got to plug. My plug variable here is long-term debt, so let's figure it out. Now, the way we're going to get there is just go 4,800 minus 1,100 minus 600. So 4,800 minus 1188 minus 600 to get that missing number. The missing number is 3012. So there we have it. This was harder to do. Part B was definitely harder to do, particularly if you've never done it before, but we did it. We need to have roughly $3,000 in debt in order to make this thing work, 3,012. So prepare pro forma statements, done. Compute external financing needed. That's just saying how much new debt do we need? Well, we had 2,600. We're going to need 3,000, so 3012 minus 2,600. We're going to need $412 of new debt. The external financing needed, the new debt needed is 412, just the additional borrowing. And so again, that's a problem for real businesses, right? They go, wow, if everything goes according to plan, I need to borrow 400, in this case, let's pretend it's all in thousands, $400,000. You better make sure you got a bank willing to lend you the $400,000 or your plan goes poof, up in smoke. So that's why EFN is really important, because you run out of money and you're dead as a company, right? This companies get in crunches if they are unable to borrow when they need to borrow. Okay, I don't know what's just happened here. There we go. I was just going to click over to this screen to say if you made it to the end of the video, I hope you liked it. I hope it was helpful. And if it was helpful, and if you did like it, please don't be shy. Hitting those buttons helps me out a whole heck of a lot. Have a great day. Thanks for watching. Bye for now. Let's examine problem 2.2a, more on external financing needed. This time we may or may not need to buy some new fixed assets, and that's sort of the extra dilemma, the extra wrinkle thrown in here. Here we go. Fisher Company's financial statements are below, and we got an income statement and a balance sheet, and it says the company expects sales to grow by 40% next year, so we're going to have to recast the income statement with 40% sales growth. It says it's going to have a 25% payout ratio, dividend payout ratio, and all costs, current assets, current liabilities are expected to increase with sales, implying long-term debt, equity, and net fixed assets are not. So let's read on. It says, assuming a company is operating at 65% capacity usage for fixed assets, compute the external financing needed, and also at 95% will be our second part. But let's start with the income statement. That should be easy here because 40% sales growth and 40% cost growth just means multiply everything by 1.4, right? This is all plus 40%. So 7,500 adding 40%, we multiply by 1.4, we get 10,500. 7,300 times 1.4, we get 10,220. 10,500 minus 10,220 is 280. That also happens to be income before taxes times 1.4. 60 times 1.4 gives us 84. And again, taxes are 30% of income before taxes. So 280 times 0.3, it's also 84. Net income, 280 minus 84, 280 minus 84. Our new net income here is 196. Okay, we've projected our income statement. That'll be the same in both scenarios because we're only worried about capacity of fixed assets, and that's going to create some potential borrowing. But let's go on to project our balance sheet, and we're given that current assets and current liabilities are going to go up by 40% in this scenario. They vary with sales. So sales are up 40%. We're going to need 40% more working capital, for lack of a better word. So 2,000 times 1.4, 2,800, and 1,500 times 1.4 is 2,100. Okay, now the $1 million question. Before we can solve for the equity, well, we could do the equity if we wanted, but before we do that, let's do net fixed assets. We have enough information to do that as well. The question says the company's operating at 65% of capacity with its fixed assets. So we got to answer the question, do we need to buy any new fixed assets? Do I need new fixed assets to sort of fill a 40% increase? Well, very simple calculation. We're at 65% of our maximum, and now it's saying we want to increase by 40%. Production's got to go up by 40%. Presumably we need 40% more assets. Well, if production goes up by 1.4 times, 40% more, where am I at? 0.65 times 1.4, I'm at 91% of capacity. So if I go from using my assets 65% to 90%, do I need to buy new ones? The answer is no. I mean, we might have to replace or repair some, but no, we don't need to buy any new ones. We're operating at 60% capacity. Maybe we're operating, 2 shifts, and now we can just add a shift but still use the same assets. So no, I don't need to buy any new assets. That means my net fixed assets can remain at 4,000. So 2,800 plus 4,000 is 6,800. My total liabilities and equity then will be 6,800 in this scenario. We can solve also for equity. Remember, equity is beginning equity plus net income. I like to subtotal it here. Minus dividends equals ending equity. So our beginning equity was 2,000. We're going to add net income. Our projected net income is 196. So I get 2,196. This would be my equity if I didn't pay a dividend, but I do pay a dividend. We have a 25% dividend payout next year. So 25% of net income, so 196 times 25% gives us, I always double underline, that gives us a dividend of 196 times 0.25 of $49. So I'm going to deduct $49 to get my ending equity to 196 minus 49, 2147. There's our ending equity. So our ending equity here, 2147. Now it's just a plug, right? Now we're plugging for our long-term debt, and that's going to help us figure out the external financing needed. I just go 6,800 minus the 2 above minus 2100 minus 2147. That's going to solve it for us. 6800 minus 2100 minus 2147 gives us 2553. So are we going to need to borrow some new money? Yes, but not much. Like, I wouldn't be super worried if this was my projection. My EFN is 2553 minus 2500. I'm going to need $53 or thousand or million, right? Like, these are often in big numbers, but I'm going to need $53 in new financing according to this calculation. Okay. Now we're asked to do the exact same thing, except this time we're at 95% capacity. Let's see if I can get, I'm just going to solve in the same spot, but with a different color ink. See how I do with some, maybe green ink? What do you think? Green? How's this look? Hello? Yeah, that looks okay. Maybe a little bit thick. Let me make it a little thinner. Then we'll solve. Yeah, that's perfect. Okay, so I'm going to solve in green ink the exact same problem. In fact, I don't need to do anything here. The income statement is the same. The balance sheet, though, my current assets, they grow by 40%. My current liabilities, they grow by 40%. Let's look at what happens to net fixed assets. That's the key to the whole puzzle. That's the new thing. And let's think about this. We are at 95% capacity now, and we're going to grow by 1.4 times. 95% times 1.4 times growth, 40% growth, is going to put us at, let me get my calculator, oh, there it is, 0.95 times 1.4. It's going to put us at 1.33x capacity. Meaning, I got to grow my fixed assets by 1.33 times. So let's do that. We have $4,000 in fixed assets. I want them to go up by 1.33 to 5320. Our new total assets then, 2,800 times, or not times, plus 2,800 plus 5320 is 8120. Now it's all the same math on the other side. We just have to sort of redo it. Our current liabilities are 2,100, same as before. Our equity, same as before. So it's going to be beginning equity, 2,000, just as it was. Our net income, because our income statements are the same, is the same. Our dividend payout ratio remains the same. So our ending equity is still 2,147 in this new scenario. We've just got to plug then. We know our total assets now are 8120. They're higher, right, than the new total assets. So our total liabilities and equity has to match that, has to be 8120. So we're going to have a whole bunch of new borrowing. 8120 minus 2147 minus 2100 gives us our new borrowing needs, 3873. 3873 is our missing number there. So under this scenario, our EFN is 3873 is our new debt. Our old debt was 2,500. So our new borrowing, our external financing needed here, is 1373. This is significant, right? Especially if these are in thousands or millions of dollars. You're thinking, my God, I got to borrow so much money to meet my needs. If I want to grow like this, I'm going to need a lot of new assets. And if I need a lot of new assets, I'm going to need to borrow a lot of money. My external financing needed here is 1373. And again, that's a problem or a challenge for the manager to make sure they have the capacity to borrow that much. And if they don't, they better change their plans. Okay, that's it for this video. Stay tuned for the next one. Bye for now, and thanks for watching. Bye-bye. Let's take a look at problem 2.3a. We're going over a couple of growth rate calculations. The calculations themselves aren't too hard, but kind of understanding what's going on might be a little harder. So let's discuss the meaning of an internal growth rate and a sustainable growth rate as we solve the problem. So I'm going to distinguish the two immediately. The difference between an internal growth rate and a sustainable growth rate is this. An internal growth rate is how fast a company can grow without taking on any new debt. So it's what percentage in growth the company can experience without taking on any new debt. A sustainable growth rate is the rate of growth a company can have while taking on some new debt, but maintaining the same debt to equity ratio. In other words, as the equity grows, the debt is allowed to grow along with it. Where in internal growth rate, the equity grows, the debt has to stay at the same level. So we're going to project that a sustainable growth rate will always be larger than an internal growth rate. Let's get to the problem, and hopefully it sort of clears itself up as we go. So we were given financial statements, given a dividend payout ratio, and it says compute the company's internal growth rate. Now, there's just a formula for this. At the end of the video, I'll show you, I'll prove that this does indeed work. But at this point, you just want to kind of know the formula. So the formula for an internal growth rate is ROA, return on assets, times B, I'll explain what B is, divided by 1 minus ROA times B. So lowercase b, 1 minus the numerator. Okay, so ROA is return on assets. We learned to compute that last chapter. It's net income divided by total assets. So here it's net income divided by total assets. We can do the math. In fact, let's do the math. 350 divided by 2,000. 17.5%. Okay, so I'll put 0.175, 0.175. That's our ROA. What is the B? The B is called the plowback ratio, or the plowback. So if we have a dividend payout ratio of 30%, so it means of our profits, 30% is getting paid out. It's our policy to pay out 30% of our profits in the form of dividends. How much are we plowing back in the company? How much are we keeping in the company? How much are we retaining in our company's retained earnings? Well, the answer is the inverse, right? If our dividend payout ratio is 30%, the plowback rate, or the plowback ratio, is going to be 70%. That's how much we are plowing back into the company. So that's B. B is the plowback. So 0.175 times B, so it's 0.175 times 0.7, divided by 1 minus 0.175 times 0.7. Okay, so let's crunch all the numbers. So 0.175 times our plowback, which is 0.7. It's 0.1225. That's my numerator. 1225. My denominator is 1 minus 0.1225. So 1 minus 0.1225, 0.8775. So 0.1225 divided by 0.8775. And it's going to give us a percentage. 0.1225 divided by 0.8775 equals, whoa, I messed that up. I missed the decimal. 0.1225 divided by 0.8775. There it is, 13.96%, 0.1396, or 13.96%. Okay, so that is our internal growth rate. And that just means no more debt. How quickly can I grow? What's the maximum this company can grow without taking on new debt, without taking on leverage? That's the answer. That's the internal growth rate, and it's about 14% for this company. Now, I'm going to prove that, but I'll prove it a little later. So let's compute the sustainable growth rate, then we'll come back to that concept. So the sustainable growth rate, almost the exact same formula. We just changed one letter. We changed the A in ROA to E. So we use return on equity. Exact same formula otherwise. So the formula is ROE times B divided by 1 minus ROE times B. So what's our return on equity? Well, it's our net income divided by our equity. So net income divided by equity, 350 divided by 1,000 is 0.35. So 0.35 times B, same B as before, which was 0.7, 0.35 times 0.7, divided by 1 minus 0.35 times 0.7. Okay, so now let's crunch the numbers. 0.35 times 0.7 is 0.245 divided by 1 minus 0.245. 1 minus 0.245 is 0.755, so 0.245 over 0.755, and let's at long last get a number. 0.245 divided by 0.755. We get 32.45%. So remember what this ratio was. The first ratio, I think, is very clear, at least in my mind. The internal growth rate tells us how quickly can this company grow without taking on a single dollar of debt. So the company can grow about 14% per year. The sustainable growth rate is how quickly can the company grow while maintaining the same debt to equity ratio. That means it takes on more debt, but the debt grows in proportion with the equity. So the fastest it can grow there is 32%. So it can grow faster. The sustainable growth rate is always going to be higher than the internal growth rate. Okay, if you want to stop there, I think this is a great place to drop out. I'm going to keep going though, but if you want to stop there, no hard feelings. As long as you smash one of those buttons, no hard feelings. But if you want to keep going, I just kind of want to prove this one. We won't go through both. You definitely could do both. I just want to prove this one. So if we grow at 14%, 13.96%, what does our company look like? And the answer is, it looks like it grew by 14%, but we don't take on new debt. Let's do some math here. So again, we'll recast our income statement plus 13.96%, right? Assume we grow by about 14%. So 3,000 times 1.1396, 3418.8, 2,500 times 1.1396, 2849, 3418.8 sales minus our costs, 2849, 569.8. Taxes will be 30% of that, 170.9 say, and profits 569.8 minus 170.9, and we get 398.9. Okay, so our income statement has now grown by about 14%. Let's contemplate what that looks like for our balance sheet now. So our income statement's grown by 14%. What about when our balance sheet grows by 14%? But we, again, want to maintain the same level of debt. That's the whole idea here. So our current assets are going to grow by 14%. 200 times 1.1396, 13.96%, 227.9. 1,800 times 1.1396, our fixed assets grow, 2051.3. Totaling up here, 227.9 plus 2051.3 gives us total assets of 2279.2. That's going to be our total liabilities and equity, 2279.2. Let's figure out what our equity is going to be after having this happen. Okay, so our old equity was 1,000. we're going to add the net income, add the profit, 398.9. We're going to take out a dividend now. Dividends are 398.9 times 0.3, 119.7. And that's going to give us our new equity. So 1,000 plus our net income, 398.9, minus our dividend of 119.7. This gives us our new equity next year of 1279.2. Okay, so there's our new equity, 79.2. Okay, so now we know our liabilities, we know our equity rather, we know our liabilities plus equity. We're just going to solve for liabilities. And you can see the answer here. What's the missing number? Well, it's something plus 1279 equals 2279. It's 1,000. The whole point of this exercise was to say, if we grew by 14%, we're not going to need to take on any new debt. And guess what? I crunched the numbers. It's true. If we grow by 14% exactly, well, 13.96%, we don't need to take on any new debt. That last part of the video, there's a reason I said goodbye to a lot of the students, because generally speaking, you're not going to be asked to prove that. You're just going to be asked to like crunch the number, right? And so crunching the number is a lot shorter, but I just wanted to prove to you that this does in fact work. So it worked for me. If it worked for you, hit one of those buttons. Have a great day. Thanks for watching. Bye-bye. Let's run through problem 2.4a. We're calculating a sustainable growth rate. This is a funny problem. I have to be honest with you. The reason it's a funny problem is because it's not super realistic. We're given just scattershot information and we have to play puzzle solver here. So normally you just look at financial statements and be able to get the information off financial statements. Here we're given just like bits and pieces, the odd ratio, and the idea is, are you clever enough to solve the puzzle that's been put in front of us? So let's see if we're clever enough to solve this puzzle. It requires some algebra, and algebra is not my strong suit. I've got to be honest with you, but I think we're going to get through it together. I hope so. Calculate the sustainable growth rate given the following information, and there's a bunch of ratios and information they've given us. Now let's remember what a sustainable growth rate is. It starts with ROE, return on equity, times B, which is our plowback ratio, divided by 1 minus ROE times B. That is our sustainable growth rate. Okay, so we've done that in previous problems, right? We've solved for the sustainable growth rate. That's the formula to do it. And we're given bits and pieces. We're basically given enough information to figure out B, because we're given the dividends and the net income. So, all right, if we're paying $20,000 out of $30,000 in dividends, our dividend payout ratio is 66.67%. And that's the payout ratio. So how much are we plowing back into the company? Remember, B is the plowback, right? It's the amount of money that we're not paying out as dividends. Well, it's 33.33%. So that's our B in this formula. So, all right, we're already most of the way there. We got the B. The ROE is not easy. That's the problem in this question. If it's just finding out the B, okay, yeah, you kind of got to solve for it. But so B is 33.33%. We'll kind of keep that. You know what? I'm going to put that up here somewhere. B equals 33.33%. Okay, well, that'll come in handy much later. We now have to solve for return on equity. And return on equity is net income, which we have, divided by equity. So we just have to figure out, what is our equity? That is the $1 million question here, and it's not so easy to get. To get there, you have to know these formulas. So our profit margin is net income divided by sales. This goes back to stuff we learned in chapter 1 when we did ratios. We looked at this ratio, and if you have a ratio sheet you can refer back to. Capital intensity ratio is assets divided by sales. And debt to equity ratio is debt divided by equity. Okay, so we're just going to try to figure out the raw numbers here, and we'll work our way down from profit margin and try to figure out missing numbers. So let's start with profit margin. We know net income divided by sales equals 10%, 0.1. We also know our net income is 30 grand because it was given. So we can solve for sales, right? We know this is $30,000. So $30,000 divided by sales equals 0.1. If you rearrange, you go, okay, 30,000 divided by 0.1 equals sales. What you find is sales equals 300,000. It's just 30,000 divided by 0.1. 300,000. Okay, so maybe useful information, maybe not. We'll see. Well, in fact, it is useful information. I wouldn't have solved if it wasn't. We can use that in this next ratio where we know assets divided by sales is 0.85. So assets divided by, now we know our sales, 300,000 divided by 300,000 equals 0.85. So assets is 300,000 times 0.85. 300,000 times 0.85 means our total assets are $255,000. Okay, so again, a little bit of algebra and just like puzzle solving in this problem. Next, debt to equity ratio. Now, again, if you're doing this for the first time, you wouldn't know where to begin, I believe. But that's why we do these together. And so if you're faced with something like this, okay, you've got at least a prayer, right? Debt to equity ratio is 3.2. So, okay, we know we're trying to get down to equity, right? Because that's what we're looking for. We're looking for ROE, and we need the E to get to ROE. So we got to solve here for equity. Now we know debt plus equity equals the total assets. Assets equals liabilities or debt plus equity. So we know debt plus equity equals 255 because we just solved for assets. We also know debt divided by equity equals 3.2. Debt to equity ratio equals 3.2. I'm going to move this out a little bit just to sort of focus in on this part of the puzzle. And so we just got a little algebra puzzle to be solved here. Debt plus equity equals 255,000. Debt divided by equity equals 3.2. I'm going to isolate equity as a variable. So I'm going to say, actually, I'm going to isolate debt as a variable. Debt equals 3.2 times equity, right? I just moved the equity up. I'm going to plug this in and replace debt up there. So I'm going to say 3.2, because if debt equals 3.2 equity, I can just plug it into the formula. 3.2E plus E equals 255. 4.2E, so 3.2E plus 1E is 4.2E equals 255. Equity equals 255 divided by 4.2. Our equity equals 60714. Okay, now we can solve. We know our net income. Our net income was $30,000. Net income divided by equity equals ROE. So was it 30? Yeah, $30,000 divided by 60714 goes 0.494, 49.4% or 0.494. Okay, so now we have everything. We have our ROE, 0.494. We have our B, 0.333. Let's solve. I'll do this in different color ink because it's getting too much of the same ink. So let me actually move this over here. So our equity, or our ROE was 49.4%, 0.494 times B, which was 0.333, divided by 1 minus 0.494 times 0.333. And let's crunch the numbers. 0.494 times 0.3333333 is 0.1647. 0.1647 divided by 1 minus 0.1647. So divide by 0.8353 divided by 0.8353. And here is our answer after all that effort. 0.1647 divided by 0.8353 equals 19.72%. So a long journey there, but we have calculated our sustainable growth rate. Our sustainable growth rate is 19.72%. Really more of an algebra problem, really more of a puzzle that we've solved, but congratulations to us. We've solved it. That's it for this video. Thanks for watching. I'll see you in the next one. Bye-bye. Let's jump into module 3 of our course. This is, I think, the most important module of the whole course. I don't think it's the hardest, but it's so fundamental to everything we do in finance that if you don't understand annuities and the time value of money well, you'll be in trouble in your course. So let's just sort of jump into it. I brought this slide up in lots of my videos so far. The value of anything is the present value of the future cash flows. Well, again, that word future, that makes me think, okay, there's time involved, right? This time value of money. $1 a year from now is not worth the same thing as $1 today, right? You would rather have the dollar today than $1 promised to you in a year. Money changes value over time, and that's where the math of finance comes in. So a simple example to kind of get us started and get us thinking about this: I buy a $1,000 investment that offers 5% annual interest. Whenever you're quoted interest, it doesn't say annual or when you assume annual. Question: how much is it worth in a year? Okay, so your intuition and my intuition here should be pretty much right? It's a $1,000 investment. It offers 5% interest. That means it's $50 in interest. 1,000 times 5% is 50. And so if I don't lose that original investment, I'll have 1,000 plus 50. I'll have 1,050 in a year. And we, of course, are right. Now, yes, we can solve, I would call this a future value of a lump sum question, right? And it's only 1 year away. We can solve this just in our head, just with our own intuition. But what if I said, oh, we left it in and let it roll over for 10 years? Oh, it's a little bit more complicated. My intuition doesn't quite get there because year 1, I have 1,000. Year 2, I have 1,050 for another year. Year 3, I roll that over. And if it keeps rolling, the math gets like, it's not so easy. And so because of that, we're going to use, I'll show you how to solve things by hand using formulas this chapter, but also show you how to use a financial calculator. So let's solve this very basic one just by hand and with our financial calculator, the more proper way. And as we jump into the chapter, you're going to do tons of examples. This chapter has more examples than any other chapter I've ever written. But let's solve this one using a formula. And this is a formula. It's, again, future value of a lump sum. So it says, well, let's keep the question on screen. Future value, that's what we're solving for. That's our X, our unknown, equals PV. Well, what's the value of the investment today on times 0? The value of the investment is $1,000, right? This is what I'm putting in today, times 1 plus R to the T. R is the interest rate in this case. It's often called a discount rate or required rate of return. R is sort of a stand-in. You might have I as your notation in your textbook, and T is the number of years or the number of compounding interest periods. In this case, it's 1. So 1 plus R to the T, 1 plus 5%, which of course we're going to put in as 0.05 to the power of T. So it's 1,000 times, and then again, raise something to the power of 1. It's just that number, so it's 1.05 to the first power. It's 1,000 times 1.05, It's 1050. Big surprise. We kind of knew that already. Again, we wouldn't likely use a formula like this for a 1-year annuity, but if I wanted to do 10 years, real easy, right? You just put the exponent to 10. In fact, why don't we just for fun go out to 10 years? All right, so x equals 1,000 times 1.05 to the 10th power. Let me get my calculator out. I wasn't planning on doing this, but why not? It's fun. So it's 1.05. This little button is to the power of the y to the x. You'll see it on even your non-financial calculators. Y to the x 10. 1.62. I multiply that by 1,000. So this number in brackets is where, or this right here is worth 1.62. 1.63, I should say. 1.62889. I multiply this by 1,000, and I get the value in 10 years. 1628.89. Okay, so there we have it. We've solved for 10 years, which I couldn't do just with my intuition and my cunning and my guile to solve that. I needed a formula. I needed some support, right? Doing it in 1 year, no problem. Doing it out 10 years, I need something a little bit more than just my intuition to help me solve that one. Now, I think that formula is good, and I think that's how I would solve it, but there are many things that even get more complicated that have bigger, more detailed formulas that we'll learn this chapter, and I'll show you the formula way for pretty much everything, but it's also useful if you have the ability to use a financial calculator in your class. I highly recommend it, and if I had this problem in a financial calculator, it's actually a little slower to solve in financial calculators. As problems get more complicated, it's actually easier, but let's do the 10-year one. The 1-year one is too easy. Well, let's do them both. Okay, so I'll do the 1-year one first. So here's what I input in my calculator. N is the number of periods, so we called it T in our formula, but same thing, it's 1. IY is 5%. Now here we don't put in 0.05 into our calculator, we just put in 5. PV is how much it's worth today. I'm going to put this in as a negative generally. If I'm making an investment, I'm giving you 1,000 a day and I'm going to get back positive money later. PMT is if there's recurring payments. That's useful for annuities, another concept we learned this chapter. But here there's no internal like ongoing payments between either us or the person we're investing in, and FV is what we're solving for. So let's put those numbers into our calculator. So I put 1 N, I put 5 IY, I put 1,000 negative PV, PMT I put in as 0, and then I forget how to do this. I think I go compute FV. Yeah, compute FV, and you can see it's 1050. So CPT FV. It's been a while since I've used my financial calculator, and you can see it's 1050. Well, let's quickly do this for 10 and see if we match. So this is the number we're looking for. 1628.89. That's what we got with our formula. Let's see. Now, the good thing about a financial calculator is we've already got all the inputs in. All I have to do is put 10 in for N, and all the other numbers are in. So now I'm going to compute FV, and I get FV is 1628.89, and sure enough, it matches. So the purpose of this chapter is there's these types of calculations all over finance, and this was as easy as it gets, right? It gets harder and harder and harder, and so you really gotta grasp what's going on. So find out from your professor if you can use a financial calculator. If you can, you should be zipping along with your financial calculator. If you can't, it's totally okay. It's totally appropriate. You're going to need to learn the formulas that we introduce through the chapter. But that's, I can't speak to what your professor is doing. I think it's appropriate to allow a financial calculator. I think it's appropriate if they don't allow it. So you have to figure out what your professor is doing and work with them. In our videos, I'll do both. All right. Thanks so much for watching, and practice. You're going to want to do lots of examples, and I've got lots for you. Stay tuned for the next video. Bye-bye. In this video, we're going to work on a problem you can download from tonybell.com. Go to the website, click the PDF link, and you'll notice there's no sign in, no sign up. The PDF just pops right up. You'll scroll down and find whatever problem it is that we're working on. As you scroll through the problems, you'll notice many are free and open, like the one you're watching now, but some are members only. I think the free and open ones are enough for most people, but if you can't get enough of me and you'd like to join and get access to those members only videos, click the join button underneath the YouTube play box. All right, thanks so much for watching. Let's get started. Let's take a look at problem 3.1a, the first in our series on time value of money. So we deposit some money in an account. It's going to grow for a while. And we got to figure out, well, what's it going to be when we go to withdraw it a year or 5 years from now. You deposit $5,000 into a high yield savings account that pays 4% interest. How much money do you have after a year? Okay, well this, I don't need any fancy finance to tell me, right? I can just go, well, it's $5,000 I'm putting in. It earns 4% interest, so that's $200 is what it's going to earn this year. So if I start with $5,000, how much money do I have? I'll have $5,200. But of course, you probably won't be handed a question like this on your corporate finance midterm or, in any test. It's too basic, I would say. But, it could ask, what's that going to grow to over 5 years? And it's not as simple as saying, well, it's $200 in interest every year. So 5 years from now, that'll be $1,000 in interest. Because after year one, we have $5,200 in the account, and that $5,200 grows at 4%. This is the concept of compound interest. I'll show you how to solve this in a financial calculator in a minute, but I would never solve this one with a financial calculator. I would do it by hand, and here's how you would do this by hand. You go $5,000 times 1 plus R, being our annual interest rate in this case, to the power of T. T is the number of years or the number of periods that this thing is going to compound for. So $5,000, and this might seem weird if hopefully it isn't your first time seeing it, but if it is your first time seeing it, it might feel weird. You use this little function so much in a finance class, it's going to become second nature to you, which is why I would never use the financial elements of my financial calculator to solve here, just because the formula is real easy once you've used it a billion times, as you will in your finance course. So 5,000 times 1 plus R. Well, what's 1 plus R? It's 1 plus 4%. It's 1.04 to the T, 5 years. 1.04 to the power of 5. Okay, so let's punch that in our calculator. 1.04 y to the x, that means to the power of, and it's the power of 5. So 1.2166, that's what this equals, 1.2166 times 5,000. So I'll just multiply this number by 5,000. And I get 6083.26, 6083.26. Okay, so there, we've answered the question. We're done. And the idea is money grows when invested in an account that has interest. Pretty straightforward. I hope straightforward. I don't think you should use your financial calculator. And if you're not going to use your financial calculator, stop the video here. Just hit the thumbs up on your way out the door. But if you're one of those folks that wants to say, oh, I'd like to know how to use my financial calculator, this isn't a great question for it, but just practice. So here's what I use: the BA2 Plus financial calculator in classes and in videos. If you're using some Casio or some other brand, it'll be similar. So let's figure out what we're going to input here. The number of periods for this was, I think it was 5. The interest rate per period or discount rate per period was 4%. Present value is the value of the money today I'm going to invest. I put this in as a negative number. I'm putting in $5,000 out today. There's no recurring payments. The future value, we don't know. And the payments at the beginning, no. So we don't worry about the begin function, no. Okay, so let's input all of this into our calculator. What does that look like? I always go second function clear TVM in case there was some information in there. So second function gets you above, and then clear TVM. And then I go second function clear work, and then I hit the CC button 5 times just for good luck. I don't know why I do that, but I always do that just to make sure there's no numbers lurking in memory somewhere. So I hit 5N. I hit 4 IY. That's kind of a weird thing here. You put the interest rate, you don't put 0.04. You put 4 as in 4%, even though in a calculator you would put, or you were calculating numbers, you would put 0.04. 5,000 negative is my PV. 0 is my payment. I don't need to put it. Like if it's 0, you just don't do anything. I don't need it for the begin. So then I say, okay, please compute. So I hit the CPT button, and then FV, where are you? There you are. So compute FV. I get 6083.26. Same answer as I got up here. I wouldn't do this in a financial calculator. I would do this one by hand. There's plenty that we will do in our financial calculator this chapter. Anyway, there you go. We've solved 318. Now, I know the people that left earlier gave me a big thumbs up. I hope you give me an extra big thumbs up for sticking around till the end. Thanks for watching. See you in the next video. Bye. Let's have a look at problem 3.2a. This problem has us calculating the rate of return a little harder than problem 3.1, but let's jump into it. You lend your friend $400 today. They promise to give you $500 a year from today. What's the rate of return on this? If you give them $400 today, you get $500 back in a year. What's your return? So I think you can intuit the return. Just with your intuition, you can say, well, I went from 400 to 500. That's $100 in interest on a $400 investment. That's 100 over 400, 25% return. But let's kind of math this out, and I think that's the correct answer. Let's math it out with the formula that we learned from our previous video. So we know if I invest $400 today, I multiply it by 1 plus the rate of interest, that's what we're solving for, to the power of the number of periods. In this case, it's 1 year, so it's 1 compounding period. And that's going to equal 500, the future value of my money. Okay, so I divide 500 divided by 400 to get the stuff onto the other side. So 500 divided by 400. So now I have 1 plus r to the power of 1 equals 1.25. I divided 400 off of both sides. And anything to the power of 1 is just itself, so it's just 1 plus r equals 1.25. Subtract r from both sides, I get r equals 0.25. Okay, so I've done it sort of with the math. Now, 1 year from now, I think you can just do it the quick, easy way I did it, but very likely you'll be given multiple year situations, and if that's the case, you're going to need math. You're going to need the formula on your side. So it says, assume you lend them $400 today and they pay back the $500 in 4 years. So it's not 1 year from now. They hold on to the money for 4 years and they give you $500. So you earned $100 of interest over 4 years, not over 1 year. What does that look like? Well, same formula. You go 400, that's the value of the money today, times 1 plus a rate of interest to the power not of 1 now, to the power of 4. Equals 500. So divide both sides by 400. I get 1 plus r to the power of 4 equals 1.25. Now here's where you need a bit of algebra skill that I honestly lack. What you end up doing is you say, well, this is to the power of 4 and I want to get rid of this exponent. You raise both sides to the power of 1/4. So you end up going 1 plus r to the power of 4, but if I raise to the power of 1/4, I get rid of it, equals 1.25 to the power of 1/4. Okay, so let's do 1.25 to the power of 1/4. 1.25, I hit this y to the x button. To the power of 1/4 is 0.25. I have to put it in a decimal here. So 1.25 raised to the power of 0.25 is 1.05737. So I get 1 plus r equals 1.05737. Subtract 1 from both sides, I get r equals 0.057 37, and we've solved it. So R equals 5.737%. Okay, that is the correct answer, and we've done it with formulas. This one might be one I would want to do in a financial calculator, because for me, everything's okay except for this step where we raise everything by a power of a quarter to get rid of that exponent. You know, if you practice it, certainly you can get it, but I don't know, I'm just not that algebraically talented. And so once I get to something like where it has me calculating rates, I end up leaning on my BA2 Plus, my financial calculator. You may be allowed to do that. If you're not allowed to do that, now's the time to say goodbye. Goodbye. But if you are using a financial calculator, here's how you would solve with a financial calculator. And I do think this is easier. I do think it is a time-saving step. So the number of periods here, we're just going to do part B. The number of periods is 4. The interest rate per period is what we're solving for. Our present value, we're going to give up $400 now with the expectation of getting $500 in the future, and there are no in-term payments, which we will get into. It's a big part of a corporate finance class, but when we're introducing the concept, we don't have any payments. And so payments at the beginning, no, there are no little payments going back and forth. Okay, so I clear my memory. I go second function clear TVM. I go second function clear work. I hit the CEC button a bunch of times. 4N. IY, I don't know. PV, 400 negative, PV. 0 PMT, you don't need to enter that one if you've cleared your memory properly. 500 FV, and then I say compute the IY, and I get 5.737. So we solved this one 2 ways. I think it was a little quicker in the old BA2 Plus. It's going to depend what your professor allows. If your instructor lets you use a financial calculator, I do recommend using them. I think it's going to save you a lot of time and effort, especially when we get into more complicated annuities and things like that. But that's all for a future video. For now, on your way out of here, smash one of those buttons. Is that the verb? I think the verb is smash. Smash one of those 2 buttons for me. Have a great day. I'll talk to you soon. Bye-bye. Let's have a look at problem 3.3a, present value question. Your grandfather makes you an offer. They say, I'll give you $100,000 today or $200,000 in 10 years. Assume you wish to use a discount rate of 8%. Are you better off or worse off if you take the money today, and by how much in today's dollars? Okay, so there's I think a quick, easy way to solve this, but the issue is actually the second part. The first part should be easy because you can just go, okay, if he gives me $100,000 today, I can go, well, I can invest that at 8%, so times 1.08 to the power of 10, and I can say $100,000 today times 1.08 raised to the power, 1.08 raised to the power of 10 times 100,000. You can see I make $215,892.50. I should take the $100,000 today, right? $100,000 today in 10 years is worth, $215,892. I'm clearly better off to take the $100,000 today than to take $200,000 in 10 years. And I'm $15,000 better off in 10 years. How much better off am I in today's dollars? Well, the way we would get at that is to take this $200,000 and discount it back to today. So how would you go about doing that? Well, the present value times 1.0, in this case, 1.08 to the 10 equals the future value, right? In this scenario. So the present value times 1.08 to the 10 equals $200,000. To discount it back, you just divide by 1.08 to the 10. So I'm going to take 1.08 to the power of 10, 2.159, and I'm going to divide 200,000 divided by 2.159, and that's going to give me how much that $200,000 is worth today. Again, 200,000 divided by 1.08 to the 10. So 200,000 divided by 2.159. To do that, just to keep all the decimals, you can go 1 over x in your calculator to divide 1 divided by 2.15, and then multiply that by 200. That discounts the money to today. I get 926.3, let's call it 92639. So $200,000 today is worth 92639. I'm being offered $100,000 today, or I can take something that's worth $92,000 today. I should obviously take the $100,000. Now, what's the difference? It's a difference of $73.61. So you are $7,361 better off if you take the $100,000 today. So that is the answer to the question. Showing you how to do this in the financial calculator. Let's think of our inputs here. The number of periods here is, what is the number of periods? 10. Our interest rate is 8%. Our present value is what we're solving for. Our PMT is 0. We don't have to worry about a payments at the beginning thing. And our future value here is positive $200,000. So what is that in today's dollars? Okay, clear, second function, clear TVM, second function, clear work. Okay, I'm making sure everything's clear. 10 goes in as N. 8 goes in as IY. 0 goes in as PMT. And 200 goes in as FV. And now I compute PV. And I get 92639. 92639. And in other words, I'd have to give up $92,000 today. That's why it's negative. I'd have to give up $92,000 today to get $200,000 back in 10 years. So I'd rather get the $100,000 right now, and you can see the numbers do indeed match up. There we have it. We've solved 3.3a. As always, thanks for watching. Bye-bye. Let's have a look at problem 3.4a. Thus far, we've been asked to calculate the present value, the future value, the rate of return or the interest rate, and now we're being asked to do the hardest one, mathematically anyway, the hardest one, the number of periods. So we're given present value number, you invest $50,000 today at an interest rate of 8%, so we're given the rate, and it says how long will it take for this investment to grow to $75,000, so that's the future value. So we've been given everything but how long, right? The number of periods. This is the hardest one to do. So here's the formula we've been using quite often this module. The present value, you take the dollar value today times by 1 plus the rate raised to the power of the number of periods equals our future value. So plugging things in here, it's $50,000 times 1 plus the rate of interest, 1.08. Our rate is 8%. Raised to the power of t, that's what we're solving for. We don't know the number of periods, equals our future value, 75,000. So we got to solve for t. And the fact that we're solving for an exponent brings the math far beyond my puny brain. But my understanding reading the textbooks is it's just not an easy solve. The textbooks all say just trial and error to get your answer. So I'll show you what trial and erroring to get our answer looks like here. So I'm going to divide both sides by 50,000 to get the 50,000 off this side. So I have 1.08 to the power of t equals 75 divided by 50. It equals 1.5. Okay, so I need to make 1.08 to the power of something equal 1.5. And good news is most calculators will have this y to the x or some x to the y button, right, that I'm hovering over right now. And so I just trial and error. I go, okay, well, 1.08 to the power of 3 is at 3 years. 1.25, I'm not even close. Okay, 1.08 to the power of 6 years. Is it 6 years? Okay, 1.58, I'm too high, right? Because I want it to be 1.5. I'm shooting for 1.5. So 1.2 was too low, 1.6 is too high. Let's go a year less. 1.08 to the power of 5. Oh, I'm closer now, 1.47. I want to be at 1.5, but I'm at 1.47, so it's a little bit higher than 5 years. 1.08 to the power of 5.2 years. Is it 5.2 years? Oh, I'm 1.49. I'm still not there. It's higher than 5.2. 1.08 to the power of 5.3. Now I'm just a little too high. It's somewhere between 5.2 and 5.3 years. 1.08 to the power of 5.25. 1.497. Okay, I'm going to stop there. I'm going to say 1.08. I'm going to say T here, just by trial and error, equals, I'll make this wavy because we're not quite right. What was it? 5.25 is where I saw it. It's actually a little higher than 5.25 because we want this answer to be a little higher. It's actually 5.26, 5.27, 5.28, something like that, right? And you just have to try them all in your calculator until you land right on it. Here I'm going to say it's about 5.25 periods or 5.25 years. Now, that's kind of unsatisfying to me, but you can get the answer that way, right? And it's just like, okay, brute force your way to a solution. In Excel, you can like goal seek. But if you have a financial calculator, you can just solve. So let's solve in our financial calculator. Let me pull up my little table here and we'll fill in the information that we've got. The number of periods is our thing that we're solving for. Our IY is 8%. Our PV value today, $50,000. We're going to invest today. There's no payments. There's no BGN. And our future value is $75,000. We put in 50 today to get 75 out in who knows how many years, 5.25, somewhere around there, a little higher, we said. So let's punch in our numbers. I always clear memory to the best of my ability. And I go 8 is my IY. 50,000 negative is my PV. 75,000 positive is my FV. And that's everything. PMT is 0. Zero is PMT. I think I put in 75 as PMT there by mistake. Anyway, I think we're good. Now I've fixed my PMT. Now we want to compute the number of periods. So I say compute N, and I get 5.268. So we knew we were close. But 5.268 is a more precise answer than 5.25. There we have it. We've solved 3-4A. We did it the trial and error way, and we got close, and we could have got closer if we just stuck with it. Now we've got a much more precise answer using our financial calculator. I hope this video helped you, and if it did, I hope you'll give me the old thumbs up. Thanks for watching. Bye-bye. Let's examine problem 3.5a, rates of return. So we know the formula that we've been using this whole chapter. Present value times 1 plus the rate of return raised to the power of the number of periods equals the future value. And so we're doing lump sums here, right? This is just one chunk of money in the present, one chunk of money in the future. In future questions, this chapter, we'll look at frequent cash flows and annuities, they're called. But here it's just one chunk. So it says one of the most famous baseball cards is the T206 Honus Wagner card. I urge you to Google it. It's a very famous baseball card. Mint condition copy was sold in 1933 for $50. By the way, $50 in 1933. It's like a ton of money. And was the most expensive baseball card in the world at the time. In 1991, a group including professional hockey legend Wayne Gretzky, if you're Canadian, you definitely know who Wayne Gretzky is, very famous ice hockey player, bought a mint condition copy of the famous card for $451,000. 4 years later, in 1995, they sold the card to a group led by Walmart for $500,000. So these are famous sports cards bought and sold by famous people. The same card sold to another collector in 2006 for $2.6 million. So the question says, what was the rate of return on the card from 1933 to 1991. If you bought the card for $50 in 1933 and then sold it to Gretzky in 1991 for $451,000, what was your return? So we're solving for R. Okay, let's punch in what we have. Today is 1933. We buy the card for $50 times 1 plus R raised to the power of T. Well, how many years is it? 1933 to 1991. 70, 60... 58 years, 58 years. Doing the math in my head, always hazardous to a guy's health. 1991 minus 1933. Yeah, 58 years. Okay, raised to the power of 58 equals, so we bought it for 50, 58 years go by, and we sell it for $451,000. What is our annualized rate of return, our compounding rate of return here? Divide 451 divided by 50, so we get 1 plus R raised to the power of 58 equals 451 divided by 50, 90/20. Okay, so 1 plus R to the 58th equals 90/20. We have to raise these to the power of 1 over 58th. We have to take the 58th root of these, so to the power of 1 over 58 to get that working. So again, we're just getting rid of this exponent, so we raise both sides to the power of 1/58. 1 divided by 58, I need it as a decimal, is 0.01724. So I get 90/20 to the power of 0.01724 equals 1 plus R. 90/20 to the power of 0.01724. I get 1.17, almost exactly. It's unusual to have a number so close to an exact number. 1.17, R equals 0.17. R equals 17%. So in answer to A, what's the rate of return on the card from 1933 to 1991? It's a crazy example, right? This is an unusual type of investment, but there you go. You would have earned an annualized return of 17%, way outperforming any stock market over the same time period, I'm sure. What did the Gretzky Group get on the card? Okay, the Gretzky Group, this is more human terms, buys the card for $451 in 1991, and then 4 years later they sell it for $500. Now, they didn't get a great return here. So let's do the math here. So the PV, 451 times 1 plus R to the power of how many years? 4. So 4 years later, they sell it for $500. Okay, divide both sides by 451. So 500 divided by 451. 1.1086. 1.10865. I'll throw that in. So 1 plus R to the power of 4 equals 1.10865. 1 plus R equals 1.10865 to the power of 1/4, sort of same thing we did here doing 1/58. Here we do 1/4. So 1.10865 to the power of 0.25, right? 1/4 is 0.25. So I get 1.02612. So 1 plus R equals 1.02612. R equals 0.02612. R equals 2.612%. Okay, so the Gretzky Group did not earn a great return, 2.612%. They would have been better buying an S&P 500 index or something like that. I want to show this in the financial calculator just in case you were curious about that. So let's do the Gretzky Group. We won't do them all in the financial calculator. We'll do the last one by hand, but let's just do this one in our financial calculator. Make sure we know how to do that. Make sure everything's cleared. Our present value here is $451,000 negative. We make a $451,000 investment to get $500,000 in the future. That's our F fee. We enter the N as 4. Our payment is 0, and then we compute the IY, and you can see 2.612, and that's the same answer. So I just wanted to show how you would do that in the calculator, and we do produce the same answer. Let's do the last piece. It says, what's the total rate of return from 1933 to 2006? Okay, 1933, the PV of the card was 50 times 1 plus R, raised to the power of the number of years. 1933 to 2006, 73 years. Raised the power of 73, and in that year it sells for $2.6 million. So we get a rate of return here. We'll solve for R. So divide both sides by 50. $52,000. This grew by 52,000 times, right? The value didn't double, didn't triple it. 52,000 times itself. That's what long time periods and high growth will do for something. So 1 plus R to the 73 equals 52,000. We have to take each side and raise it to the power of 1/73. 1 divided by 73 is 0.0137. We're going to call that 0.0137. 1 plus R equals 52,000 to the power of 0.0137. So 52,000 to the power of 0.0137, 1.1604. So R equals 0.1604. R equals 16.04%. There we have it. We've solved part A. 17% is the return from 1933 to 91. The Gretzky group did very poorly on the card, only earning 2.6% over their short ownership. But over the life of the card, well, from 1933, it's an older card than that. From 1933 to 2006, if you had owned it the whole time, you would have got 16% return on your money. That's our answer to part C. All right. Kind of a long one, an interesting one though. Sports cards, at least they interest me. And if they interested you, hit me with a thumbs up. Thanks for watching. Have a great day. See you in the next video. Bye-bye. Let's take a look at problem 3.8a. We're taking the present value of an annuity. An annuity is just a stretch of recurring cash flows. And this is such a common problem in corporate finance. I promise if you're doing finance, you will see this type of problem in your class where you've got a string of payments. So let's look at the situation and kind of contemplate how we're going to tackle it. You run a taxi company and are thinking of investing in all electric vehicles. To change your fleet from gas powered to electric would cost $1 million today. But would produce annual savings of $150,000 over the 10-year life of the cars. Company uses a discount rate of 6%. So it's going to cost us $1 million today, but over the 10-year life of the cars, let's see, so we got 10 years. Let's call this 5. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, so there we have our 10 years on a number line. Each year, we're going to save $150,000. Plus 150. Sorry, I have to write this 10 times. Plus 150, plus 150. Plus 150, plus 150, plus 150, plus 150. And the question is, what's the value of saving this $150,000 a year over the next 10 years? And the answer is not 1.5 million, right? 150 times 10 is 1.5 million. But of course, that's future dollars. They need to be discounted to today. And so what we learned in previous videos is, well, if I want to discount this, I can just go, well, this 150 divided by 1 plus the discount rate, 1.06 to the 10, and do this one divided by 1.06 to the 9, divided by 1.06 to the 8, and so on. And add those all up, and I can figure out what the discounted cash flows are going to be. But that's a pain in the neck, isn't it? So you could do this and get the right answer, but it's too much work and it's too tedious. So there's really 3 ways to solve here, and I'm going to go over two. So the way I'm not going to go over is these things called present value tables, which your professor might use. And if they do use, unfortunately, this isn't the video series for you. Although I do think you can, even if they give you present value tables, you can still solve it formulaically. And that's the first way we are going to solve it together. The second way we're going to solve it together is with the calculator. So of the three ways, we're not going to use tables. We are going to do it via the present value formula, and we're also going to do it in our financial calculator. And that's what we'll do in this video. So let's solve it. So some smart mathematician looked at this situation and was like, okay, yes, I could brute force and calculate 10 present values and add them all together, but that seems like a lot of work. Why don't I solve for this mathematically? I don't know how they come up with this formula. They're much smarter people than me, but here's the formula they came up with. They said, okay, the present value of annuity equals the recurring cash flow amount. And it's got to be recurring. So in this case, it's $150,000 of recurring, annual cash flows times. Now, this is such an awkward construction, but you get used to it. Once you've done this like 10 times, you sort of get used to it. 1 minus 1 divided by 1 plus our discount rate. And our discount rate was, what was it? 6%. So 1.06 is what goes in this bracket. 1.06, 1 plus the discount rate to the power of time t. This was 10 years. All divided by 0.06. Okay, so now we just have to crunch this down. I'll do it in the calculator. So so I start with the exponents, right? There's sort of an order of operations things going here, and we start with this exponent, which is inside the bracket. So 1.06 to the power of 10. Then we want to go 1 divided by that number. Well, we have actually a 1 divided by that number button in our financial calculator. So I go 1 over x. So now what's inside this bracket is, in here is 0.558. I'm going to just keep it in my calculator. So I go 1 minus that number. The way I do this is I just go that number minus 1, and then I hit the plus minus button. So 1 minus that number is 0.441. And then I divide by 0.06, divide by 0.06, and I get 7.36. So this big bracket is 7.3600. So I take 150,000 times, and then again, the value of that bracket when you break it all out is 7.36. So 150,000 times 7.36 is 1104013. 1104013. And okay, so we've kind of solved it. 1104013. So compute the present value to determine if this is a worthwhile investment. It costs us $1 million to generate $150,000 annually of positive cash flow from our cash savings on the electrification of our cars. We're saving $1.1 million. So we're spending $1 million today to save us the present value of $1.1 million. Is it worthwhile? The answer is yes, right? Overall, we are 104,013 better off if we switch the fleet to electric. Now, of course, there could be a million little things we're not considering here, but just based on these projections, we should do it. And actually, you see lots of taxi cab companies have done that just because it does may save them. They likely did similar math. In any event, there we are. We're $104,000 better off if we go electric. So we've solved it. So we've done it the formula way. I'll show you how to do it within our calculator. And this isn't too complicated if you've been using your calculator all along. If you don't have a calculator, say goodbye. Goodbye, everybody. But if you do have a calculator, this is probably the way to do it. Once you get into PV of an annuity, a lot of the lump sum present values, I would just do them by hand. I think it's quicker. PV of an annuity is the one where I go, I think I'd rather just crunch the numbers within the calculator. Things can go wrong with the math we just did. So in your calculator, make sure you've cleared your memory. Second function, clear TVM, clear time value of money. Second function, clear work. I don't know what that does, but I always hit it just in case. And then let's sort of figure out what we got. N, we have N, that's the number of periods, and the number of periods here is 10. It's a 10-year life of the car. IY is our discount rate, which is 6. We enter 6 as IY. PV, we don't know. That's what we're going to be solving for. Or do we know our PV? Well, no, we don't know our PV. We know our payment is $150,000 flowing to us, 150,000 PMT. It didn't happen at the beginning of a period. We'll look at those. Those are called annuities due. And FV is 0. These things go down to 0. So I'm going to compute the present value of those payments, essentially. So I go compute PV, and I get 1104013. Well, look at that, 1104013. It's the exact same answer. Let me put them beside each other, and there we have it. So the value of this is 1104013. If I have to pay $1 million to get $1.1 million in value, I should do it. We've solved this using both the formula as well as our financial calculators. Thanks for watching. As always, thanks for sticking with me. Have a great day, everybody. I'll see you in the next video. Bye-bye. Let's have a look at problem 311A. This problem has us calculating payments based on APR, that interest rate that we don't love so much in corporate finance class. So you decide to buy a new car. The car's cost is $50,000 and you pay $10,000 today, meaning you're going to have to borrow $40,000. Financing the rest with a car loan. So you're borrowing $40,000. The terms of the loan, 4.5% APR for 60 months, and interest is compounded monthly on this loan. First question is, what are the monthly payments? We're going to need to use PV of an annuity to solve that. And the second is, what's the effective annual rate of the loan? Okay, let's figure out the payments. So the first thing we say is, okay, APR is simply the interest rate per period times by the number of periods in a year. So if the interest is compounded monthly, this 4.5% is actually, we just divide by 12 to figure out the monthly rate of interest. So 4.5% divided by 12, 4.5 divided by 12 is 0.375% interest per month. That's our true interest rate. It's really 0.375% per month. It's not really 4.5% per year, as we'll show with our effective annual rate when we at last calculate that. Okay, so we need to figure out the payment. Now, we'll use the present value of an annuity formula. I'll also use the financial calculator, solve this in a few minutes, but let's do it with the formula. I think the formula is a good way to do it. So we know the present value of this loan. We borrowed $40,000 today. What we don't know is our monthly payment, and this C is your cash payment. So we're solving for C, but we have everything else. Times 1 minus 1 over 1 plus our rate of interest, monthly rate of interest, 0.375%, which translates to 0.00375 as a decimal, raised to the power of t, which is the number of months, 60 months, all divided by 0.00375. Let me zoom in on this. I think I'm getting a little far away. Okay. So we start with what's in the brackets inside, 1.00375 to the power of 60, 1.00375, y to the x, 60, is 1.25. Now I go 1 divided by that number, so I just go 1 over x in my calculator. I get 0.79, 1 minus 0.79, it's going to be like 0.2 roughly. The way I do this is I go minus 1, and then I hit the plus minus button, so it's 0.201. I divide by 0.00375, divided by 0.00375, and I get 53.64. That's the number in the big brackets. So I have C times 53.64 equals $40,000. I just have to divide 40,000 by 53 and I get the answer. So again, having the number in my calculator so I don't round, I just go 1 over X times 40000 and I get $745.72. C equals 745.72. It asked me what the monthly payment is. That's my monthly payment. Monthly payment, I put an S. Okay, so there we have it. We have calculated the monthly payment. I'll just show you quickly what this looks like in the financial calculator for you financial calculator havers. So again, second function, clear out any time value money information that's in there. We know our N is 60. That's the number of periods. I put 60 for my N. I know my interest rate is... Okay, this one's tricky. It's 0.375%. So I put in 0.375, not 0.00375. I put in 0.375, the actual percentage. My PV is 40,000 positive PV because I'm getting a $40,000 loan. I don't know my payment. My future value is going to be 0, so I can put in 0. You don't have to. I have to compute the PMT, and there it is, 745.72, and that's exactly what we had, 745.72. So the calculator gets us the same place a little bit more quickly with these present value of an annuity. But, you know, if I was told I had to do it by formula, no problem. If I was told I had to do it with a calculator, no problem. I don't use the tables, but the tables are also no problem. Okay, what's the effective annual rate of this loan? This should be very straightforward. If it's 0.375 per month, you add 1 to that. You go 1.00375. And now with APR, you just multiply that by 12. With effective annual rate, you compound it. So you compound it 12 times, you raise it to the power of 12. 1.00375 to the power of 12 is 1.0459, which converts to you just take away the 4.59%. So as a finance person, we think 4.59% is a more accurate number to be quoting than 4.5%. But there we have it. We've solved 311A. If this video helped, it always is kind of you if you can help me too. Give a thumbs up or a sub. Thanks again for watching. Have a great day. Bye-bye. Let's examine problem 313A. It's a perpetuity question. The good news is the math of perpetuities is less complicated than much of the math we've been doing. The present value of a perpetuity is the cash flow, the recurring cash flow, divided by the discount rate. That's it. So comparing it to an annuity formula, fairly simple. Let's jump into the question. You want to start a scholarship that will award the winning student with $2,000 each year. The scholarship will be awarded to a new student every year in perpetuity. The first scholarship will be awarded 1 year from now, and the discount rate is 7%. How much do you need to donate today to fund the scholarship? Okay, so it's 2,000 divided by 0.07, 2,000 divided by 0.07, it's 28,571. 28,571. That's how much you would have to donate today. And the idea here is if you donate exactly 28,571 and it grows by 7%, well, let's do some math. 28,571 times 0.07. Look at that. You get $2,000. So you can just let the money grow by $2,000, then skim the $2,000 off the top to pay the scholarship, and then you're back to 28,571, and it's going to grow another $2,000. And the idea is you can just do this in perpetuity. So that's what makes a perpetuity a perpetuity. Not that you'd ever want to do this, but to enter a perpetuity into a financial calculator, again, the formula is so simple, but I know some folks will come to rely on their financial calculators. Here's how you do it. You just go 2,000 as your PMT, your recurring payment. You go 7 as your IY. you go, no, this is the tricky part. N is forever. So I just put like a billion, a billion years from now is your N. And then you compute PV, 28571. You can see 28571. It's the same answer. So just wanted to show that, you could do this in a financial calculator. You just put a billion as the time frame and it works out to the same. Okay, suppose you wanted the scholarship to commence 5 years from today. The first payout to be 5 years from today. It means you've got a discount. So it's the same formula. So, okay, let me read the question. Suppose you wish for the scholarship to commence 5 years from today. How much would you need to donate today to fund the scholarship? So remember, we need $28,571 at the beginning of this year. So we pay it out at the end of the year because it's going to grow by 2,000, and that's what makes this a perpetuity. So we actually need this $28,571 to be in place 4 years from now in order to start paying out the perpetuity 5 years from now. So I need $28,571 4 years from now. How much money do I need to put away today that's going to grow at 7% to get to $28,571 4 years from now? That's the question. And here's the math. You go 28,571 divided by 1.07 to the fourth, right? It's just a present value of a lump sum. So it's, this formula, right? PV times 1 plus R to the T equals FV. Well, we know our FV. We want 28,571 to be in place 4 years from now, not 5, because again, it's got to grow by 2,000 to pay the scholarship at the end of the year. Okay, so in this circumstance, we know our FV is 28,571. We know 1 plus R to the T is 1.07 to the fourth, and we don't know our PV. That's how much we got to put away today. So that's how we sort of rearrange to get to here. 1.07 to the power of 4 is 1.31. I'm going to go 1 over X times 28571 to do the math there. Oh, no, I messed up. 1.07 to the 4, 1 over X times 28571. I wonder what I clicked wrong in my calculator there. There we go, 21,797. So I need to put away 21,797 today. It's going to grow in some, investment account for 4 years. At the start of year 5, I'll have 28,571 put away. It'll grow by $2,000. We'll trim the $2,000 off the top, pay our first student, and do that in perpetuity. There we have it. We've solved 313A. As always, I hope these videos are helping, and if they're helping you, I hope you'll consider helping me by hitting one of those 2 buttons. Thanks for watching. Have a great day. Bye for now. In this video, we're going to work on a problem you can download from tonybell.com. Go to the website, click the PDF link, and you'll notice there's no sign in, no sign up. The PDF just pops right up. You'll scroll down and find whatever problem it is that we're working on. As you scroll through the problems, you'll notice many are free and open, like the one you're watching now, but some are members only. I think the free and open ones are enough for most people, but if you can't get enough of me and you'd like to join and get access to those members only videos, click the join button underneath the YouTube play box. All right, thanks so much for watching. Let's get started. Let's run through problem 315A, now a future value of an annuity. I think you're going to find the math here is easier. It's easier to use your calculator. It's easier to do the formula. I wouldn't want to memorize that formula, so hopefully you're given a formula sheet, or hopefully you're given a financial calculator. In this video, we'll solve it both ways, with the formula as well as with the financial calculator. Starting at the end of this year, you intend to make yearly contributions of $3,000 to your retirement savings. The account earns 10% interest compounded annually. Calculate the value of the retirement account in 25 years. So you're doing $3,000 a year, earning 10% on your money for the period of 25 years. What's that going to be worth when you're ready to retire? Okay, so future value annuity equals C, the cash flow. The regular cash flow here is 3,000. We're solving for the FV. outside of 1 plus R is a required rate of return, so 1.1, right? 1 plus 10% is 1.1 to the power of T, 25 years of compounding is going to happen here, minus 1, all divided by R, which again is 0.1. It's 10%. Okay, there it is. So this isn't bad in a calculator. 1.1 to the power of 25. 10.83, we subtract 1, minus 1, we divide by 0.1, and then that number we multiply by 3,000. 295,041. Okay, that's the answer, 295,041. So if we're putting $3,000 a year away for 25 years and we're earning 10% on our money, do the math. 3,000 times 25. What is 3 times 25? It's only $75,000 cash we're putting away, but because the money grows and, compound interest, we'll have, even though we've only put away $75,000 cash, we'll have $295,000 at the end of 25 years. Showing this in our financial calculator as promised, our N is 25, so I just put 20. Actually, let me just make sure I've cleared everything. Second function, clear TVM. 25 is our N. Our IY is our required rate of return. Our interest rate, I put 8, but it's 10. 10 IY. PV is 0. We have no money today. Our PMT is our regular cash flow of 3,000. And I'm going to put that in as negative. 3,000 PMT because we're cash outflow. And when we compute FV, it'll be positive. If we put the PMT as positive, the FV would be negative. But there it is, 295,041. And you can see that matches up with what we just calculated, 295,041. Okay, so we've solved part A. Let's solve part B. If you made the first deposit today rather than the end of the year, how valuable would your retirement account be in 25 years? Kind of an interesting puzzle. This is a future value. They call it an annuity due. It just means you started early, essentially. You paid at the beginning, not the end of the year. And all it means is you get 1 extra year of compound growth. And 1 extra year of compound growth is actually easy to do calculation-wise. You just take this number and you go, let's pretend I got an extra year. You multiply it by 1 plus the interest rate, 1 plus the rate of return here. So 1.1. You just go, okay, pretend it grew by an additional 10% because every year I'm a year ahead, right? I'm depositing at the beginning, not the end of the year. So I'm getting 1 more year out of every single one of my payments. And so I just grow the lump sum by 1 year's worth of growth. 295,041 times 1.1, 324,545. So if you start making payments at the beginning of the year rather than at the end, it grows by 1 year more. So that's the answer to B. How would I do this in a financial calculator? I would switch on to the begin mode. You can see it's there as a second function. So it's a bit of a pain to get into begin mode and to get out of it. So I'll show you how. You go second function, begin. Now it says end. It says set. I go second function, set. And now I'm in begin mode. And you can see the begin there. I clear out. All my previous calculations are in here. So I'm just going to have it compute the future value, as that's what we were solving for. I compute FV, and you can see the number does indeed match up, right? So it's, all the same numbers. You put in the same N, the same IY, the same PV, everything, same PMT, and you end up with the correct answer, 324,545. Now, I want to get out of this mode because it's annoying, so I go second function, begin. And then I have to go second function set. I always forget and then clear out. There we are. We're back to normal. Okay, we've solved 315A. It would be great if you'd go back to normal by hitting the button as you always do. Thanks a lot for watching. I genuinely appreciate that you're here, and I'm lucky that you're watching, so I do appreciate it. All right, thanks a lot. Have a great day. I'll see you in our next video. Bye-bye. Let's take a look at problem 316, a present value of an annuity problem. You can see I've got the formula ready to go. We'll solve it first with a formula, then we'll solve it with our fancy financial calculator. But before we can do any solving, let's do some reading. You won a $50 million lump sum lottery prize. Wouldn't that be nice? Knowing that you're not good with money and are likely to waste it, you decide to buy an annuity, which will pay $100,000 per year for the next 40 years, starting 1 year from now. Your logic is that even if you blow the rest of the money, having a guaranteed $100,000 per year would be sensible. The current interest rate is 4% annually. So it says, how much money do you need to deposit into an annuity today in order to meet your $100,000 per year for the next 40 years? And this is a very straightforward annuity problem. So we see the formula there. We'll start by solving with the formula, then use our financial calculator. We see the formula. Present value of an annuity equals the recurring cash flow, which in this case is $100,000, times, and then this big bracketed ugly mathematical thing, 1 minus 1 over 1 plus the required rate of return, or the interest rate in this case, 4%, so 1.04 to the power of t. How many years? 40 years, so 1.04 to the 40th power, all divided by the rate of interest, or required rate of return. There we are. So that's what we're calculating. PV equals 100,000 times that big messy bracket. Okay, let's deal with the bracket. So we deal with our exponent first, 1.04 to the power of 40, 4.8. Okay, 1 divided by 4.8, I use this 1 over x button, I get 0.2. 1 minus 0.2, it's going to be 0.8, well, 0.792 or 793. So I do minus 1 equals, and then I hit the plus minus button. There it is. So now I've got the numerator complete. I divide by 0.04. And now I've resolved the entire piece of the brackets. 19.79 is the annuity factor here, 19.793. So I'm going to go 100,000 times 19.793, and that's going to give me my answer. So I just multiply that number by 100K. And I get 1.979277. So I won $50 million. Congratulations to me. If I want to lock in $100,000 a year for the next 40 years, basically the rest of my life, that's how much money I need to set aside right now. So that is the PV of the annuity. We've answered the question. So if that's all you need, great. If you want to see it done in the calculator, stay tuned. Here we go. Let's put it in the calculator. So I'll just start with the N. It's 40 years, so 40 goes in as my N. My IY, 4% annual interest, so I put 4 in as my IY. My PV is what we are solving for. My PMT is how much we're going to be receiving on a regular basis. $100,000 is the PMT, and the future value will be 0. We're dripping this thing down to 0. So let's compute the present value, and you can see there negative 1979277, and that does indeed match with what we had figured, 1979277. Okay, we've solved the problem 2 ways. I hope the video helped, and if it did, I hope you'll give me a thumbs up. All right, thank you so much for watching. See you in the next video. Bye-bye. Let's have a look at problem 317A. It's called an annuity due. So an annuity, you make a payment at the end of each period for a certain number of years, and we calculate the present value of those payments using this formula. For an annuity due, it's the exact same thing as the present value of an annuity, except for you don't pay at the end of the period, you pay at the start of the period. And as a consequence, you get 1 more year of interest accruing on this because you're paying at the start of the period. So you get 1 more period of interest accruing. So it's a simple matter of multiplying whatever the result there was by 1 plus the discount rate or the interest rate. And that's it. You're just sort of adding an extra year's worth of interest because you're contributing the money a year early. So in any event, that's sort of the only difference between PV of an annuity and an annuity due. Annuity due. So let's solve. Your company finances a new piece of equipment with a price of $250,000. The contract calls for monthly payments for the next 48 months, starting today. It's an annuity due. The interest rate is 11.5% APR. Calculate the monthly payment. Okay, so we're quoted an APR interest rate. So we've actually got a bit of work to do there. And we're solving here for C, right? We're solving here for the payment amount. So let's start by figuring out the interest rate on a monthly basis, because again, we're looking at this thing monthly payments. So we want to figure out the C per month, right? The payment, the cash flow per month. So it's an 11.5% annualized rate, APR. To figure out the monthly, you actually just, it's very simple with APR. You just divide by 12. So 0.115 divided by 12 equals, this is a little bit awkward for our calculator, 0.0095833, right? So it's 0.95% or 0.96%. We'll leave it as 0.0095833 because that's what's going to go into our calculator. Okay, so let's punch in the numbers we know. We actually know the value of the annuity. It's got to be $250,000. It's the price of the equipment. So 250, maybe I'll write this underneath. 250 is our PV of our annuity equals C, that's what we're solving for, times, and then big awkward brackets. We'll deal with that in a second. So times 1 minus 1 over 1 plus R, which is this 0.0095833. So 1.0095833 to the power of T, 48 payments, 48 months, so to the power of 48. And we divide that by 0.0095833. Take as many decimal places as you reasonably can. And then we're going to multiply that by 1.0095833. Okay, there we have it. We've got the formula now. It's just a matter of like working with our calculator. So I'm going to add 1 here. Oops, I right clicked. Add 1 to get 1.0095833. I'm going to raise that to the power of 48, to the 48th power, y to the x, 48. So now I got this exponent dealt with. I go 1 over x, so 1 divided by that amount is 0.63. 1 minus that amount, so minus 1 plus minus, so 1 minus 0.63 is 0.36. Divide by that magic number, divide by 0.009583333. I get 38.33. So what's in the brackets is 38.33. I'm going to multiply that by 1.0095833. So let's do that now, times 1.009583333. I get 38.69765. So I have, let me just fill this rest of this out. C times that equals 250. Let's continue to work this down. 250 equals C times 38.69765. 38.698, we'll call it. So then 250 divided by 38 is going to be our answer. So I just go 1 over x times 250, and that gets us the same result. 6460.34. C equals 6460.34. We've solved it. So it's, what's the monthly payment on this new piece of equipment? It's $6,460.34 per month. Well done. We've solved the problem. Let's crunch those numbers in our financial calculator. So N is 48. So put in 48 as N. IY is going to be this 0.0095833, but remember we put in the percentage, so if it was 8%, I don't put 0.08 in my calculator, I would just put the number 8. So here it's actually 0.958333%. That's the number that goes into my calculator. I got to be careful there. It can be a little confusing, but that's the number that needs to go in. 0.9583333. That's my IY. My PV, we actually know, is 250,000 positive PV. We don't know our payment. Our FV is going to be 0. And now we're going to compute a payment. So, I almost did it. I'm clearing. I forgot to put on begin. Of course, this is an annuity due. That's a key step here, right? Because otherwise we would have just been computing this without this little feature on the end. So I have to tell my calculator this is an annuity due. So to get it to do that, I go second function begin. I go second function set, and then I clear. So I think all my numbers are still in there. I'm going to compute PMT, that's what we're looking for. And there it is. I got the right number, right? 6460.34. I'm feeling pretty good about myself. I hope you're feeling pretty good about yourself. When you leave a problem like this, make sure you switch the begin back off. So I go second function begin, second function set, clear. Right now, my calculator is back to normal, but you saw we did it in the financial calculator. We've also done it by hand. We've solved 317A. As always, hope the video helped. Bye for now. Let's take a look at problem 324A. We're running through a loan amortization schedule. So let's read the question. We'll see what we're up against. And I think these ones aren't too hard. And in fact, if you've ever had a loan, you may have seen one of these before. You borrow $100,000 on a 10-year loan. The loan has 9% annual interest rate and requires you to make equal annual payments. I know that they don't tell you how much those equal annual payments are. So for us to do a schedule, we got to figure out how much the payment is. And in fact, before we can do a schedule, we got to figure out what that payment is. So we're going to solve for the payment. If we look at our PV of an annuity formula, we're solving for this, the regular cash flow. I'll solve it first in the financial calculator, then we'll do it by hand, and then we'll prepare our loan amortization table. So let's go through it. What am I going to input into my calculator? Well, let's start with the N. Number of periods is 10. There's 10 years. It's annual interest. So 10 periods, 10 payments. What's next? I/Y, the discount rate. The discount rate here is 9%. PV, well, what is the value today? We're borrowing. We're getting 100,000. Let's put in a positive 100,000 as the PV. The next one is PMT. That's what we're solving for. And the last one is FV, and that's going to be 0 because we're paying off this loan over the 10-year period. Okay, so let's solve. 10 goes in as N, 9 goes in as IY, 100,000 positive goes in as PV, 0 goes in as FV, and I'm going to compute PMT. I get PMT of 15,582.00. Well, I guess 0.01. I'm just going to leave it 15,582. Okay. So let's do that in the PV of an annuity. If you want, you can skip ahead like a minute, if you are satisfied with 15,582, but we'll do the math here. So PV is 100,000. We know this is 100,000 equals, we're solving for C, times 1 minus 1 over 1.09, 1 plus r, to the t to the power of 10, all divided by r, which is 0.09. Okay, let's solve. 1.09 to the 10th power. I go 1 over that number, so 1 over x. I go 1 minus that number, so I do minus 1. Hit the plus minus, 0.5775 divided by 0.09. And now my brackets, the total amount of what's in brackets is 6.42, say. So it's 100,000 equals C times 6.42. Solving for C, C equals 100,000 over 6.42. And I'll just take this number, which is, no rounding here. I hit 1 over x times 100,000. And that gets me the answer of 15,582. C equals 15,582. And look at that. That was our payment from before. Okay, so we've solved for the payment, but that isn't answering the question. That question said, give me an amortization schedule for the loan. Here's how we do it. We start with a beginning amount, beginning value, I suppose, would be one way of putting it. And the beginning value of our loan is $100,000. This is year one. How much are we paying? Well, we make a payment of $15,582. How much is interest of our payment? And the interest is 9% times the beginning value. So the interest here in year one, we have a loan that's $100,000 times 0.09, 9,000. So if I make a $15,000 payment, $9,000 goes to interest. How much goes to actually reduce the loan? We call this the principal. You could call it principal reduction, I suppose, but it's $6,500, $6,582, and it's just 15 minus 9 is 6. So what's the ending value of the loan then, or the ending balance? After we made the payment, the value or the balance left on the loan, $100,000 minus what we paid down, $6,582. Remember, the $15,000, bunch of it went to interest. Only $6,000 went to pay down the loan. We're at $93,418. Okay, that's year one. We're asked to do 3 years. Now, there are 10 years, but we're just going to do years 2 and 3. We start year 2 with what we ended year 1 with, $93,418. We make another payment. The payment's always the same, $15,582. Our interest is 9% of the beginning value, 9% of $93,000 this time, so times 0.09. It's 840, I'll call it 8408. 93,418 minus 8408. Or sorry, no. I'm saying the wrong thing here. $15,000 payment, $8,000 was interest. How much was principal? 15,582 minus 8408 is 7174. I had a loan that started at $93,000. I paid $15,000, but $8,000 was interest. The other $7,000 paid down the loan. What is my new loan balance? I'll take 7174 minus 93,418. Hit the plus minus. It's 86,000. So it's just 93 minus 7 is 86. 86,244. Okay, last one. Start with 86,244. I make a $15,582 payment. How much of that went to interest? Well, 86,244 times 9% is 7762. And the principal then, if it's $15,000 repayment, $7,700 is interest, almost half. It's basically almost right on the nose, half. 15,582 payment minus 7762 means 7820 went to pay down the principal. So I had an $86,000 loan. I paid off $7,800 of principal. 86,244 means if I take 86 minus 7, I end up at 78,424. 78,424. And we could keep going. And in fact, I did this in Excel previously as I was setting it up. And you can see Excel, I went to the penny, but let's just sort of compare notes here. So a couple of things happen as you look at this. The first is we matched, right? 93,418, 93,418, 86,244, 86,244, 360, 78,424. Yes, right. We got it right. So congratulations to us. We've solved the problem. Thumbs up. The only other thing I wanted to call your attention to is when you look at one of these long ones, like if you have a 30-year mortgage or something like this, I look at these things and it kind of makes me want to puke. And what makes me want to puke is when I look at the total payments, 15 times 10 is 155. $820.10. So $155,000. Remember, we borrowed $100,000. 9% interest is not insane interest. We make $155,000 in payments to pay back $100,000. We paid $55,000 of interest. That's like a year's salary and like a pretty good salary. And that's not even a ton of money that we borrowed, $100,000. So you borrow $100,000 for 10 years, you're giving up a year's salary to do it. Whenever I see those numbers, I always total up the interest. And I always think, ugh, it's good not to get into debt if you can avoid it, right? These very long-term debts just sap away at people's cash flow. So I know this is a finance class, there's a lot of lending and borrowing going on, but on a personal level, whenever I look at one of these tables, I always get uncomfortable. I think that's what makes me an accountant and not a great corporate finance professor. So I know I'm teaching finance material, but know this, I'm an accountant and I'm very financially conservative in my own life because I look at tables like this and they make me very uncomfortable. Anyway, hopefully this problem didn't make you uncomfortable, and hopefully you're comfortable hitting one of those buttons. I'm just pointing at the air right now, but I think on the screen I'm pointing at the buttons. Thanks for watching. I'll see you in the next video. Bye-bye. Welcome to Module 4, a module on bonds. So bonds are a very common financial instrument, and they will be in every corporate finance course. And the reason is, well, one, they're important to finance, but two, the reason you'll learn about them fairly early in your finance course is because the cash flows related to bonds are very predictable. And we know the value of pretty much anything, value of a bond, is the present value of the future cash flows. And so we have lots of work we can do with bond calculations. And the best way to learn, I think, anything in finance, anything with numbers, is to do examples. So I've prepared a fairly straightforward example of a bond, and we'll just talk about the cash flows, and then we'll solve this example. And I think it'll be illustrative of a lot of other examples that we'll do in my video series here, but also in your class. I imagine this will relatively match up with what you're learning. There might be some differences in jargon and lingo, but you'll see the calculations will be fairly similar. I'm thinking of buying a 2-year $1,000 bond. Now, most bonds will be of longer length than this that you'll be tackling in your class, but 2 years makes it easy to explain. $1,000 bond with a coupon rate of 4% and a yield to maturity of 5%. The bond makes semi-annual payments. How much will I pay today? What's the price of the bond? Okay, so present value of future cash flows, and we got to think, what are the cash flows related to the bond? And maybe a big step back, what is a bond? A bond is an investor is loaning money to a company or to a government, and they want to get paid back with interest. That's essentially it. It's a loan between the investor and the organization. So you're the investor, you're giving somebody $1,000, or you're thinking of giving somebody $1,000 today, and they're going to pay you back with interest. But the cash flows related to the bond are kind of funny. They're almost always semi-annual. So semi-annual means every 6 months. And so you loan them the $1,000. They don't let the interest clock tick for the 2 years and then pay you back everything. Every 6 months they go, how much interest is ticked up? Here's your interest. 6 months more. How much interest is ticked up? Here's your interest. And they write you a check every 6 months. So that's part of the return on a bond. And that makes bond math a little complicated because we don't just give them a bunch of money at the start and they give us a bunch of money at the end. We give them a bunch of money at the start. Then every 6 months they give us a little bit of money. And at the end, they pay us back the $1,000, and they give us a little interest at the end too. So there's multiple cash flow streams, and so it's a perfect finance problem. It really is. It's all the time value of money stuff we learned last chapter just comes into play for this very real financial instrument. So I find this stuff is helpful to draw a timeline or a number line here. So we've got 2 years, right? This bond is a 2-year bond. So we got time 0. That's the day we lend them the money or write the check, buy the bond, essentially. We got year 1 and we got year 2. But we need to remember, because bonds, everything's semi-annual, we're actually interested in semi-annual periods. So we got time 0. And in terms of semi-annual periods, every half year is a period. Time 1, time 2, time 3, and time 4. Because again, we're not interested in 1 year at a time. We're actually interested in everything's 6 months at a time. So let's do some quick math. We're trying to figure out how much to pay for this bond. And the question is, how much should we give up? And it's based on what we are going to get over time. So let's figure out what we get. Well, we get payment at time 1. Let's see, it's $1,000 times 4%. That's a $40 payment, but that would be if it was annual. We're getting it every 6 months, so it's $20 every 6 months. So we get a $20 payment 6 months from now, a $20 payment a year from now, a $20 payment 18 months from now, a year and a half from now, and a $20 payment 2 years from now. But you can see, if I spend $1,000 and I get $20, $40, $60, $80 back, that's nothing. I got to get my $1,000 back, and we do get our $1,000 back at the end. Now, how do I discount the cash flows? And that's where, so we use the coupon rate to figure out the payment amounts. We use the yield to maturity to figure out the discount rate, to say, okay, well, it's $20 6 months from now. How much is that worth today? And again, it's 5%. That's an annual interest rate. We got to divide it by 2. So it's 2.5% per 6 month period, per 6 months. So I got to discount this $20. So how do I discount it? I go 20 divided by, actually, let me just go, divided by 1.025 to the power of 1, right? 1 plus the discount rate to the first power. This one's going to be divided by 1.025 to the 2 squared, because it's 2 periods. I got a cough. There we go. Just had to clear my throat. 1.025 to the third power, and this one and again, these are all divided by 1.025 to the fourth power, right? But of course, you and I know this is just present value of an annuity, and so that's what we will do. We'll say, okay, what's that annuity of $20 cash flows? The $1,000 is a lump sum, and we'll divide 1,000 by 1.025 to the power of 4 to figure out what $1,000 is worth 2 years from now, 4 compounding periods from now. So those are the cash flows, and we just have to take the present value of those cash flows. That's how bonds work. Now, again, you can imagine if this was a 10-year bond, not a 2-year bond, this number line would go on forever, and you'd be like, this doesn't make sense to do it this way. So the way to do it is either with a financial calculator or by formulas. Let's do it first by formulas. So here's a formula for present value of an annuity. That's the $20 every 6 month piece, and present value of a lump sum, that's the $1,000 at the end. Let's do the lump sum first. So we said it's a $1,000 lump sum divided by 1 plus R, which is our yield to maturity rate, 5% per year, divided by 2, because again, everything with a bond is semi-annual, so 1 plus 0.025 raised to the power of the number of periods. Now it's 2 years, but that's 4 semi-annual compounding periods. So that's the math. Let me do it. Where's my calculator? There you are. You were hiding away. 1.025. So that's the denominator raised to the power of 4, y to the x 4. So it's 1.1. Now to do the math here, you can write the number down. So I can go 1,000 divided by 1.1038. But I like keeping it all in my calculator. So what you do here is you go 1 over x, and I get 0.9, and then you multiply by 1,000. You'll get the same answer. It's just a way to keep all the numbers in your calculator. So I get 905.95 as my present value of the 1,000. So again, I loan them 1,000. They're paying me $20 interest every 6 months for 2 years, and then they'll pay me back the 1,000. So what's the 1,000 worth in 2 years? It's worth $905. What's the $20 payment worth? Well, that's the PV of an annuity. It's a $20 payment. The C is the payment. equals, now this is an awkward formula, 1 minus 1 over, some brilliant mathematician came up with this, 1 plus r, so 1.025 to the t to the power of 4, all divided by r, 0.025. Okay, so I'm going to just figure out what's in the brackets here. So I go 1.025 raised to the power of 4, y to the x 4. So it's 1.1. That's a familiar number. It's down there. Then I go 1 over that. So 1 over x, I get 0.9. Then I go 1 minus that. So I put this in as a negative number, plus 1. So now my numerator is 0.094. I'm going to divide by 0.025. So again, this number on top, once I sort of resolve all of that, I'm at 0.094, etc. 0.094 divided by 0.025. Again, I'm keeping everything in my calculator, so I don't want to round. I get 3.76, and then I multiply that by 20 times 20. So it's worth 75.24. And by the way, these numbers are both passing my sniff test. Does this stink? I've said the present value of 20, 40, 60, 80, $80 worth of payments. If I discount it, it's not that long of a period. It's worth $75 in today's dollars. And that sort of smells right to me. If you get some number like 200, you go, there's no way, right? Or if you get a number like 12, there's no way. So sometimes you get weird numbers. So let's add these together. My present value of the $20 cash flows, again, from this bond is $75. The present value of the lump sum coming from the bond is $905. 75 plus, where's my mouse? 905.95 is 981.19. 981.19. So what should I be willing to pay for this bond? This bond is worth $981 in today's dollars. Okay, so obviously, and I've mentioned this a few times, we did it by hand, and I would be much quicker if I wasn't explaining it as I went, right? I could just punch in the numbers. It would take me a couple of minutes. It is much faster, though, if I am able to use a financial calculator. So let's just sort of think of what goes into our financial calculator. So my N is the number of periods, of course, 4. My I/Y is the R, right? It's our 2.5%. It's our yield to maturity, again, semi-annual, so divide by 2. My PMT is, my PV is actually what we're going to solve for. We won't say PV negative 1,000. We're just going to say PV what we solve for. So our PV here is question mark. Our PMT is, what was it, $20. Our FV is $1,000. And now how much would we give up today? Well, that's our PV. So let's punch these all in. 4 goes in as N. 2.5 goes in as IY. PV, we don't know. PMT is 20. And again, there's money coming to us. $1,000 is our future value. We compute PV, and I get 981.19. So how much is this bond worth? It's worth $981.19. Okay, there we have it. We've solved for our bond. Bonds are pretty straightforward, but it's mathy, right? It's present value of a lump sum combined with present value of an annuity, and they'll often say, okay, well, this is the information we don't know. We'll solve for this, or we'll solve for that. And it's just a matter of working our way around that math. We'll do tons more examples this chapter. Thanks for watching. See you in the next video. Bye-bye. In this video, we're going to work on a problem you can download from tonybell.com. Go to the website, click the PDF link, and you'll notice there's no sign in, no sign up. The PDF just pops right up. You'll scroll down and find whatever problem it is that we're working on. As you scroll through the problems, you'll notice many are free and open, like the one you're watching now, but some are members only. I think the free and open ones are enough for most people, but if you can't get enough of me and you'd like to join and get access to those members only videos, click the join button underneath the YouTube play box. All right, thanks so much for watching. Let's get started. Let's run through problem 4.1a. I'll read through the question and we'll kind of discuss it as we go. You're considering buying a 10-year $1,000 bond with a coupon rate of 9% and semi-annual coupons. So 10 years, semi-annual coupons means there's 20 payments, right? 20 interest payments. Its yield to maturity is 8%. So big picture, when you're contemplating a bond, you have two cash flows to track. One, these 20 semi-annual payments, which is an annuity. So with a bond, we take the present value of an annuity and it's just those 20. Every 6 months, there's interest to be paid back. And then at the end of it, the borrower, the person you buy the bond from, has to pay you back the $1,000. It's a loan. You're loaning them $1,000 and they're making interest payments along the way. And so that's the second piece of this. There's the present value of that $1,000, or however much you'll loan them up front. So we'll solve at least a part of this problem by hand just to show you the math, and it can be done by hand very easily, but we'll focus in on our financial calculator as we solve the problem. So I'll solve it first with a financial calculator, then I'll solve maybe part A with just by hand to show you it can be done, but let's solve it with our financial calculator. Okay, you're considering buying a 10-year $1,000 bond, coupon rate 9%, semi-annual payment, semi-annual coupons. Its yield to maturity is 8%. Calculate the price of the bond today. Here's what we're going to input into our calculator. The N is 20, right? There's 20 semi-annual payments, 20 periods. Our IY is this yield to maturity, and the yield to maturity is 8%. But remember, when you're quoted interest rates, you're quoted for the year. We need to break that into 6 months. So for a 6-month period, that's half. It's 4%. Per semi-annual payment, right? Per 6-month period. Our PV is unknown. That's what we're solving for. Our payment amount is what we promise, and what we promise is the coupon rate. So it's a $1,000 bond. 9% coupon means it's a $90 payment. But the fact that it's semi-annual, this is $90 per year. Divide by 2 to get your payment, which is $45 per 6-month period. Our F fee is $1,000. That's what we get paid back at the end of this. So we're saying, what's the present value of those cash flows? 20 payments of $45. That's what this is summarizing. And $1,000 lump sum coming to us at the end of the bond. I smacked my microphone. I said coming to us and smacked my mic. Okay, let's solve it. Hopefully I'm still speaking into the mic. Yeah, my meters are still working. Okay, so let me just clear any information I have in my calculator. I hit 20 as my N, 4 as my IY, PV is unknown, PMT is 45 positive, this is cash flowing to us, 1,000 FV positive, this is cash flowing to us, and I compute the PV, and the answer is I got to pay $1067 to get those cash flows. That's the value of those cash flows today, 1,067.95. And this is not a surprise that it's more than $1,000. The reason is the coupon rate, 9%, is higher than the yield to maturity, 8%. It means our coupon is going to be attractive and people will pay a premium. This is a higher coupon rate than the risk level of the bond might dictate. People will pay a higher amount for it. There's a premium of $67 on this bond. And had the coupon rate been lower, there would be a discount. And I think that's the B version of this problem, shows a discount. Assuming no changes in interest rate, calculate the price of the bond in 5 years. So this is asking us, okay, everything else in the bond is equal, but just change the N. What is our new N? Well, 5 years, it's a 10-year bond. 5 years from now, there's 5 years left, which means there's 10 payments left, right? There's 2 payments a year. There's 5 years left. So our N is 10. everything else is equal. So again, nice feature of the financial calculator. All I do is put in 10 as N. Everything, I could re-input everything, right? Put the IY, but it's already in there. So now I compute PV and I get 1040.55. All right, the third scenario. So that's the answer, right? Assuming no changes, calculate the price of the bond. In 5 years, it's 1040.55. What about the price of the bond in 9 years? Okay, the price of the bond in 9 years. So in 9 years, how many periods are left on the bond? How many interest payments are left? And the answer is, well, I got 1 year left. So there's 2 payments a year, 2 payments. So N is 2 in that circumstance. So I put 2 in as my N and I compute PV. And I get 1009.43. Okay, there we have it. So we've solved A, B, and C. Part D says, explain the movement in the bond price. We expect bonds over time, as they get closer and closer to the maturity date. In other words, as they're, getting closer and closer to the day they have to pay back, the value gets closer and closer to the face value. Any discount or premium, as we have a premium here, shrinks, right? The premium was $67 today, $40 5 years from now, and $9 9 years from now. The premium's going to go down to zero because they're just going to pay me back $1,000 without a premium or without a discount. So we expect the movement of any bond to be closer and closer to the maturity value as the maturity date approaches. So again, closer and closer to $1,000 face value as the maturity date approaches. Okay, there we have it. We've solved 418. I will do a little chunk of this by hand, but if that's enough for you, that's enough for you. It'd be enough for me to hit one of those buttons. Hey, if you're going to stick around, why not hit one of those buttons anyway? It feels good to do it. It feels good. Make you feel good, make me feel good. Okay, let's do this by hand, though, and see how you're coping with doing it by hand. The present value of the annuity is the payment amount. We said the payment was $45. So C is cash flow, the regular cash flow, 45 times 1 minus 1 over 1 plus the interest rate. And this is the IY. This is the yield to maturity divided by 2. So 4%, 1.04 to the power of T, it's 20. Sorry, I'm redoing part A, just to be clear. I'm calculating the bond price. Oh my goodness. Oh, forgive the coughing attack. I will mute that in post. Okay, so we were just kind of coming up with our time period, and what we'd said was, well, we're doing part A, and so for part A, this is a 10-year bond, 20 payments, so our T is 20. I had like a real tickle in my throat there. We divide that by R, which is 0.04. And so there we have it. We have our payment, 45 times, and then what's in brackets. That's going to give the present value of those regular interest periods. What about the present value of the lump sum? Well, again, we're getting paid $1,000 back at the end of the bond. Divide by 1.04, 1 plus R to the T, 1.04 to the power of 20. Okay, let's crunch our numbers, and then I'll stop the video and cough away. 1.04 to the power of 20 is 2.19. 1 minus 2.19. No, 1 over 2.19. So I go 1 over x. Then I go 1 minus that answer. So minus 1, hit the plus minus, 0.54. Divide by 0.04. I get 13.59 times 45. 611.56 is the present value of the interest. Well, what about the $1,000 I get at the end of the bond? You go 1.04 to the power of 20. You divide 1,000 by that, so 1 over x times 1,000. And that's worth 456.39. Add these two together, you can hear a frog in my throat. 611.56 plus 456, let's do it. 611.56 plus 456.39. And we find the present value of our bond is 1067.95. And that's what we had done in our calculator. Now, we could very easily do this for 5 years and 10 years. All you would do if you want to do it for 5 years, you would change this exponent to 10 because that's the amount of time remaining on the bond. You would change this to 10. And if you wanted to do it for 9 years out, you would change the exponent to 2. And this exponent would become 2. And you could solve them all that way. And if you had to, you could. And it's not even that much slower. You could do this by hand reasonably quickly. But we did it with our calculator first, and we have solved the problem. All right. I got to remember to edit the coughing out of the video. Thanks so much for watching, as always, and I'll see you in the next video. Bye-bye. Let's take a look at problem 4.2a. We're playing around with interest rates and how they affect bond prices. Remember, the price of the bond is just the present value of all of the interest payments you're going to get. Typically, every 6 months, you get some interest payments. So we do PV of an annuity. I'm going to do this all in my financial calculator, but I always think of it in terms of these formulas. Maybe this helps you, maybe it doesn't, but that's how I think about it. And then at the end of the bond, you typically get your $1,000 back, or whatever it is you invested in the bond. You get the face value of the bond back. And so there's a present value of a lump sum coming back to you at the end of the period of the bond. So what we're going to do is we're going to look at a very short-term bond, well, a 5-year bond, and compare it to a 20-year bond and say, hey, if there's an interest rate fluctuation, how does it impact the bond? If the interest rates in the market increase by 1%, the Fed increases the interest rate, something like this. So the market rate of interest goes up by 1%. What does it do to our bond price? And the answer is the bond price goes down, right? When you can buy similar bonds at a higher interest rate, our bond becomes less attractive, less people want to buy it, and therefore our price will come down. So that's what we're expecting to see. But the question is, will it affect the 5-year bond or the 20-year bond more, right? Which bond has higher interest rate risk? I'm going to answer that question for you right now. If you have a short bond, the shorter one here, which is 5 years, which is 10 payments, compared to a bond, the long one, which has 40 interest payments, well, the market is going to react to this and say, well, we're getting, our interest payments aren't that attractive anymore. So I can have 10 unattractive payments or I can have 40 unattractive payments. The answer is the rates of interest in the economy going up is going to hurt the longer term bond value more. Okay. Maybe I'm overthinking this or overspeaking it at the start. Let's actually just solve the problem, and then it'll come out in the numbers. You're considering two nearly identical bonds, bond short and bond long. Both have par values of $1,000, and both are priced at par value of $1,000. So they're both priced at $1,000. They both have the same coupon rate, 10%. And since they're both par value, the yield to maturity is 10% also, because coupon rate, when it equals the yield to maturity, that's how bonds issue at par. There's no discount or premium to worry about. Both bonds pay interest semi-annually, so everything's the same about these bonds so far. The key difference is their time to maturity. Bond short is 5 years, bond long is 20. So we already know the price at 10%, right? When the yield to maturity is 10%, the bond prices, the PVs, are $1,000 for both short and long. What about when the interest rates go up to 11%? What is the price going to be? The price of these bonds is both going to come down a little bit because, again, the market rate of interest goes up. Our bonds that pay 10% interest, a coupon of 10%, aren't as attractive. We're going to have to take a discount on our bonds if that were the case. Let's figure out the price. So let's do short first. Number of periods. Well, these are 5-year bonds, so the number of periods or the number of payments is 10. Our IY was 10%. It's now 11%, but remember we divide by 2 for bonds, so 5.5%. PV is what we don't know. Our PMT, well, it's $1,000 bond times 10%. It's $100 a year, but again, remember bonds are all, well, in my class, all semi-annual, and that's pretty normal. The PMT is 50, and the FE is 1,000. Let's compute the price of this bond. So clear out. 10 goes in as N. 5.5 goes in as my IY. 50 goes in as my PMT. And 1,000 goes in as my FV. I will compute PV. I get 962.31. 962.31. Now, for the bond that has 40 interest payments left, having a weaker interest rate is going to hurt the value of this bond more. In other words, a longer term bond has higher interest rate risk. Let's see what the numbers look like for our long bond. Everything's the same except for the number of payments. 40. Our IY is 5.5, same as the other. Our present value, we don't know. Our payment's the same. Our FV is the same. So the only thing that changes here is the N. And in fact, I think I can just put in 40N and everything else stayed the same. So I don't have to mess with any of the other inputs here. And now I just compute PV. And I get 919.77. So the question asks, if the interest rates increase by 1%, so go from 10 to 11%, what will the change be in the price of bond short and bond long? So what is the change? So 1,000 minus 962, 1,000 minus 919.77. I'll do the 919 because it's already in my calculator. So 1,000 minus that is 80.23. Our price went down by 80.23, $80.23. And in this case, our price went down 1,000 minus 962.31. Our price went down by $37.69. State your answer in both dollar and percentage change. So percentage change, you just divide the change by the earlier number, the 1,000. So 37.69 divided by 1,000 is 0.03769, which is 3.769%. And this one, and again, this is a negative, so it went down by 3.769. And this one went down by 8.023. Oops, it's a little bit messy, 8.023%. So as we speculated, the longer term bond has higher interest rate risk, and that should make sense, right? If you are going to get 40 interest payments over a number of years, if interest rates fluctuate, that's risky for you holding the longer term bond. By the way, if interest rates in the market went down, what would you expect to happen? Well, short would start selling at a premium, long would sell at a much larger premium because, again, you're benefiting from having your locked-in interest rate that is now higher than the market rate of interest. So this is something to contemplate. If you think interest rates are going down, you should be buying bonds. If you think interest rates are going up, bonds are not as good of an investment. Anyway, that's sort of random thought. I'm not an investor. I'm an accountant, but that's just my gut feeling. Okay, we've solved the problem. Congratulations. You've made it to the end. You can stop here if you want. If you want to do it by hand, though, stay with me. We'll do one of these by hand. Let's do bond short at 11% by hand. Okay, so what are the details of bond short? The payment is $50 times 1 minus 1 over 1 plus that rate, 1.055, 5.5% to the T. It's 10 years, all divided by 0.055, 5.5%. Okay, so that's the present value of those payments, those regular interest payments. So 1.055 to the power of 10. 1 over x, 1 minus that number, so minus 1, hit the plus minus, and divide by 0.055, divide by 0.055. And I get 7.537 for what's in the brackets times 50, 376.88. Let's do the lump sum, the $1,000 we get at the end of 10 years, $1,000 divided by 1.055 to the power of 10. 1.055 to the power of 10. 1.708. And I go 1 over x times 1,000. 585.43. add them together, 585 plus 376. And I get 962.31, and that's exactly what we got from our financial calculator, 962.31. So you could do this both ways. It wouldn't be that complicated. The question's a bit of a jumble, but once you sort of figure out what it's talking about, the idea is longer-term bonds have higher interest rate risks, all else being equal. In the real world, it's rare that all else is equal, but in a finance question, we can make all else equal. So it's just the idea that interest rate risk is higher for longer term bonds. Hope this video helped, and I hope you give me a thumbs up. Bye-bye. Let's run through problem 4.3a, another problem on interest rate risk. This time we're comparing a bond with a higher coupon rate to a bond with a lower coupon rate and seeing how those are affected by fluctuations in interest. Now, here's what your intuition should say. If I have a bond where, it's paying, as this one is, 4% interest, and rates in the market go up by 1%, that's actually very significant for a low rate bond. A fluctuation in interest is, it's a big chunk of it. Where if my bond is 12%, a 1% fluctuation is not as significant. So my hypothesis here that we're going to put to the test is the lower rate, coupon rate bond will be more profoundly affected by the change in interest rates. But we haven't even read the question. So let's read the question and solve it, and we'll test that hypothesis as we go. If you are considering two nearly identical bonds, bond high and bond low. Both have par value of $1,000, both have 10 years to maturity, and both have a yield to maturity of 8%. The key difference between the bonds is their coupon rate. Bond high has a coupon rate of 12, bond low has a coupon rate of 4. So the first job is just to compute the price of the bonds. They're not the same. They're not $1,000. They're going to be some other amount. And in fact, we can say that bond high is, the yield to maturity is 8, bond high is 12. Bond high is going to be a very large premium, and bond low is going to be a very significant discount because it's lower than the yield to maturity. But anyway, let's figure out the amounts. So here's what I'll use the financial calculator. I'll do one of these by hand, but so I have my formulas ready to go. But I'll use the financial calculator to answer the whole question. Then I'll just solve one by hand for fun, and we'll be out of here. Compute the price of each bond. Okay, the high number of periods. Let's see. Both have value 10 years to maturity. So 10 years to maturity means there's 20 payments, there's 20 interest periods, and that's same for high and low. The IY is based on the yield to maturity, which is 8%, but of course this is semi-annual, so we divide by 2. We put 4%, or just 4 into our calculator. PV, we don't know in either case. PMT, this is the one that's going to be different between the two alternatives. 12% is what our bond high pays, so it's $1,000 times 12%. It's $120 divided by 2. Our PMT our regular payment for bond high is $60 semi-annually. For bond low, 4%. So again, 4% of 1,000 is 40, divided by 2 is 20. Our FV is $1,000. Our future value is $1,000. Okay, so in both cases, we're going to solve for PV. Let's do high first, and again, we'll use the financial calculator. Clearing my memory. 20 goes in as N. 4 goes in as IY. PV, we don't know. 60 goes in as PMT. 1,000 goes in as FV. And we compute the PV. We get 1271.81. And this is at 8%. 1271.81. And for low, it's going to be below 1,000. We're expecting it to be a discount. We just changed the PMT, though. That's the only thing different between the two options. So I change the PMT. I can compute PV. All the other numbers hold. 728.19. Okay, so that's part one. We've got the prices of the bonds. $270 discount and a $270 premium. Okay, very exciting. If interest rates decrease by 1%, that's yields to maturity in the market, decrease by 1%. So now it's 7% yield to maturity for this bond. What does that look like? Well, we just changed the IY from 4, based on our 8% divided by 2, now to 3.5. So just change to 3.5%. So, and it's again the same for both. So let me just clear my memory and we'll do high. 20 goes, oh, what are we expecting to have happen? The interest rates in the market go down by 1%. Well, our bonds that are paying, the coupon rates they're paying are more attractive. Our bond prices are going to go up. That's what we're expecting to see. And well, that's what we will see. So 20 goes in as our N. IY goes in at 3.5 this time. That's the only difference. We don't know our PV. Our PMT is 60. I'm doing the high bond first. And 1,000 goes in as FV. I compute PV. I get 1355.31, 1355.31. And for my low one, let's see the change there. So I just changed the PMT because everything else is the same. The PMT goes in at 20. Now I'm still expecting this to be a discount. It just won't be as severe of a discount. The price is going to go up. So I compute PV. I get 786.81. Okay, so let's check the swings here. Let's check the changes. There's been an increase in the price of both bonds. 1355.31. I'll zoom right in here. Minus 1271.81 means there's a change, an increase of $83.50 for our high bond. For our low bond, 786.81 minus 728.19. 58.62, and there's an increase of 58.62. Now, before I started, I said I hypothesized that the low bond is going to swing more than the high bond, but the change is actually lower. What I should have said to be more precise was the percentage change is going to be higher. So let's see if that's true. You divide the change by the earlier of the 2 years. So I'm going to divide 83 by 1271 and 58 by 728, and we're going to get a percentage change. And I think the percentage swing is going to be bigger. I hope so. I got 58.62 in my calculator. I'll do the one on the right first. 58.62 divided by 728.19. I get 8.05% increase plus 83.5 divided by 1271.81. 6.56% or 6.57%, I suppose, and that's an increase. So it did follow kind of what we were expecting, which was the low bond is more impacted by an interest rate change than the higher rate bond. And that's really the point of the exercise. And why would that be? And the reason is because, a 1% change in the market is going to affect a bond with 4% interest more than 12%. It should hit your intuition as being right? A change in something with a lower denominator is going to have a higher impact, and that's essentially what's happening here. Okay, I'll just solve one of these. I'm not going to do 4 present values by hand. If you made it to here, though, and you're done, great. Thank you so much for watching. And if you want to stick around, I'll do one of these PVs by hand just to, show you that it can be done. And if you were asked to do it, you should be able to do this. So let's redo our baseline high. So we're going to shoot for this number, 1271.81. I'll use all these baseline high figures. So PV of an annuity, C is the payment, 60, times 1 minus 1 over 1 plus R, which is 4%, 1.04, to the number of periods to the power of 20, all divided by 0.04. That's going to give us our present value of our interest flow. Now we're getting $1,000 payment at the end of this thing, so it's going to be 1,000 divided by 1.04 to the 20. 10 years from now, that's what the value of that's going to be. And we combine the two values, we'll get hopefully 1271.81 as our total. But let's run the numbers. 1.04 to the power of 20 is 2.19. I go 1 over x, 0.45. 1 minus that. So minus 1, I hit the plus minus button, so 0.54 divided by 0.04. I'm at 13.59. I multiply by 60. 815.42. 815.42. Do the bottom one, 1,000 divided by 1.04 to the power of 20, 1.04 to the power of 20, 2.19. 1 over x times 1,000, 1 over x times 1,000, 456.39. So combine these two, 456.39 plus 815.42. And there's some rounding on here, but 1271.81. And the sun is shining. The birds are singing. Our answers matched. We made it to the very end. Thanks so much for watching. Have a great day. See you in the next video. Bye-bye. Let's have a run through problem 47A. More bond calculations, lots of present values to be done. I'll do them all in my financial calculator first, and then I'll circle back and I'll just do Starshot. I'll do the first one here by hand afterwards. So if you're somebody that has to do them by hand, I understand it's a little more time consuming, honestly a little more tedious, but it's doable. It's not hard. It's just you got to take your time. But let's go through with our financial calculator first, and then we will solve Starshot by hand. So we're given a bond table, and we're just missing information, right? Starshot is missing its coupon. Coupon, by the way, is what drives the PMT, right? That's the regular payment is the coupon. It's the interest payment. So as I'm thinking about my financial calculator, I translate coupon into PMT there. Maturity is all about the number of periods. Price is the present value. How much would you pay for this bond today? And yield is our discount rate, or our IY in a financial calculator. So we're asked to fill in the missing information. Starshot's missing the coupon. So Starshot, we'll call this company 1, company 2, company 3. Starshot's company 1. It's missing the PMT. Company 2, Ascendancy, is missing the PV, the price, and company 3 is missing the yield. So that's sort of what we're going to solve for. The starred things are what's missing. Everything else we should know about these companies. So it's always like one thing missing in these finance questions, and here it's very plain that one thing is missing. We can compute it though. So let's start with the first company, Starshot. The number of periods here, 10 years, so that's 20 compounding periods. Our IY, 6.5% per year, that's 3.25 per 6 month, because these are semi-annual coupon payments, so we got to convert everything into semi-annual data. So 10 years, that's 26 month periods, 6.5% per year is 3.25 per 6 months. PV is the price, and the price is quoted as a percentage, right? So we're the company's asking $1,000 or giving $1,000 face value for its bonds. To buy it, you got to pay 92% of the face value. You have to pay $927.30 to buy $1,000 bond. You got to pay 92% of the full price. I put it in as a negative. I spat all over my computer screen here. I put it in as a negative because it's a negative cash flow. You're buying a bond. So the PMT will come out as a positive. That's the positive cash flow from the bond. And the FV also will come out as a positive. That's, the lump sum coming back to you at the end. And the lump sum at the end here is $1,000. We don't know what the regular coupon payment is going to be. Let's solve for it. 20 goes in as our N. 3.25 goes in as our IY. Negative 927.3. 927.3 negative goes in as our PV. PMT we don't know. 1,000 goes in as our FV, and we compute PMT, and I get 27.4997. I'm going to just call that 27.5. Now that is our payment every 6 months. So annualized, 27.5 times 2 is $55 in interest per year, 55 per year. Well, on $1,000 bond, $55 in interest per year is 55 divided by 1,000 0.055, it's 5.5%. So our coupon would be quoted as 5.5%. 5.5 is the answer for part 1, Starshot. Company 2, Ascendancy. Okay, coupon is 7.5, so we're just working backwards from what we just did on Starshot. It's a $1,000 bond, 7.5% is $75 in annual coupon. Divide by 2, we get 37.5. That's what's going to go into our calculator as the PMT. Oops, I'm kind of jumping ahead here, but it is 37.5. Let's look at the N, the number of periods for that second bond. It's 30, 15 years. Semi-annual payments, that's 30 payments. Our IY 7.2, that's going to go in as 3.6, half. Our FV is 1,000. That one actually took care of itself quickly. I'm alarmed at how quickly that went because I think I must have skipped a step, or I try to explain every step in detail. I might not have done the job there, but hopefully you're doing your best to keep up. I'm sorry in advance if I skipped a step there. It felt like I was quick to get to the calculator. 30 goes in as N. 3.6 goes in as IY. We don't know our PV. 37.5 goes in as the PMT. 1,000 goes in as FV. And then we compute, what are we computing? PV. 1027.25. 1027.25. It shows up as a negative number here because that's a negative cash flow. All right, I'll switch it back to a positive number. Now, we're saying what percentage, the face value of the bond's $1,000. To buy one, you got to pay a little bit more. So it's like we're paying 102%. So I always just divide by the face value, and then that number is my percentage. So 1.02 is the same as 102.72%. So 102.72, and whatever, however many decimals your professor wants you to go to. Seeing this one was 3, I was like, okay, I'll go for 3. That's as many as we're going to need. 102.725. That's the percentage of the face value of the bond you got to pay to buy a bond. Okay, last one. Number of periods for bond number 3 is 20, Silverline Ventures. So 20 years, rather, is 40 semi-annual periods. Our PV is 117.468. So we have to pay $1,174.68 if we want to buy one of these bonds. I'll put that in as a negative. Our regular payment amount is based on the coupon. Again, looking at the third bond here, 9.2. So $1,000 times 9.2% is $92 a year. Divide by 2 is $46 every 6 months. And 1,000 goes in as our FV. Let's crunch the numbers. 40 goes in as N. 1174.68 negative goes in as PV. 46 goes in as PMT. 1,000 goes in as FV. And now I compute IY. Where are you? IY, there you are. 3.75. Now remember, to get it into the table, 3.6 was 7.2 in the table. 3.25 was 6.5 in the table. Well, 3.75 is 7.5 in the table. And there we have it. We've solved them. Our PMT for the first one is 5.5, or our coupon rather. Our price for the second one is 102.725, and our IY for the third one was 7.5. Congratulations, you've made it. You got to the end. As I promised, though, I'm going to come back and I'm going to do the first one by hand. You could do the first 2 of these by hand. The third one, I don't think so. IY is just torturous to do by hand. If it was even like 7.5, yeah, you could get there. But when it's 7.325 or something like this, it's trial and error to calculate IY is a pain. You can do it in 2 seconds in a financial calculator. But we'll do Starshot Company by hand. To do it by hand, you have to break the bond down into its component parts. There's the present value of an annuity, those recurring payments. We'll take the present value of those, and we'll also take the present value of the lump sum, the $1,000 at the end of the bond, and that combines to give us the present value of the bond. So this question, we're missing the coupon, right? The regular payment, the regular cash flow of the bond. That's what we're looking for, and that is right here. So that's what we're solving for. We should have every other component of this, and we do. We have the present value of the bond. The bond price is 92.73% of $1,000. So the PV of the bond is 927.30. The C is what we're solving for. We'll multiply that by, my bracket there went a little wonky, 1 minus 1 over 1 plus R. So it's 1 plus our yield, but remember, our yield is given annually. We need it divided by 2, so it's 3.25%. So it's 1.0325 to the power of t, the number of periods, which is 20 semi-annual periods to the power of 20, all divided by 0.0325. My brackets were way overkill. Let's make them a little smaller. Oh, much more beautiful. Add that to our FV, our future value of our bond, which is 1,000, divided by 1.0325 to the power of 20. Okay, so I'm going to solve for, I've already got my left here. I'm going to leave C. I'm going to solve for what's in the brackets. I'm going to solve this one. So let's solve. So solving for what's in the brackets. 1.0325 to the power of 20 equals 1.895. 1 over x, 0.5275. 1 minus that, minus 1 equals 0.47. Divided by 0.0325, divided by 0.0325, I get 14.54. Okay, so 14.54, C times 14.54 plus 1,000 divided by 1.035, 1.0325 to the 20th, 1.0325 to the power of 20 equals 1 over x times 1,000 equals 527.47 equals 927.3. So 927.3 equals C times 14.54. Now we're just in like algebra mode. We'll subtract 527.47 from 927.3. 927.3 minus 527.47. I get 399.83. Equals 14.54 times C. Divide both sides by 14.54. So this number divided by 14.54 equals our payment. C equals 27 point. I'm going to call this, it's 27.4986. We're going to call this 27.5. And remember, that's every 6 months. So double it to get annualized. And we end up with a payment of 55. And this number is looking very familiar to me. 55 divided by 1,000 gives us a coupon rate of 5.5%. So that's the number that would go in our table, and that is the number we got earlier in the question. So there we've done it. We've done it by calculator, but we can also do it by hand. And the payment's hard to do by hand. PV, the price is easier to do by hand, and then the yield is very, very difficult to do by hand, but we won't worry about that. Okay, we have solved this in our calculator, and now we've solved it by hand. Hope this video helped, and if you made it to the end, for goodness sakes, I hope you'll hit me with one of those sweet, sweet likes. All right, have a great day. Bye-bye. Welcome to Module 5 of our Corporate Finance class. This module introduces the dividend discount model. Now, what have we said this whole semester, this whole class, this whole class, we've said the value of an equity, a financial instrument, the value of a bond is the present value of future cash flows. So when we looked at a bond last chapter, we said, okay, what are the cash flows? Well, there's interest payments typically every 6 months, and then we get a cash flow, a lump sum comes back to us on whatever we loaned the company, whatever we bought the bond, the bond's face value. So we take the present value of those cash flows. The dividend discount model says, okay, that's for debt, that's for bonds, it's when we buy a bond. What about for equity, when we buy equities in a company? How do I determine the value of that? And one method, the first method we'll learn in our class, is called the dividend discount model, because the cash flow from a bond is the interest payments and the payment of the lump sum at the end. The cash flow from a stock, from an equity, the main cash flow is the dividend. So potentially anyway. And so that's one way of valuing the company, saying, okay, well, this is the cash flow that I'm generating from my investment, my equity investment. How do I value that? And you take the present value of your expected future dividends. So that's a big focus of Module 5, but this stuff is not learned by me explaining what it is. This stuff is learned by you doing examples, and the next video in this series is an example of the dividend discount model. See you there. Bye. In this video, we're going to work on a problem you can download from tonybell.com. Go to the website, click the PDF link, and you'll notice there's no sign in, no sign up. The PDF just pops right up. You'll scroll down and find whatever problem it is that we're working on. As you scroll through the problems, you'll notice many are free and open, like the one you're watching now, but some are members only. I think the free and open ones are enough for most people, but if you can't get enough of me and you'd like to join and get access to those members only videos, click the join button underneath the YouTube play box. All right, thanks so much for watching. Let's get started. Let's take a look at problem 5.1a. This explores the dividend discount model. What the dividend discount model says is to value a company's stock, value the cash flows it's going to produce. And what are the cash flows of a stock? Dividends. So to basically figure out how many dollars worth of dividends we're going to get over time, discount those cash flows to today's dollars. That'll tell you the price of the stock, or the value of the stock, I guess is a different way of saying it. So suppose Benson Industries has just paid a $5 per share dividend, and it is announced that it plans to increase dividends by 3% per year going forward. The company's equity cost of capital is 10%. Okay. So what's the price of the stock today? We're going to use this formula. This is the dividend discount model with a growth rate to the dividend, and this is the formula. So P0 is just a value of the stock today. So the price today, or the appropriate price today, that equals D1, which is the dividend amount in 1 year, so our expected dividend in 1 year, divided by R, which is our required rate of return, our discount rate, and G is the dividend growth rate. And in this question, we're just given all this information, or most of it. We certainly have enough information to go on to solve the problems. Let me change my ink color and let's get to it. So what's the stock price today? So we're solving for this P0. Well, what is the dividend going to be in a year? We know the dividend's $5 yesterday. What's it going to be a year from now? Well, it's going to grow by 3%, so $5 times 0.03. I can do that in my head. I think it's 15 cents. 5 times 0.03 is 0.15. So it's going to grow by 15 cents. So it's going to go from $5 to $5.15. That's 3% growth. So D1 is 5.15. We'll divide that by R minus G. R is our required rate of return, or equity cost of capital in this case, 10%. And the dividend is going to grow by, whoa, that was crazy. Things slipped away on me there. 10% minus 3%. That's our growth rate. So 5.15 divided by 10 minus 3, 5.15 divided by, I'll put 0.07 into my calculator. So 5.15 divided by 0.07 equals $73.57. That's the value that the dividend discount model would put on this stock. Now, there's millions of other factors that go into an actual stock price, but this is one way of considering the value of the stock. So that's A. And we've solved. Let's move on to B. What's the price going to be in 5 years? Well, revisiting our formula here, P5 equals D6, right? P0 equals D1. Well, P5, we got to figure out what's the dividend in 6 years divided by R minus G. So R minus G are the same. We got to figure out D6 in this whole equation. So what is the dividend at time 6? Well, we know the dividend at time 0 is $5, and we know it grows by 3% a year. So we're going to say times 1.03 to the 6th power, and that's going to give us our dividend at time 6. So 1.03 to the power of 6, 1.19 times 5. So our dividend, if it keeps growing at 3%, after 6 years, it's going to be $5.97. So our D6 is 5.97. We'll divide that by R minus G, 10 minus 3. It's still 7%, or 0.07, I guess is what I'll do. So 5.97 divided by 0.07, $85.29. Okay, so there we have what we would anticipate the stock price to be in 5 years. What about in 20 years? Well, we say, well, the price at 20 is D21 divided by required rate of return minus the growth rate, dividend growth rate. So 5 times 1.03 to the 21st power, 21 years of dividend growth. Going to be a big number here, 1.03 to the power of 21. 1.86 times 5. 9.3, basically 9.3, 9.301. Okay, so that's my D at time 21, my dividend at time 21, 9.301, divide by, again, R minus G is still the same, 10 minus 3 is 0.07. Now, again, projecting forward 21 years, companies change their dividend, growth rates change over time, but this is just, an exercise, like a calculation exercise. 9.3 divided by 0.07, 132.88. So our answer to A, $73, answer to B, $85, and our answer to C, $132. I hope I helped you with this, and as always, if I helped you, I hope you'll help me. Have a great day. Bye-bye. Let's go through problem 5.2a, more on the dividend discount model, this time with a little algebra at the start. Because we're not solving for P0, we're calculating the required return, we're calculating R, we're solving for that one. So let's look at the problem and see what we're up against. Stratford Partners will pay a dividend of $4 per share next year. The dividends are expected to increase by 5% per year going forward. So first of all, they will pay a dividend of $4 per share next year. This is D1. The dividends are expected to increase by 5% per year going forward. That is G. And the stock price today is $50. That's P at naught, or P at time 0. Okay. Calculate the equity of cost of capital. That's solve for R. So we can sort of rearrange this, and I'll show you the algebra here. So I'm going to multiply both sides by R minus G. So I get P naught times R minus G equals D1. I'm going to divide both sides by P0. I'm trying to isolate the R. I'm going to divide both sides by P0. So I get R minus G equals D1 over P0. And again, I'm isolating the R, so I just add G to both sides. So I get R equals D1 over P0 plus G. Welcome to finance. There's a fair amount of algebra. You probably didn't need to go through that to solve this, but it's useful in explaining what's going on. So being able to do that kind of algebra, by the way, is very good in a finance class. It will come in handy. It will serve you well. Okay. So R equals D1 over P0 plus G. We've got D1, we got P0, and we got G. We can solve. So let's solve for R. D1 is 4 divided by P0, which is 50. I said 50, I wrote 40. I don't know what happened there. Plus G. There's nothing worse in my video making career than when I say the right thing and I write the wrong thing and I get the answer wrong. I have to redo the video. Okay, 4 divided by 50, it's going to be 8%, 0.08. So I get 8% plus 5% equals 13%. Our equity cost of capital is 13%. Now that gets deconstructed. And the reason I did the formula this way, or I rearranged the formula in the way I did, is because it says calculate the dividend yield. We've calculated it. It's the dividend, D1 over P0. That's the dividend yield. I'm getting a $4 dividend. If I invest $50 today, I get a $4 dividend. My dividend yield is 8%. So our dividend yield is 8%. What's the other 5%? And the other 5% is our capital gains yield. It's how much we're expecting or requiring of capital gains growth in the stock value. So it sort of deconstructs into two pieces here. But the answer to the second part, what's our dividend yield? Our dividend yield is 8%. And again, the other component here is capital gain, how we expect the stock price to grow. So that's that 5%. Okay, there we have it. We've solved, what is this, 5-2A. Thanks so much for watching. Bye-bye. See you in the next video. I can't find the stop button. Okay, I found it. Goodbye. Let's take a look at problem 5.3a, more dividend discount model. This one's a little bit different in how it works because it's a company that's going to go out of business. So it doesn't go on forever as the other questions have implied. Westbrook Technologies is a mining operation and pays a constant dividend of $15 per share, so no growth rate on this dividend. After 10 years, the company is expected to shut down and retire the mine. At that point, the company is going to stop paying dividends and stop operating. The required rate of return on the stock is 14%. So here's what's happening, right? We're going to get a $15 dividend in a year, and so $15 divided by 1.14 to the power of 1. So that's the value of that cash flow today is going to be 15 divided by 1.14 to the 1. And in 2 years, we're going to get, again, a $15 dividend. So 15 divided by 1.14 to the 2, and do that all the way up to 10. 1.14 to the 10, and then it stops, and the company's dead. So we're going to get 10 $15 dividends. What's that worth in today's dollars? Well, this is an annuity situation. So we'll use the present value of an annuity formula. We'll do that after. I'll do it in my calculator just because it is fairly quick, straightforward calculation. I'm just clearing things out here. So let's start with my N. It's 10 years. So 10 goes in as my N. My IY is the discount rate, which is 14%. So 14 goes in as my IY. We don't know the PV. The amount of the easy for me to say. I stumbled there. The amount of the payment is $15. Forgive that stumble. I felt like I sounded like Porky Pig. That's a very old reference, but there we go. The amount of the regular dividend payment is 15, and the future value is 0. This thing's going to 0. So FV goes in at 0. I compute the PV. If I wanted a stock that would pay me a $15 dividend for the next 10 years, 14% discount rate, the value of those future cash flows is $78.24. So that's the value of the stock today, or an appropriate price to pay for that stock today. There we have it. We've solved 5.3a. I'll do it by hand in a second, but if you want to say goodbye, hit one of those buttons on your way out of here, and see you in the next one. But if you want to solve by hand, here we go. Let me zoom out a bit. Yeah, there we go. Okay, so the C is, so we're solving for PV of an annuity. The C is the amount of the regular payment, which is this $15 dividend, times 1 minus 1 over 1 plus R, 1.14 to the power of 10 years, all divided by 0.14. Let me get some brackets in place here. There, good enough. Okay, so clear that out. 1.14 to the power of 10. 3.7, so I go, that's 1.14 to the 10th, divide by 1 by that, so 1 over x, 0.269, 1 minus that answer, so minus 1, hit the plus minus, 0.73, divide by 0.14, 5.2, multiply that by 15, and because I haven't rounded, I get the exact same answer, 78.2417. If you look back in the video, it's going to be 78.2417. And you can see that does indeed match my answer. So we've solved it twice. Don't hit the button twice. I was going to say, if you liked it, hit the like button twice. No, that erases it. Hit it 3 times. Hit it twice, and then hit it a 3rd time to give me an extra thumbs up. Hope you're having a great day wherever you are in this world, and I'll see you in the next video. Goodbye. Let's examine problem 5 for a kind of a weird question. This is an oddball question. It's just about the mechanics of voting for a board of directors. And I actually learned something here. It's a little bit funny, so I'll show you what I did and why it was wrong and what the right answer is as we go. Evergreen Creations will soon be running an election for 4 seats on its board of directors. The company has 100,000 shares outstanding. The share price is $20 a share. You like Susan Sampson, but she's extremely unpopular, so nobody else is voting for her except you. Assuming you own no stock today, how much will it cost you to get enough stock to buy the seat if the company uses straight voting? Assume no one else is going to vote for Susan Sampson. If the company uses cumulative voting. So there's 2 different types of voting that this introduces to us. Straight voting is the candidate comes up and people vote yes or no should they be on the board of directors. And if that's the type of vote it is, one at a time, you're electing the board of directors on sort of yes, no type of vote, you need more than 50%. Like it needs to pass with more than 50%. So you would need, for straight voting, 50% plus 1 share, right? More than 50%. So if there's 50% of 100,000 shares is 50,000 shares, you need 50,001 to have enough votes to say, okay, well, 49,999 can vote against her. I have enough votes to just win. So you need 50,001 shares at $20 a share. It's $1 million or something. 50,000. Oops, not 50,000. 50,001. Don't forget the 1 times 20. Yeah, $1,020,020 worth of stock. That would buy you the election under straight voting. So again, straight voting, 1 candidate at a time. If you have 51% of the shares, you can just dominate. You can just pick your candidates, pick your slate. You win because you have more than half the votes. Another way of electing a board is to protect minority shareholders. So people without 50% of the vote can get screwed here, right? And so they say, well, if I have 25% of the vote, shouldn't I be able to elect 25% of the board? Something like this. And so this is what cumulative voting is for, where you get 1 vote for the entire slate of candidates. And so if there are 4 seats coming up, you don't need half the votes. Now, this is where I got it wrong. And this is an interesting math puzzle. I thought, well, okay, 4 seats. I want to elect 1 person, Susan Sampson, so I'm going to need 1/4 of the votes. I'll need 25%. This is not correct. The math is you go 1 over the number of candidates plus 1 to figure out how much you need. So in this case, 1 over 4 plus 1, it's 1 over 5. The correct answer here is 20%. And I was wrong about it. My intuition said, no, it's got to be 25%. So this is why I think this is an interesting question. Beyond this, it's a weird question, to be honest. But I think this is just intriguing. Why is it that there's only 4 board seats, but to get 1, I need 20% and then plus 1 vote, right? Same with 50% plus 1 vote. So I need 20% plus 1 vote. Well, let's contemplate this. So 20% of 100,000 is 20,000. So I would need 20,001 share times $20. That's 40,000 or $400,020 worth of stock. Okay, that's the answer to the question, right? We've solved the question. We need 20,001 shares. It's going to cost $20 a share. That's what we need to buy up to guarantee Susan Sampson gets her seat under cumulative voting. But why does it work this way? Well, let's sort of divide this up. Let's assume that each candidate wins with their bare minimum, which we've said is right around 20,000. So candidate number 1 gets 20. There's 5 candidates vying for 4 seats. So candidate number 1 gets 20,000 votes. Candidate number 2 gets 20,000 votes. our preferred candidate, well, candidate 3 gets 20,000 votes. We vote 20,001 votes for Susan Sampson, and candidate number 4, because it adds up to 100, has to have 19,999. Well, you can see there, if I have 20,001, even if the votes just split perfectly evenly everywhere else, I'm guaranteed a spot with Susan Sampson. Now, if this person gets 30,000 and this person has like 25, well, all of a sudden, Susan Sampson's for sure going to be at least 4th place with 20,001. The worst you can do is 4th place. And look, we're electing 4 seats. So my intuition about 25% was just totally wrong. You need this N+1. Susan Sampson, to get on the board, needs just 1 vote more than 20%. There's no way it just guarantees her a seat, even if the voting goes terribly. And again, if you had 20% plus 1, you would guarantee yourself a seat on this board of directors. So you could buy the seat for $400,000 and $20 to get over the 1. So that's the worst case scenario for her is everybody splits the vote at 20, 20, 20. And even still, if everybody split the vote right around 20, her having 20,001 gets her in. Nobody's going to beat her. Okay, kind of an interesting question. I think the math of it's interesting. We've solved the problem. Thanks for watching. It's a weird problem. Have a great day. Bye-bye. Welcome to Module 6 of our finance course. One of the most important modules of the semester. I don't think it's one of the hardest, though, but it's a very useful module. So we're going to cover payback period, internal rate of return, and NPV, net present value. And we'll start actually by doing an example with all 3 of them just in this video to explain each of them. So net present value, if you've been following along with our course so far, really is straightforward. You just figure out what the cash flows related to whatever the opportunity is, the project or the investment or whatever, and you just take the present value of the cash flows. So typically it's going to be like we spend some money at the start, some cash flows to us, and we're saying, well, was it worth it? That's the very typical net present value question, and here is a typical example. I drive Uber, and I'm thinking of replacing my gas car with an EV. After trade-in, the EV is going to cost me $35,000 out of pocket today. I estimate that it's going to save me $10,000 a year for the next 6 years. By the way, these numbers are totally made up if you are an EV superfan, and I've underestimated this. Too bad. If you're a gas lover and I've overestimated the savings, too bad for you too. This is just back of the napkin guesswork calculation to serve a finance problem. So I spend $35,000 upgrading my car, getting a new EV, and it's going to save me $10,000 a year for the next 6 years. And the discount rate here is a big one, 12%. So we'll start by calculating the net present value. We'll go over what it means. We'll talk about IRR and last payback. Let's start with net present value and let's just track the cash flows. Pretty straightforward cash flow number line here. We've got time 0. Start with 0, 1, 2, 3, 4, 5, 6 years. There's my timeline, and at time 0, it's negative 35K. Time 1, it's plus 6K, or plus 10K, not 6. 6 years. I had the number 6 in my mind. Time 2, it's plus 10K. Time 3, I'm sure I could have squeezed this in a nicer spot, but here we are. I'm committed to it now. Time 5 plus 10K. And time 6 plus $10,000. And what we're saying is, do the plus 10s outweigh the minus 35? Again, you're saying likely, of course, it's plus 60 minus 35, but time value of money matters. And in fact, having such a big discount rate is going to mean this $10,000 6 years from now is worth half in today's dollars. So it's not so obvious an answer. And so what we need to do is figure out, well, what is the value of our 10K cash flows over the next 6 years? And does it beat the negative $35,000 today? And so it's present value of an annuity, right? This is a $10,000 annuity for 6 years. We know the math. I can do it in my financial calculator fairly quickly. I'll do this one by hand because we'll do some financial calculator work in a second, but let's do the present value of that annuity we've looked at. It is a $10,000 savings, so my C is 10,000. Here's the formula for an annuity. You've seen this before. 1 minus 1 over 1 plus R, so 1.12 to the power of 6, the power of T, all divided by 0.12. All right, so get my calculator out and we'll solve for this. I won't start with the $10,000. Clear, clear, clear. Let's start with a 1.12 to the 6th power. 1.12 y to the x 6, 1.97. I go 1 divided by that, so 1 over x, so now I'm at 0.5. Then I go 1 minus that, so I make that number negative, plus 1, so now I'm at 0.49. I divide by 0.12, and I multiply by 10,000. So it's 41,114. 41,114. So looking at my NPV, I have to put out $35,000 today, but the present value of those $10,000 cash flows is 41,114. So overall, I'm up 61,114. In our class, if the net present value is positive, we say do it. Go ahead with the project. It has a positive NPV. It is worth doing. That's what we would say here. If you want to do this maybe more quickly in a financial calculator, what I would do if I was using the BA2 Plus is you enter cash flow. So you go CF. Oops, let me clear this out. I've done this in preparation. So my cash flow at time 0 is negative 35,000. I hit enter. Down arrow, my cash flow at time 1 is plus 10,000. And since all the cash flows are the same, I can use this frequency and I can say that there's 6 of them. So I hit 6, enter. That's it. I've got all my cash flows in the calculator. I compute NPV. It says, well, what's your discount rate? My discount rate is 12. Enter. I hit the down arrow and I hit compute again. And there it is, 6114. And that's the number I had calculated by hand. So just to show you, you can do this by hand or in a financial calculator. IRR, I'm a believer you're going to need a financial calculator. I don't have the math chops to do this one by hand. Maybe you do, maybe your instructor does. IRR is solving for a rate. And what IRR says is what discount rate is needed to show NPV of 0. So we know it's got a positive NPV when our discount rate is 12. It's going to be a higher discount rate to show an NPV of 0. Meaning if our discount rate is lower than that, then if IRR is higher, gives us a higher discount rate than the one in the question, this is a project worth doing. In other words, the project's internal rate of return is higher. And we know the project's internal rate of return is going to be higher because NPV was positive. So if NPV was 0, what would the discount rate need to be to make NPV 0? How do I do that? Well, again, financial calculator, it's easy. You just go IRR, compute, right? We got all our cash flows in. It's 17.97%. So a required rate of return is 12%. The internal rate of return of this project is about 18%. Again, you would say, do the project. And we'll see some curious examples where NPV and IRR give us interesting results anyway. The last one, Payback is the simplest. Payback, I think of ski pass math, maybe because I'm from Canada and I ski. Here's ski pass math in a nutshell. Ski pass costs $1,200 at my local hill, or I can go just without a ski pass and it costs $100 per trip. So you go, okay, it's $1,200 for all you can eat, all you can ski pass, or it's $100 for a trip. Well, the ski pass pays for itself after 12 times, right? That's payback period math. The payback period is 12 ski trips. Well, the payback period here is, it cost me $35,000 and I saved $10,000 per year. What's my payback period? 3.5 years, right? This is ski pass math. Couldn't be simpler. And this is like early days when you're thinking about a project. This is back of the napkin math. And of course, the faster the project pays you back, the less risky it is. If the payback is 10 or 20 years, well, the world changes in 10 or 20 years. So you would generally think shorter payback means less risk for me. All right. And by the way, the thing about payback is you can see it does not take into consideration the discount rate. Now, there is such a thing as discounted payback, but that's for a future video. So there you go. The big topics of the week. Payback period. Very simple. IRR, probably the trickiest and the one that I do think you're going to want to use a financial calculator to solve, or Excel or something like this. And net present value, a core concept in any finance course. This one is going to be a key concept for you. All right. Thanks so much for watching. Lots of examples ahead. See you in the next video. In this video, we're going to work on a problem you can download from tonybell.com. Go to the website, click the PDF link, and you'll notice there's no sign in, no sign up. The PDF just pops right up. You'll scroll down and find whatever problem it is that we're working on. As you scroll through the problems, you'll notice many are free and open, like the one you're watching now, but some are members only. I think the free and open ones are enough for most people, but if you can't get enough of me and you'd like to join and get access to those members only videos, click the join button underneath the YouTube play box. All right, thanks so much for watching. Let's get started. Let's examine problem 6.1a, payback period. When I think of payback period, I think of like gym memberships, or for me, I ski. I'm from Canada, so we have good skiing nearby. And here's my ski pass situation. It costs $1,000 to buy a ski pass to my local hill. It also costs $100 if you just want to buy a ticket for the day. So the math is pretty simple. I say to myself, if I'm going to ski more than 10 times, I'm getting my money's worth out of the pass. In other words, the payback period for the pass is 10 ski trips. We all have these types of things, and it's a very basic, I consider it a back of the napkin calculation you can do, and companies do it on their projects. They go, okay, well, this project costs us this much, but this is how much it's going to bring in. How soon does it pay itself off, right? How much do I need to use the project or whatever? How many years does it take to pay the thing off? So that's what we'll look at with problem 6.1a, a payback period. So Horizon Strategies is considering a project with the following cash flows. It costs us 60 grand up front, and you can see the payback over time. So the question is, how long until it pays back? And the way I do this is I just do a running total. So I go, okay, after year one, I'm minus 60,000. After year two, well, minus 60 plus 20, I'm minus 40,000, right? It was minus 60. I've made 20 grand, but I'm still in the hole on the project. After year three, I'm still in the hole by 10,000. After year four, I go positive. I go to 5,000. So I can stop there. Once I've gone positive with my little running total here, we can figure out the payback period. So it takes us 1 full year there. We still haven't paid back. 2 full years here, and then sometime in year 3 we pay back because we go positive. Now the math here is fairly straightforward. You just go, well, I was $10,000 behind, and I'm going to make $15,000 this year. So you take this number, divide by that number. So you go, okay, well, it's $10,000 is what I needed to make up, and that year I make $15,000, so it's 0.667. So how many years is it going to take me? 1 full year, 2 full years, and then 2/3 of year 3 to break even. So my payback period is 2.667 years. Okay. And again, you would be evaluating this against other projects, right? You have more projects typically than you have resources to do them. And so you'd say, well, this is, 2.67, if all the other projects are taking 4 and 5 years to pay back, you'd say, oh, this is a pretty safe project to tackle. But something that is lost here, because it's such a simple calculation, is the time value of money. The fact that these future cash flows, they are, money in the future is not the same as money today. So part B says, well, why don't we discount those cash flows? So I'm going to move and erase this stuff. And actually, I'm going to erase everything and just sort of start over. I trust you can rewind if you need those numbers. And we're going to do a discounted cash flow. So how do I discount them? Well, it's a 10% discount rate. The first number, well, you divide by 1.1 to the power of 0, which of course is just dividing by 1. This one divided by 1.1 to the 1, because it's a year from now. This one divided by 1.1 to the power of 2, divided by 1.1 to the third power, divide by 1.1 to the fourth power, and divide by 1.1 to the fifth power. And we're going to figure out what our discounted cash flows are. So again, 60,000 divided by 1.1 to the 0th power is just 60,000 divided by 1. You can see I did it in my calculator there. And so it's 60,000. And of course, $60,000 in today, that's what it is in today's dollars. 20,000 divided by 1.1 to the first power, 20,000 divided by 1.1, 18,182. That's positive. So the first one, I put a little negative. It might be hard to see there, but I did squeeze a negative in. This is a positive number. Every other number here is a positive cash flow. 30,000 divided by 1.1 squared. So 1.1 squared. I go 1 over x times 30,000. 24,793. 24,793. 15,000 divided by 1.1 cubed. 1.1 to the power of 3. 1 over x times 15,000. 11,270. 8,000 divided by 1.1 to the fourth power. 1.1 to the power of 4. 8,000 divided by that, so 1 over x times 8,000. 5464. And 4,000 divided by 1.1 to the fifth power. For 1.1 y to the x 5. And then 1 over x times 4,000. 1 over x times 4,000. Okay, so finally I've got my numbers. 2484. Now, just as I did last time, I'm going to want to do a running total, but this time with the discounted cash flows to figure out, well, using only discounted cash flows, how many years or periods does it take me to kind of come out even or come out ahead? So negative 60,000 plus 18,182. So 60,000 negative plus 18,182. After 1 year here, I am still in the hole, minus 41,818. Let's add 24 grand to that, plus 24,793. After 2 years, I'm still in the hole, minus 17,025. I'm digging myself out of this $60,000 hole I've made for myself. Plus 11,270, plus 11,270. So after 3 years, I'm still in the hole, minus 5,755. And after 4 years, you can see I'm still going to be in the hole, plus 54,64, minus 291. And so it's not until sometime in year 5 that I climb out of this hole. 291 negative plus 2484 positive is 2193. Okay, so I go positive in the 5th and final year. So it's going to be 4 point something years, right? Because I got 1 full year, 2 full years, 3 full years, 4 full years being negative before I finally go positive at some point in year 5. You take 291, divide by the discounted cash flow of that year to figure out which fraction of the year you're going positive in. So 291 divided by 2484 says 0.117. So let's call it 0.12. So 4.12 years. We're being overly precise for something that's going to happen 4 years from now. Will it be exactly 4.12 years? 0.1 of a year is whatever, a month or something like that. A little bit. It's about a month. 4 years in 1 month. It's maybe a little overly precise when we're making projections that far into the future, but that's how you do it. So we've solved the problem using the discounted cash flows. It's going to take us 4.12 years to pay back, right? And so that's useful information to have, right? The time value of money becomes highly relevant. And, the numbers were sort of manipulated to make that the case with our lower cash flows later. So that's why that's happened that way. But it's a useful calculation, a useful tool to have in one's toolkit. I hope this video was useful to you. I hope I was a useful tool. No, that doesn't sound right. I hope the video was useful to you. Have a great day. Thanks for watching. See you in the next video. Bye-bye. Let's take a look at problem 6.3a. We're into one of the key concepts of our finance course, and that is the concept of net present value and IRR, internal rate of return. We'll solve this one. We'll do part A by hand, and then I'll show you how to do everything in the financial calculator. You'll see it's a lot quicker in a financial calculator. So, Global Vision Partners has a potential investment with an initial cost of $500,000 in the following projected cash flows. So, when we're thinking about cash flows, we actually have another cash flow at year 0 that's not on this list. And the year 0 cash flow is $500,000 negative, right? Our initial investment. You can see 120, 160, 200, 180. Let's see. Total cash flow is 660. Just adding up that list. And so you might think, okay, well, cost me 500. And I'm bringing in 660, this is a go. And, if we were using payback period, maybe we would sort of say, oh, yeah, it pays back in 3 years or however long, 3 and a bit years. Maybe that's sufficient for us. But a little bit more sophisticated is to bring in the time value of money. And to bring in the time value of money, you need a discount rate. And so we're going to figure out the present value of these payments using a 6% discount rate. So how do I discount these cash flows? Well, very straightforward. You just divide by, now I'll do this in the financial calculator, go quicker, but divide by 1 plus the discount rate. So in this case, 1.06, raise the power of the number of periods we're discounting. And for our initial thing, it's 0. Now, you don't need to do this, but 1.06 to the 0 is 1. You can see there it's 1. So 500,000 divided by 1 is 500,000, or negative 500,000 divided by 1 is negative 500,000. Now you just do the same thing for all these cash flows. Divided by 1.06 to the 1, divided by 1.06 to the 2, because of course the more years, the more the discount factor will be. Okay, so let's do 120 divided by 1.06 to the 1. 120 divided by 1.06 is 113,208. $160 divided by 1.06 squared, 1.06 squared, 1.1236. I go 1 over x times 160. 142,399. $200 divided by 1.06 cubed. 1 over x times 200. 167,924. And 180 divided by 1.06 to the power of 4, 1.06 to the power of 4, 1 over x times 180, 142,577. Now I just add everything up. And the idea is if it's positive, this is a good project. If the total number here is negative, this is not a project worth doing. So 500,000 negative plus 113,208 plus 142,399 plus 167,924 plus 142,577 equals positive 66,108. 66,108. And so what we would say is the net present value here is 66,108. This is a go. We should do the project. If the net present value is positive at all, it means this is a project worth doing. Okay, so we've solved part A by hand. Now we'll do everything else in the financial calculator. You could do part B by hand, just the same thing. It's just 20%. So everything here, the 0.06s would change to 0.2, 1.2 to the 0, 1, 2, 3, 4th power. But we don't need to run through that again when we have a financial calculator that'll make our life easier. So here's how we do this in a financial calculator. So I'll do part A just to show you, and then B and C are just going to be super duper quick once we get the numbers in here. So if you want to do net present value, you have to say, what are my cash flows? So it's the CF button in our BA2 Plus calculator. Every financial calculator will have something like this. Unfortunately, I can't support all financial calculators. This is, I think, widely thought of as the best, or certainly the industry standard one I've seen. So CF. So this is CF at time 0. What is my cash flow at time 0? It's negative 500,000. So I just put in 500,000 negative. I hit enter. And then I hit the down. This is sort of telling you like what you can do here. So there's enter and then there's up and down. So I hit the down arrow. Cash flow at time 1, 113,208, 113,208. I hit enter. I hit the down arrow. FO1 is, what's the frequency? If you've got like an annuity with like 15 cash flows at this point, you could enter 15, but we only have, oops, I did the wrong number. Oh my gosh, let's go back up. Cash flow at time 1 is not 113,208, it's 120. I discounted it already. Sorry. I'm glad I caught that. 120,000. Enter. So there's my cash flow at time 1. The frequency was 1. Cash flow at time 2, 160. I hit enter. Cash flow at time 3, again, the frequency there is 1. So cash flow at time 3, 200. Enter, and the cash flow at time 4, 180. And I'm just skipping past the frequencies because I only have 120, 161, 200. If you had multiples of the same, you would put frequency of 2 or 3 or whatever. So anyway, there we go. There's our cash flow at time 4, and now we're done. So I want to do the net present value. So I hit NPV. It says, well, what's your discount rate? It's 6%. So I hit 6, enter. I hit the down arrow. It says NPV equals, and it tells me compute is a button you might want to hit now. And so I hit compute, 66,108, and you can see the numbers match, right? 66,108 is what we had calculated. That's what our financial calculator tells us. So now we can play around. We've got all the cash flows already inputted into our calculator. I can solve part B in 1 second, right? All I do is I hit NPV again. It says, well, what's the discount rate? It was 6. Let's make it 20. I hit enter. I hit the down arrow. I hit, now this is the old answer. I have to hit compute again. I hit compute, and you can see it's negative 86,343. So, okay, we've solved, right? We've computed the net present value at 6%. We've computed the net present value at 20% discount rates. What is the internal rate of return? The internal rate of return is the discount rate where NPV is 0. You set NPV to 0 and you solve for the rate. Now, not an easy thing to do here, solving for the discount rate. If you do it by hand, it is trial and error. You're just, punching in numbers and saying, well, that's a little too high, that's a little too low. So we know looking at this, it's going to be between 6 and 20%. What's it going to be, like 12%, 11%? I don't know. But because I have a financial calculator, it's easy. I've got a button marked IRR. Let's hit it. IRR equals, and it says, well, why don't you compute? So let's compute. 11.24%. And there we have it. We've solved the problem. Now, if I entered this IRR as my discount rate, 11.2418. If I go into NPV and I say, no, my I is 11.2418, enter, and now I compute the NPV. I hit the down arrow, and NPV is negative 86, but I hit compute. NPV should be very close to 0. If I didn't round it all, it would be 0. Let's see what NPV is with that slightly rounded answer. You can see it's 0.47 cents. It's 0, essentially. So that's the internal rate of return of the project. And what does that mean? Well, it means if my required return is less than 11, this is going to have a positive NPV. If my required return is more than 11, it's going to have a negative NPV. And that's certainly bared out in parts A and B. All right, there we have it. Holy cow. Very important concept, right? Net present value, fundamental to your life in a corporate finance class. So this is the first of many NPV calculations we'll be doing through the course. Thanks for watching. See you in the next one. Bye-bye. Let's take a run through problem 6.4a. We're asked to compute internal rate of return. That's the point at which net present value is 0. That's the discount rate at which net present value is 0, as well as just net present value calculations. This is a great practice. Again, net present value being a fundamental concept in a corporate finance class. Pinnacle Company is considering a project that will cost $50,000 today and expects will provide cash flows of $10,000 per year for the next 8 years. So we're going to be to have a payback period of 5 years, right? It costs us $50,000 per year, and it's $10,000 per year for the next 8 years. It pays back in 5 years, but what's the net present value? Because payback doesn't consider the time value of money. And so it's going to depend on our discount rate, our required rate of return, to figure out whether this is a good idea or a bad idea. So you could do this in so many ways. We're going to do it in the financial calculator, so I'll show you how to do that. But you could also do this by hand, just by like listing out your cash flows. So negative 50, 10, 10, 10, 10, 10, 10, 10, down to, do that 8 times, and then you just go present value calculations. You divide by 1 plus the discount rate, 1.06 to the 0. That happens at time 0. This one happens at time 1, time 2, down to time 10. But of course, we have an annuity, so I'll show you how to do it in the financial calculator, and there's different ways you could do it in the financial calculator. And then I'll show you, I'll calculate the PV of the annuity by hand and show you how I'd solve this by hand. But let's start with our financial calculator. We're going to be entering cash flows. Now, I think I have stuff, in my calculator from before, so I have to go second function, clear work. Let's see, NPV. Okay, that's all cleared. Good. Okay, so you just want to make sure the memory is cleared out so you don't have some previous payment hiding in there somewhere. But let's think about the payments. We're putting out $50,000 today, and we're getting $10,000 a year for the next 8 years. So cash flows. I want to enter cash flows. $50,000 negative today. Cash flow at time 0. I hit enter. Down arrow. Cash flow at time 1, 10,000. Enter. Down arrow. Now here, this F1 is the frequency of that $10,000 cash flow. And because it's an annuity, it just pays the same every year for 8 years. I can say frequency is 8. And at that point, I've done. I've entered every cash flow. I've said, I get $50,000 out today, and starting next year, I get 8 payments yearly of $10,000. That's what this means, and I'm done. So now I can compute the net present value at 6%. Let me erase this so I can have room to enter my answer. So I hit NPV. It says, what's the I, or the required rate of return for part A? It's 6. So 6, enter. I hit the down arrow. It says NPV 0. No. I hit compute, and it'll tell me the NPV. And the NPV is $12,098. 12,098. So we would say, based on NPV rules, to do it, right? This is a project worth doing because it has positive net present value. Okay, part B, calculate the net present value, assuming a required rate of return of 30. Well, you just go back, you got all the cash flows already entered, so you just go back into NPV. You change I from 6 to 30. How do I do that? I just put 30, enter. So now my I, or my required rate of return, is 30. I hit the down arrow, and now it's got the old NPV. I just have to recompute it. So I hit compute. Now it's negative 20,753. So in this case, we would say, don't do the project. Negative NPV, don't do the project. Positive NPV, do the project, in the absence of other information. Okay, so we've solved there. Now it asks for the internal rate of return. That's the rate of return at which NPV is 0. So it's going to be somewhere between 6 and 30. I'm going to guess, I don't know, I'm spitballing here, maybe 14, 15%. I don't know, some point in between 6 and 30, we go negative. So what's the point at which we're 0? I'm spitballing 13, I'd start with maybe. Let's see. So easy enough in a financial calculator, you just hit IRR and compute. 11.8. So I was a little bit off with my guess. 11.81%. That's the point at which our net present value is 0 and we're indifferent to the project. So if our required rate of return is higher than 11.8, we don't do it. If our required rate of return is lower than 11.8, it's worth doing. Okay, we've solved, and that's it. So if you're using a financial calculator, you probably don't need to go any further. We can say goodbye. But if you're using if you want to do this by hand, you won't do IRR by hand because changing these rates in our calculations is like tedious, and it's just trial and error. You just just trying various versions. You can do it in Excel quickly, but you can do it much more quickly just with a financial calculator or in Excel using an IRR solve feature. Okay, let's solve this by hand though. So I'm going to redo part A by hand. You could apply this to part B just as easily. So PV of an annuity, we'll deal with this $50,000 today money after. We want to know what $10,000 per year for the next 8 years at a discount rate of 6%. What's the value of that? So 10,000 is our recurring payment times 1 minus 1 over 1.06, right? 1 plus 6% to the power of t. This is 8 years, all divided by r, which is 0.06. Okay, let's get some brackets around stuff. And there we are. That's good enough. Okay, so 1.06 to the power of 8. 1.59, I go 1 over that, so 1 over that is 0.62. 1 minus that, I always go minus 1, then hit the plus minus, 0.37, divide by 0.06, and I end at 6.2 times 10,000. And the value of those cash flows is 62,098. So you got to ask yourself, would I pay $50,000 today to get value of $62,000? And the answer is yes, you would. And what's the overall value here? Well, I'd pay $50 to get $62. I'm making $12,098 on that deal. That's my net present value. So we could do this, by hand. That took 2 minutes maybe. Like, it doesn't take long. It is quicker in the financial calculator, but you can do it by hand. We've solved the problem though. Thanks for watching. See you in the next video. Bye-bye. Let's have a look at problem 658, an interesting question and a lot of interesting math going on here. In fact, the math is challenging enough because it's a lot of calculating of rates. And when we calculate rates, I advise you to use Excel or a financial calculator. Doing it by hand is just trial and error. I'm not going to do anything by hand here. Everything is going to be in my financial calculator. So if you're not a financial calculator user, this might be of limited use to you, but in any event, it's still a good problem. Evolve Management is debating between 2 projects. The company does not have the capacity to do both and must choose the best option or neither. Cash flows for the projects are laid out in the table below, and there are some cash flows. Now, just at the start, this type of question, let's just do some math here. 340, so I'm looking at project X, 340 negative plus 200 plus 175 plus 155. If we do the project just purely based on a cash basis without thinking of time value of money, we end up ahead 190 grand. And looking at project Y, 340 negative plus 160 plus 170 plus 210, we end up $200,000 ahead on project Y. Just pure cash flow, just calculating the numbers. But time value of money matters, and the fact that you're getting a bunch of money early with Project X and less with Project Y, and more Project Y's money comes in late and less in Project X, means even though Project X has less raw dollars, it might be more attractive. So anyway, that's sort of important in these calculations. And what we find is if the discount rate is 0, in other words, there's no such thing as time value of money, Project Y is way better. If the discount rate is high, like 20%, for sure, Project X is going to be better because we're discounting the future cash flows, and there's more future cash flows with Y. The question is, what's that point where they cross over, right? What's the crossover rate? So that's the big question of the problem. That's the name of the game here, and we're going to figure that out. But before we can figure that out, we're asked the IRR. To compute IRR, that's the point where net present value of a project is 0. What is the rate at which the net present value is 0? We're going to enter these numbers into our calculator and compute IRR. Let's do it. So I go CF, second function, clear work, make sure there's nothing in there. CF, so CF at time 0, I'm doing Project X now, 340,000 negative. Enter. Down arrow, cash flow at time 1, 200 grand positive. Enter. Frequency of that is 1. I only have one $200,000 cash flow. Everything here, the F frequency is going to be 1. 175 for cash flow at time 2. Enter. Cash flow at time 3, 155. Oops, screwed that up, 155. Glad I caught that. Enter. And then I just hit IRR, compute, and the IRR is very high, 27.3%. What's the IRR of, well, actually, before I do IRR of Project Y, I've got all those numbers in my calculator. Let's do the MPV at 10%, which is part 2, assuming a discount rate of 10%. What's the net present value? It's going to be a big number, and it's going to be positive. How do I know it's a big positive number? Because my IRR is 27%. If my discount rate's 10, it's got to be positive. If the IRR was 27% and the discount rate was 30, this would be a negative number. Okay, let's go ahead and solve. So I go MPV. The discount rate is 10, so I put 10 in as my I. Hit the down arrow. I compute NPV 102,900. Okay, Project X in the bag. Let's do the same thing for Project Y. Clear, clear, clear. CF, second function, clear work. CF, 340 negative. Enter. Cash flow at time 1, 160. Enter. Down arrow. Cash flow at time 2, 170, positive. Enter. Cash flow at time 3, 210, positive. Enter. Now, I just had this sneaking suspicion. Did I put in my cash flow at time 0 as a negative number? I did. Okay, so you can just hit up and down and go through your cash flows, but they're there. So I've got everything in. Now I want to compute IRR. So I just hit IRR, compute, 25.82%. I guess I'll just call it 25.8%. So a lower IRR for Project Y, slightly. And well, let's see what the NPV is, the net present value. Is it also lower? I don't know. So I go NPV, and it's the NPV at 10%. So I is 10, hit enter, down arrow, compute, 103,726. Oh, interesting. So the IRR is actually 727. The internal rate of return is higher for project X, but the net present value at a 10% discount rate is higher for project Y. And just eyeballing this, as the net present value goes from 0%, if we're just, not the net present value, discount rate, was 0%, we really prefer project Y because it's 200 versus 190. At 10%, we still prefer project Y. But at some point, because look at the IRR, it's higher for project X, at some point, we're going to start to prefer project X. The question is, at what discount rate do we switch from project Y to project X? In other words, it's climbing, everything below 10%, certainly project Y. Everything up to a certain number, we're going to like project Y better. At what point do we cross over? Here's how we do that. You subtract your two, you just find the difference between the two. So 340 minus negative 340 is 0. There's no difference. 200 minus 60, that's 40,000. 175 minus 170, that's 5,000. And 155 minus 210, that's negative 55,000. And we just enter these as cash flows into our financial calculator. So let me clear, CF, second function clear. So I put them in as cash flows. So CF at time 0 is 0, using that one. Cash flow at time 1, 40,000 positive, enter. Cash flow at time 2, 5,000, enter. And the cash flow at time 3, 55 negative, enter. And now I'm going to compute the IRR of those cash flows, those differences in cash flow. IRR compute, and it's 11.18%. That's the moment we cross over. That's the moment we go from preferring project Y, as we did for those first 10%. So we prefer project Y up to 11.18%. And then we cross over at 11.18%, we're indifferent. And once we're over 11.18%, we prefer project X. So that's the crossover rate, 11.18%. So just to draw this on a chart, from 0% to 11.18%, we would pick project Y. From 11.18% to, 27.3%, we prefer project X. And after 27.3%, we prefer neither. We would just say don't do either because we're losing money. Because 27.3% is the internal rate of return of project X. Above that, the net present value is 0. In fact, above that, it's negative. 27.3% is where net present value is 0. So above 27.3%, we would just not do either project. So the question goes on. If the interest rate increased above your answer in part C, above 11.18%, so above your answer in part C, which project would you prefer? We would prefer project X. Why? Because it produces a higher net present value than project Y does at that level. And we sort of explained why in that little graphical chart I put on the bottom. Okay, folks, we've done it. Congratulations. Not an easy concept, but the math's not too bad if you know how to use your financial calculator, I suppose. Thank you, as always, for watching. I really do appreciate it. I work hard on these videos for you. I hope they're helpful, and if they are helpful, I hope you'll give me a thumb or a sub. Have a great day. Thanks for watching. See you in the next one. Let's examine problem 6.6a. We're calculating IRR, we're calculating net present value, but the real key topic of this question is that of the crossover rate. So let's read the question and see what we are up against. Elevate Enterprises is debating between investing in two separate projects. Both have an initial cost of $75,000. The company does not have capacity to do both and must choose the best option, or neither, if NPV or IRR is negative. Cash flows for the projects are laid out in the table below. And so there's our table. I guess the one cash flow, at time 0 that isn't included in the table is that they both cost $75,000. Before I get into it, I always eyeball the cash flows of the project. I do almost like payback of it. And I sort of say, does this pay back? And if so, over what time period? So 40 plus 30 plus 20 plus 10. It's 100,000 positive to go against 75,000 negative. So this one, you add it all up, you're plus 25, not considering time value of money. And this side, 10 plus 20 plus 30, it's 105 versus 75. So this one, you're plus 30. And so you think, well, maybe project B is just better because you're 30,000 to the good, where project A, you're only 25,000 to the good. And that would be the case if there was no discount rate. If there was no such thing as time value of money, project B all day, it would be the winner. However, the fact is project A's cash flow is largely upfront, and project B's largest cash flow is backloaded, and so the time value of money is going to become a factor. At 0% discount rate, it's project B, but at a large discount rate, it's going to be project A. You want your money up front when interest rates or discount rates are high. So the question is, at what point are we indifferent? At what point do these rates cross over? So that's a $1 million question, but before we get to it, it asks us to compute the IRR of both projects. We'll do IRR of project A now. So I enter CF at time 0, 75 grand negative. My cash flow at time 1 gets entered as 40,000 positive. Cash flow at time 2, 30,000 positive. Enter. Cash flow at time 3, 20,000. Enter. And cash flow at time 4, 10,000. Enter. And now I compute the IRR. I hit IRR, compute, 16.09%. So change my ink color here. IRR, 16.09%. And we'll also compute the net present value at 9% discount rate. By the way, we're expecting this to be positive because the IRR is 16%, the net present value discount rate is 9%. It's going to produce a positive net present value. Let's figure out what the net present value is, though. I go NPV. My discount rate goes in as 9. Enter. I hit the down arrow. I compute NPV, 9476. Okay, so project A, we've done parts A and B. Let's do the same for project B. Let's compute the IRR of project B. 75,000. Oh, sorry, let me, CF, second function, clear. So I just wanted to clear everything out that had been in there before. 75,000 negative goes in at CF at time 0. My cash flow at time 1 is 10,000 positive. Cash flow at time 2, 20,000 positive. Cash flow at time 3, 30,000 positive. Cash flow at time 4, 45,000 positive. And now I compute the IRR. So I go IRR, compute, 11.91%. So significantly lower for project B than project A. If I were using IRR, which project would I prioritize? Definitely project A would be my answer to part A. Assuming 9% required rate of return, compute the NPV. Well, we've done it for project A. Let's do it for project B. NPV, I put 9 in as my discount rate. I hit the down arrow. I compute NPV, 6052. So using NPV as a threshold, I like project A better. Also, NPV at 9%. So now the $1 million question, the whole purpose of this question was, a little bit of practice for net present value and IRR, but what is the discount rate where you'd be indifferent between the two? The way you figure this out, you subtract, you just figure out the differences between the two. So the 75,000 to 75,000, there's no difference there at the cash flow at time 0. 40 minus 10 is 30,000 positive. 30 minus 20, 10,000 positive. 20 minus 30, 10,000 negative. And 10 minus 45, 35,000 negative. We enter these all as cash flows, and we calculate the IRR of this, this will be our point of indifference. This will be where we're indifferent between the two options. So let's do that. CF, second function clear work. CF at time 0 is 0. Cash flow at time 1, 30,000. Cash flow at time 2, 10,000. Enter, I hit the down arrow twice. Cash flow at time 3, 10,000 negative. Cash flow at time 4, 35,000 negative. I compute the IRR. I hit IRR compute, 4.77%. Okay, now we can take a bit of a step back. What's happening here? Project B, if there was no such thing as time value of money, if our interest rates were 0, Project B returns us 30 grand, Project A 25 grand. We like Project B at 0. But we saw at 9%, we way preferred Project A. So at what point did we go from preferring Project B to preferring Project A? The answer is at 4.77%. So if the discount rate was 0, all the way up to 4.77%, we like B. From 4.77% onwards, we like A, all the way up to the point where A goes to its IRR. Anything above 16.09%, that's where the net present value of A is 0. Anything above that, the net present value of A is negative. We don't like it above that. We're not going to take either. So above 16.09%, from 16.09% to infinity, we would choose the option neither. Don't do any of these projects because they're money losers. So there we have it. We've answered part A, B, C. We've got the crossover rate of 4.77%. D says, calculate the range of discount rates where you choose Project A. There it is, 4.77 to 16.09. Where would you choose Project B? Everything up to 4.77. And where would you choose neither or reject both? Anything above 16.09%. We've done it. We've made it to the end. You survived. A challenging topic, crossover rates, but an interesting one. I hope the video helped. And if it did, I hope you'll help me with a thumbs up. Thanks for watching. See you in the next video. Bye for now. Let's examine problem 688. This has us doing lots of calculations. It's a great practice question because you've got to do payback period, you got to do net present value, you got to do profitability index, and you've got to do IRR, internal rate of return. This is a kitchen sink type of a problem, but it's a nice sort of summary problem for most of the things we've learned this chapter. So the question says, Vertex Business is debating between two projects. The company does not have the capacity to do both and must choose the best option or neither. The company's required rate of return is 19%. Cash flows for the projects are laid out in the table below. And the first thing we're asked to do is to compute the payback period, which is the simplest, I consider this back of the napkin calculation, where we just go, how many years does it take for this project to pay off? So this one that costs us $240, well, we make 110 up in year 1, so that means we're still at minus 130, right? Just negative 240 plus 110 is minus 130. Minus 130 plus 100. Okay, we're still $30,000 in the hole after 2 years, but we come out of the hole in sometime in year 3 because we go from negative 30 plus 80, we go to plus 50. So we can stop when we go positive. That's, you don't need to keep doing a running tally. So we took 1 full year to come out of the hole. We took 2 full years to come out of the hole, but we didn't take the full 3rd year to come out of the hole. We had 30 grand that we needed, and we made 80. So it took us a partial year, 30,000 divided by 80,000. It took us about 0.375 of a year. So the answer here is 2.375 years. That's how long it took us to pay back. 2.375 years. And this is project 2. Let's do project 1. I'll do it in blue ink. So again, we're 700,000 down. We make 90, so we're 610. down. We make 180, so we are, what is that, 430 down. We make 190, so we are 240 down. And then sorry, these are negatives. We make 800, so we are like 560 up. And that's where we go positive. So it's 1, 2, 3 years plus a partial last year. We had 240 to make. We made 800, so 240 out of 800 is 0.3. So it's 3.3 years for project 1. So what would you rather it take to pay back your project? 2 years or 3 years? 2.3 years or 3.3 years? You'd rather your project pay back faster. So definitely a check mark on the side of project 2, which is better, project 2 for sure. Okay, let's do net present value. Now, to do net present value, I'm not going to do by hand just because we've got our financial calculator, but I'll show you how to do it by hand. I'll show you the calculations I would do for project 2. So you divide. So you got to discount your cash flows. That's the thing with a payback period. There's no discounting of the cash flows. So that's why we call it back of the napkin math, because it's rough work. But here, this 19% discounted cash flows, right? It's our required rate of return is big here, 19%. It's going to make a huge difference. So you divide, to discount the cash flows, you divide by 1 plus the discount rate, 1.19, to the power of however many years you want to discount the number. In this case, it's 0. 1.19 to the power of 1, divide by 1.19 to the power of 2, divide by 1.19 to the power of 3, and divide by 1.19 to the power of 4. Now, 1.19 to the 0 is 1. I'm not going to do these all by hand. 1.19 to the 0 is 1, so 240,000 negative divided by 1 is 240 negative. You don't need to do that step, right? I just was showing you how it works. So there's our cash outflow. I'm going to just do the present value of all of these cash inflows in the financial calculator. You can just do it, like you can add them up, and do the math, add them up. I'll do it in the financial calculator, save us all some time. So cash flow at time 0, I'm going to just put in as 0 because we've already dealt with it. Cash flow at time 1, 110. Enter cash flow at time 2, 100. Cash flow at time 3, 80. And cash flow at time 4, 70. So I'm going to compute the net present value. My discount rate is 19. Hit the down arrow, hit compute, 245, 433. Now, again, you could have done this by hand, and you could do it all in one step. The reason I've separated it into 2 steps is having the inflow and the outflow is really useful for profitability index, so I'm sort of thinking ahead to part C. You could have put all the numbers in here and NPV'd it, and you would have got 245 minus 240. You would have got 5433, which is our net present value. 5434. Sorry, this is a 4 because I should have rounded up. 5434 is our net present value of the project. The present value of the cash inflows minus the present value of the cash outflows. Let's do the other side. So I'm just going to do the inflows again because it's useful for profitability index in a minute. So let me clear my work here. Cash flow, second function, clear. So cash flow at time 0, I'm not dealing with. Cash flow at time 1, 90,000. Cash flow at time 2, 180. Cash flow at time 3, 190. And cash flow at time 4, 800. All right, so NPV 19 is my discount rate. Hit enter, down arrow, compute NPV 714,424. 714,424. That is my present value of the cash inflows. The present value of the cash outflows is negative 700. So what's the net present value? Just combine them. It's 14,424, right? 714 minus 700 is 14. 14,424. So a pretty big win for project 1, leaving me better off here. Okay, compute the profitability index of each project. Now, because I split out my calculations the way I did, this is easy. You just divide the inflows divided by the outflows. So divide 245 by 240, divide 714 by 700. So let's do the 714 divided by 700. 1.021. 1.021. So that's for part C. And 245 divided by 240. 245,434 divided by 240,000. 1.023. 1.023. Okay, so what would you prefer? Well, it's close, but definitely Project 2 is slightly better than Project 1 as far as profitability index goes. Next, we do IRR. So we're going to enter our cash flows again. Now, if I could do a shortcut and sort of use the ones that are in memory, but I've cleared my memory to do this from scratch. I'll do Project 1 first. 700,000 negative is my cash flow at time 0. So I do enter my time 0 cash flows here. Cash flow at time 1, 90. Cash flow at, and this one, there's no way to do it by hand. All the other ones I could have done by hand just as easily. It would take me 2 more minutes or maybe 5 more minutes, but you can definitely do it. This one you just can't do by hand. Well, it's not easy to do by hand. Let's just put it that way. Cash flow at time 2, 180. Cash flow at time 3, 190. And cash flow at time 4, 800. And now I compute the IRR. So I hit IRR, compute. I get 19.77%. 19.77%. And that's my answer to D. And by the way, the fact that the required rate of return is 19, this is 19.77, we'd say this is a project you can go ahead with. And that should be clear because it had a positive net present value. Okay, I'm going to re-enter some cash flows, so clear what's in there. And I'm going to enter the cash flows for Project 2, 240,000, negative, enter. Cash flow at time 1, 110, enter. Cash flow at time 2, 100, enter. And remember, the F that I'm sort of skipping past is frequency. And because these are cash flows that only occur once, the frequency is 1, and that's the default. So I'm just skipping right past it. 80,000 for cash flow at time 3, and 70,000 for cash flow at time 4. And then I go IRR, compute, and I get 20.28%. 20.28%. So who's the winner here? Well, it's definitely Project 2 is the winner here. So this is a weird question, and it's framed kind of weirdly too. If we trust all these numbers as being equally true, and you know, if there's 100% chance that this is all going to come to pass, because we're predicting the future here, believe it or not, based on my answers above, I would choose Project 1. That's how powerful net present value is. How much money are you making, right? And if the answer is, well, these are mutually exclusive projects, I can only do one at a time, maybe it's my staffing capabilities or my personnel, I would say, do the one that makes you the most net present value. So that's how powerful net present value is. That's why it's such a fundamental corporate finance concept. Despite the fact that the payback is slower, the profitability is slightly lower, the IRR is slightly lower, it's a riskier project, but I would still say if these numbers are trustworthy, I would pick Project 1. So a little bit weird, right? There's 3 check marks on this side. There's only 1 on that side. It shows you how powerful net present value is. Hard to go against net present value. You would need really good reason to, and this question hasn't given me sufficiently good reason to go against it. I would pick Project 1 because it offers a higher net present value. Simple as that. All right. Thanks so much for watching. If this video helped, as always, you really do help me by hitting that thumbs up button. It tells the YouTube algorithm I'm doing good work, and I hope it's good work. Anyway, thanks for watching. See you soon. Bye for now. Let's jump into Module 7, a module on project analysis. So this module brings to bear a lot of what we have learned so far. And it builds on the last chapter. The key concept from the last chapter was net present value of future cash flows to determine if a project is worth doing. Well, what's project analysis? We're determining if a project is worth doing. So what's different between this and last chapter? The difference is this chapter, we have to calculate those future cash flows. They won't just be given in the question. We got to do a bit of work from company financial statements or projected financial statements, what we learned in chapter 2, and calculate cash flow. And we actually learned to do that in chapter 1. So a lot of modules sort of coming together in this chapter, but there is one new concept, and that new concept is frequently confused because it's counterintuitive and confusing. So I wanted to introduce the new concept in this video, and that concept is called the tax shield. And you will have heard this if you've worked through problems in a corporate finance class. The phrase tax shield comes up all the time, and it's something that at least I struggled with, and sometimes I see students struggling with, so I wanted to introduce it here. If you feel good about the tax shield, just skip ahead and go on to like some examples from the chapter. But if tax shield is something you haven't heard of before, or it's something that maybe you have heard of and it confused you, I hope I can bring some clarity to the situation. I'm going to try. We'll see if I bring clarity to the situation. So I wanted to prepare two income statements. One is the company's actual income statement. The green one there is a thought exercise I want to go on, and this thought exercise will help me explain the concept of the tax shield. So again, this is a pretend company. This is a pretend income statement, and some of the assumptions are pretend, right? Like revenues, all cash. Well, not all revenues are always all cash, but for our example, okay, because we're finance folks, we're interested in cash flow. I want to make it as simple as possible. Our revenues are all cash. Our costs are all cash. Depreciation is not for cash, and you can see income taxes are indeed for cash. So if I just look at the cash items here and look at the cash flow for this company, it's 100,000, that's cash. 70,000, that's cash. Okay, depreciation non-cash. The subtotal's non-cash, but tax is cash. So if I just go revenues minus costs minus tax, I get $27,000, and I would say, okay, my cash flow is again 100,000 in, 73 out. I'm at 27 in cash flow. So the cash this company generated this year would have been plus 27,000. You could calculate that any number of ways, right? We've done a lot of operating cash flow calculations before in this class, and there we have it. We've arrived at cash going up 27,000. Now, as a thought exercise, what if, let's pretend there's no depreciation in this company. Everything else is the same, but this company does not have depreciation. All right, so if we don't have depreciation, we're more profitable. Our net income, as you can see here, is like significantly higher, right? $14,000 higher because we don't have depreciation. So 100 minus 70 is 30. We do pay 30% tax. So $9,000 in tax. And that brings us down to 21,000. Let's look at cash flow now. So let's look at the items composing our cash flow. So something that I would think is, okay, well, without depreciation, I'm more profitable. That's good. I would think, yes, having low depreciation is good. But from a cash flow perspective, depreciation, even though it's an expense, is good for cash flow. Depreciation makes cash flow go up, as we will soon see. So let's look at our cash items. So revenues, all cash, 100 grand, costs 70 grand. So 100 minus 70 is 30. Taxes are 9. So in fact, this whole income statement was just cash flow. Our cash in scenario 2 was plus 21,000. 100 minus 70 minus 9 is 21,000. So why would that be? I had fewer expenses here, right? $20,000 fewer expenses, and yet my cash situation is worse because I eliminated the depreciation. Well, depreciation shields us from tax. It's an expense that doesn't involve cash, so it makes your net income go down. in making your net income go down or your taxable income go down, that reduces your tax bill, which is a cash expense. And you can see the difference in taxes there, 3 to 9, it's $6,000 different, and that's the difference here. So how do I calculate my tax shield? I just go 30%, the tax rate, times the depreciation amount, which is $20,000. The tax shield here is $6,000. So depreciation shielded us from $6,000 of tax. That's what the tax shield is trying to say. It is, at least for me, something I have to twist my mind to come to, but the best way to learn any of this stuff is to do lots of examples, and I've got lots of examples waiting for you in this chapter. So stay tuned for the next video. Bye for now. Gotta find the stop button. Where's my mouse? Bye for now. In this video, we're going to work on a problem you can download from tonybell.com. Go to the website, click the PDF link, and you'll notice there's no sign in, no sign up. The PDF just pops right up. You'll scroll down and find whatever problem it is that we're working on. As you scroll through the problems, you'll notice many are free and open, like the one you're watching now, but some are members only. I think the free and open ones are enough for most people, but if you can't get enough of me and you'd like to join and get access to those members only videos, click the join button underneath the YouTube play box. All right, thanks so much for watching. Let's get started. Let's have a run through problem 7.1a. We're going to use accounting information to compute cash flows, specifically operating cash flows. The skill we learn in this video will be used all through this chapter, so it's a very important video. Let's jump into it. Consider a potential project with the following information: sales, costs, depreciation, and a tax rate. We're asked first to prepare an income statement, and then, this is the key one, to use that income statement to compute operating cash flow. So let's prepare an income statement with the information we have. We're given the sales, so that's generally the starting point of most income statements. Now, something kind of fake in this question is it gives costs, where a typical income statement will have those costs broken out. Cost of goods sold, selling and administrative expenses, these types of things will be broken out separately. This one lumps them all together as costs. $120,000. So sales minus cost of goods sold would be gross profit. Sales minus our costs is like our income before, other expenses like depreciation and interest and taxes. And in finance, we call that EBITDA, EBITDA. And so what comes after that? Depreciation. So let's take out our depreciation. $30K, and that leaves us with EBIT of 50. Now, in this chapter, we are going to exclude interest from most of our analyses. The reason we exclude interest is we're thinking about the cash flows of some future project that our company's getting into, and we don't want to consider interest. And the reason is because we want to consider the project on its own merits. So if we're taking interest out, well, that's not the project's fault we had to borrow. So, you just want to figure out what's going on with the project. You can worry about the interest later in future calculations, but just looking at the project, analyzing a project, don't consider interest. So that's a rule of thumb. It's not a hard and fast rule. Some companies will consider interest, but in our class, we're going to ignore the effects of interest. So EBIT is $50,000. We're going to ignore interest. So then we just deal with taxes because we're not going to have any interest. So taxes are 20%. $50,000 minus 20%. Well, 20% of 50 is $10,000. Our net income, our profit here, is going to be $40,000. Now, profits are not cash flows, but we've solved part A, right? This is the answer for A. Cash flows, though, are calculated a little differently. So I've got a little formula down here for part B. Let me drag it up. So here's how we're going to calculate our cash flows. In this formula, we're going to use throughout the chapter. So it's one worth either memorizing, or if you get a formula sheet, putting it on that formula sheet. Operating cash flow equals EBIT plus depreciation minus taxes. We just look at this income statement. We go, what involves cash or what doesn't involve cash? And the key thing that doesn't involve cash is depreciation. So we want to exclude it from our calculation. So we start here with the EBIT. We say, wait, we shouldn't have taken out depreciation, so we add it back. But we do need to take out taxes because they do involve cash, and those are part of operating cash flows, so we'll take that out. So that's the formula. Start with EBIT, you take out your depreciation, you add back. You add back your depreciation, you take out your taxes. Let's do that. 50,000, add back depreciation plus 30,000, take out taxes minus 10,000. Now, you may look at this and go, I could do this several other ways, and there are several other ways you could find your way to a correct answer. This is the standard way to do it, though, and as things get more complicated, this is the better way to do it. So you might think, oh, I've got a shortcut to do this, and you could come up with a shortcut and get the right answer. I would advise you just to do it this way, and it'll serve you well. So 50 plus 30 minus 10 is, let me do the math, 70. So that is our operating cash flow. And that would go into calculations, right? When you're sort of saying, well, the value of the project is the present value of future cash flows. In previous questions, we just gave you the cash flow. From now on, you're going to have to come up with it, and that's how you would come up with it. Okay. Other questions will require you to use something called the depreciation tax shield to come up with the operating cash flow. So that's what this is sort of training us to do. So the first thing is, what's the depreciation tax shield? It's how many dollars worth of taxes are saved because we have depreciation. So remember, depreciation is non-cash. So there's no negative $30,000 in cash flow as a result of depreciation. And in fact, it reduces our taxable income and it reduces our tax bill. So depreciation saves us money, kind of counterintuitive. Depreciation is going to save us, a $30,000 expense on the income statement, but it saves us $6,000 in cash because it saves us $30,000. It reduces our taxable income. We pay 20% tax, so 30,000 times 20% is $6,000. That's our tax savings as a result of depreciation. Let me show you in the formula. I feel like I got a little bit over my skis there, but I think this will make it pretty clear. Our tax shield is just the depreciation times the tax rate. In this case, 30,000 times 20%, which is $6,000. That's how much tax savings there are because I get to deduct depreciation. And again, depreciation is non-cash, so it's actually cash savings. It's a little counterintuitive, right? It's an expense, but it actually saves you cash. A little bit weird to wrap your head around. Okay, part D says, using the depreciation tax shield, the thing we just calculated, recalculate operating cash flow. So we call this the tax shield approach to calculating cash flow. We already calculated it, $70,000. We're going to do it a different way. And the reason we want to learn to do it a different way? Simple. Some of the questions we're not going to have enough information to do it the straightforward way, the standard way. So we'll have to kind of work backwards. Here's how you do it. Here's the formula. Sales minus costs. So 200,000 minus our costs, which again are like cost of goods sold, selling and admin expenses, research and development, these types of costs. So 200 minus 120, $80,000, times 1 minus the tax rate, times 80%, 1 minus 20%, so it's times 80%. Let's just do the math here. $80,000 times 80%. $64,000. Okay, so again, we've calculated the number. What kind of does it mean? Basically, it's saying, well, let's take our sales minus our cash expenses and say, what if that was what I got taxed on? How much money would I walk away with? Just basically like a cash income statement, cash items only. So if I looked at my cash items only, I would end up walking away with 64 grand. I would have made $80,000 and then I would be taxed $16,000. So I would walk away with $64,000. However, because depreciation is a thing, if I'm looking at this cash only, I ignore depreciation, but depreciation saves me money. How much does depreciation save us? $6,000, the amount of the tax shield we just calculated. So it's 64 plus we save $6,000 because of depreciation. So we walk away with $70,000 as our operating cash flow. Same answer as we got up there. Again, we're calculating the same thing two different ways. You don't generally have to do that. You just calculate it one way and you use that number in your calculations. But there will be problems where we just use B, the most straightforward standard way of doing this. And there will be problems where we don't have enough information, and so we have to use the formula in D, and therefore we have to come up with our tax shield. So there we go. 718 sort of sets the table for a lot of future calculations this chapter. As always, thank you so much for watching, and if you made it to the end, I hope you'll give me a like. Have a great day. Bye for now. Let's take a run through problem 7.3a. We're asked to calculate operating cash flow as well as net present value of a project. Your company is considering a 4-year project that involves the purchase of a fixed asset for $2 million. The company will use straight line depreciation, will depreciate the asset to zero over the next 4 years. And the company does not expect to be able to sell the asset once the project is complete. Okay, well, a little bit of math here, right? We have a fixed asset, $2 million. We're going to depreciate to zero over a 4-year project, means it's $500,000 in depreciation per year. Okay, so that's just bubbling around in the back of my mind. The project will generate annual sales of $1.4 million and have annual costs of $750,000. The tax rate is 20%. First, it says compute the OCF of the project. Well, to do it, I want to do one of those pro forma income statements just based on what I've got here. So my sales, and this is just a useful sort of thing to do, $1.4 million minus those cash costs, so cost of goods sold, selling and admin expenses, maybe research and development costs. The total of those cash costs is $750,000. So 1.4 minus 750 is 650. That's my EBITDA, my earnings before interest, tax, depreciation, and amortization. We'll take out our depreciation to get EBIT. Our depreciation here, $500,000, we just calculated that. So our EBIT is $150,000. Now again, we do not consider interest in these calculations. We want to evaluate the project on its own merit, taking interest into account. Just, that's not about the project. That's about how we funded the project. So we consider that separately, but in just looking at the project, analyzing the project, don't consider interest. So the only thing left to consider then is taxes, which are 20%. 20% of 150 is 30, landing us with net income from the project of $120,000. There we have a pro forma income statement, but we haven't answered any part of the question. That's a useful thing to do, though. You should do this if you can with the information given to you in your questions. It's good practice to have one of these, and then when you work from one of these, it's easier. So it says, what's the OCF, operating cash flow? Well, we recall OCF, the easiest way to do this, the standard way to do it. Take EBIT, you add depreciation, which is of course included within EBIT, but it doesn't involve cash, and you deduct out taxes. So for us, EBIT is 150. Depreciation, huge number, 500. Taxes are 30. So 150 plus 500, 650 minus 30 is 620. Okay, so 620 is the OCF of the project. If the required rate of return of the project is 9%, what's the net present value? Okay, so let's think about the project on sort of a yearly cash flows basis. So at time zero, year zero, I got to buy a $2 million asset. So as year zero, time zero, oops, not 200,000, $2 million in negative cash flow. Year one, YAR one, I'm just going to Y1. I almost said Y, wrote YAR. Y1, what's my cash flow in year one? It's plus 620. Year two, plus 620, because this is my annual cash flow from this thing. Year three, plus 620. Year four, plus 620. Now, as we contemplate this, other things that would be bubbling in my mind is like, okay, what if I can sell the asset at the end? Well, there'll be some positive cash flows from salvaging that. What if there's a working capital requirement? You know, I got to tie up some short-term inventories or something like that, tie up money in short-term inventory. Well, there'd be a cash flow associated with that. And we'll deal with that in part C. But in part B, there's none of those complications. It's just like you spend $2 million to collect $620 per year for the next 4 years. What's the present value of that? So it says, if the required rate of return is 9%, what's the net present value? All you're going to do is divide by 1.09 to the, how many years are we discounting? In this case, 0 years, 1.09 to the 1, 1.09 to the 2, 1.09 to the 3, and 1.09 to the 4. Oops. Superscript that to 4. So there we go. You would just run those numbers, add those up, and you would get the net present value. Because I have a financial calculator, this will be quicker in the financial calculator, but you should get the same answer if you do it by hand, and this is very doable by hand. I'm going to enter these cash flows into my financial calculator, though. My cash flow at time zero is $2 million negative. Enter. My cash flow at time one, 620 positive. Enter. And I hit the down arrow and it says, what's the frequency? Well, actually, I can use this. 4. I have 4 $620,000 payments, and that's it. So then I go NPV. My discount rate is 9. I hit the down arrow, NPV, and it's asking me to compute. I hit the compute button. 8626.3, 8626. So the present value of all these payments is positive 8626. Okay, so if you have a positive present value, you should do the project. So this is a project worth doing, right? It's on our list, and we're not going to delete it from our list. The NPV is 8626. Let's do it. Now, again, I could solve it by hand. In fact, when we get to part C, I'll do it in the financial calculator first, but then I'll just show you how to do it by hand. It's not complicated. Okay. Let me just copy this. Well, let's read part C, and then I'll worry about copying it later. Part C says, assume the project requires an initial investment in net working capital. Sorry, I looked at myself all like my finger on my chin. I don't know. Sometimes you catch a glimpse of yourself and you feel like you look weird. I look weird all the time. Assume the project requires an initial investment in net working capital of $200,000, and the fixed asset can be sold for $250 at the end of the project. Compute the cash flows for each year of the project and compute the net present value. Okay. So we've done this cash flows for the 4 years of the project. I'm just going to copy it and move it over here in case I need it again. I don't think I'm going to need it again, but I just want to not lose those numbers because I want to adjust this. So let's look at this project again. And here were the cash flows. I'm going to erase this stuff. Here were the cash flows from the initial version of the question. Now it's just saying we're going to add a couple of wrinkles. So I'll do this in a slightly different color of ink. So it says, assume the project requires an initial investment in net working capital of $200,000. Okay, so we're going to have to pony up $200,000 more money, probably tying it up in inventories or something like this, right? We need $200,000 more, not just to buy the asset, but to invest in something else. Now, if it is that, at the end of the project, we actually get back the $200,000 because I'm not going to have those inventories any longer. My money's not going to be tied up. The project's over. So we get a $200,000 positive cash flow at the end. What else happens here? The fixed asset gets sold for $250. Well, remember, we experience a gain on this sale because we depreciate it down to zero. We think the asset's worth zero, but if we sell it for $250,000, we have a $250,000 taxable gain. Gets taxed at 20%, meaning there's $50,000 in taxes. So I get $250,000 from selling the thing, but I lose $50,000 in taxes. That nets out to another plus $200,000, right? So $200,000 flows in, $250,000 flows in, but then I got to pay $50,000 in taxes. So I got to consider those as future cash flows as well. That's it though. That's all I need to do. So if I sum this up, I go, okay, I'm $2.2 million down at time 0. So divide by 1.09 to the 0th power. I'm 620 up at the end of year 1. I'm 620 up at the end of year 2. So I'm just going through the discounting method. So that's 1.09 to the 1, 1.09 to the 2. 620 up at the end of year 3, 1.09 to the 3rd power. And I am, I'm going to have to use a calculator here, 620, clear. 620 plus 200 plus 200. Actually, I could do that in my head, but we're here now. So plus 200 is 1020 plus 1020 divided by 1.09 to the 4th power. Okay, so there we have it. Now we just need to run those numbers. I'll do it in the financial calculator first. That'll be the end of the question. And then I'll show you how to do it by hand for those that want to stick around. But let's do it in our financial calculator. So I go CF. I've got some old cash flows in there. I go second function clear work. And then I just try it again. CF 2.2 million negative, enter down arrow, cash flow at time 1. I'm going to do these ones individually. I think I could do a frequency 3 here because there's 1, 2, 3 of them. I'm antsy about screwing this up. I'm 10 minutes into a video, so if I screw it up, I wouldn't be happy with myself. Cash flow at time 2 is 620. Cash flow at time 3 is 620. And cash flow at time 4 is 1020. Enter. I just want to go up through them, make sure I didn't misclick anything. Cash flow at 1. Yeah, so cash flow at 0. Okay, there we go. Let's go ahead and calculate the net present value of those cash flows. So I go NPV. Our discount rate is still 9. Hit the down arrow, hit compute, and I get 91,996. 91,99. Actually, let me do it down here because we're going to be calculating these in a second. 91,996. That is the net present value of part C. We've solved the problem. So if you got to this point and you're using financial calculator like me, terrific. That's it. Go ahead and hit the thumbs up button and get on out of here. If you're sticking around, why don't you hit the thumbs up button anyway? It feels good to do. You're doing me a favor and I genuinely appreciate it. So let's go ahead and solve the rest of this by hand. We're just going to prove that this does equal 91,996. And if I wasn't gifted or didn't have, gifted is the wrong word, given the ability to use a financial calculator, right? If your professor says no financial calculators, you can do it by hand and it's not hard. So all we do is calculate it out. 2.2 million negative divided by 1.09 to the 0 is just divided by 1. So divide by 1, oops, and it's 2.2 million negative. 620 divided by 1.09 to the power of 1, so divide by 1.09. 568,807. Because I'm rounding here, you can see there's pennies. We might end up off by $1 or $2 at the bottom of this. This is the correct answer, but we might end up off $1 or $2, but who cares? 1.09 squared to the power of 2. I just go 1 over x times 620. I get 521,842. 521,842. 1.09 to the 3rd power. X3, you go 1 over x times 620. 478,754. And 102 divided by 1.09 to the fourth, 1.09 to the power of 4. 1 over x times 102,000. 722,594. 722,594. Now we just add up this list of numbers. Negative 2.2 million plus these 4 numbers. And we hope that we get the right answer. 2.2 million negative plus 568,807 plus 521,842 plus 478,754. And last but not least, we add 722,594. And we get, dun 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 dun, drum roll please, 91,997. So we were off by $1 as predicted. This number is more accurate, but at the end of the day, we're predicting cash flows 4 years out. So being off by $1 is not the craziest thing in the world. Okay, you made it to the end of 738. Now, if you really did make it to the end, smash one of those buttons. Unless you hit it before, then don't hit it twice. But thank you so much for watching. Have a great day, and I'll see you in our next video. Bye-bye. Let's examine problem 7.5a. The first 2 parts of this problem are straightforward. We've done similar problems to them before. 7.4 is very similar, but part C is like a level of difficulty higher, significant step up in difficulty because it's an algebra puzzle to be solved. Let's do parts A and B, and I think you'll find pretty similar. If you got 7.4, no problem. Part C, though, a little bit more difficult. Let's jump into it. Your company is considering purchasing a new piece of equipment that will significantly increase efficiency and reduce costs. The equipment costs $400,000 and it will be depreciated using the straight line method to 0 over its 4-year life. So, okay, $400,000 piece of equipment. It's going to 0 and it's going to do that over 4 years. That is $100,000 per year in straight line depreciation, which of course is a number that's going to come in handy for us. The equipment will be sold for $20,000 at the end of 4 years, and the reason for the purchase is because it will reduce other costs by $130,000. So it doesn't increase revenue, it just makes us run more efficiently, reduces costs. So similar to 7.4. Per year, and will reduce working capital needs by $40,000. That's a first. Most of the time, we enter these projects and it increases working capital. This one decreased the working capital, which is good for cash flow in the short term. The company's tax rate is 20% and the required rate of return, the discount rate, is 10%. Should we accept the project, we'll use NPV, net present value, to figure out if we should accept the project or not. And to get to NPV, we got a bunch to do. We got to do a pro forma income statement is a great starting point. So how does this project affect sales? It doesn't. No change in sales. How does it affect costs? Well, if successful, costs are actually reduced by $130,000. So a reduction in costs means earnings before interest, taxes, depreciation, and amortization, EBITDA, should go up by $130,000. That's, a savings, right? What about our depreciation? Well, our depreciation is also going up by $100,000, meaning our EBIT leaves us $30,000 better off. Earnings before interest and taxes is up 30. Well, interest is not considered here, even though we may be borrowing money. Interest would be considered in a future calculation. For this, though, we're looking at the project on its own terms. We're not considering interest because that's a financing option, right? That's not really intrinsic to the project. If you could finance it with your own cash, you don't pay any interest. Does it mean it's a better project? No. So, okay, EBIT is 30, so we ignore interest. If there was any, there's none mentioned here, but we have to deal with taxes. Taxes are 20%. 20% of 30,000 is 6,000, leaving us net income of $24,000. Okay. Well, remember, if we're doing net present value, we need the cash flows here. So we go from our income statement to operating cash flows. And a way to calculate operating cash flows that we've been doing, standard way to do it, EBIT plus depreciation minus taxes equals OCF. So here's our little operating cash flow calculation. Our EBIT here, just taking it off that income statement, $30,000. Is that visible? It's hard for me to tell. I think it is. Depreciation, we add 100,000. Take away taxes, take away 6,000. And 30 plus 100, 130 minus 6 is 124. Okay, our operating cash flows are 124, and it's just savings, right? We're saving money. It says 130 grand, but in cash, we're actually saving 124 grand each year. So what does this look like? I always like to draw a bit of a timeline. So year 0, what happens? Well, I got to buy an asset, buy $400,000 worth of equipment. That's negative cash flow. But I also save on working capital. This reduces working capital, which is good for cash flow. It's a plus 40,000 to our cash flow. Year 1, we just save our OCF, 124 grand, right? That's why we're doing the project. It's why I'm willing to put out 400 grand, is because I save costs as I go. Year 2, I save 124. Year 3, save 124. And year 4, I save $124,000. Okay, so those are my savings. Also in year 4, other things happen. 1, I have to get my working capital back to normal. The project's over. If the project was freeing up working capital, ending the project ties up that working capital again. So got to get the working capital reacquired. And the other thing is I get to sell the equipment. The equipment sold for $20,000. You know, and I know I don't get all $20,000. If I depreciated the thing down to 0, I'm going to experience a $20,000 accounting gain. It's taxable at 20%. So there's $4,000 in additional taxes. So I don't get all 20. I only get 20 minus 4. I get 16 of the 20 in terms of the equipment sale. Okay, that's it for my cash flows. So 400 minus 40 is 360. Negative. Negative 400 plus 40 is negative 360. 124 for year 1. 124 for year 2. 124 for year 3. And 124 plus 16 is 140. Minus 40 is 100 even. Okay. So now these are all my cash flows. I just present value it and decide if it's a good idea or not. So to present value, you just divide by 1 plus the discount rate to the power of however many years you're discounting. So our initial cash flow is 1.1 to the power of 0, which is 1. So it's negative 360 divided by 1. It'll be negative 360. This is 124 divided by 1.1 to the power of 1, 1.1 to the power of 2, divide by 1.1 to the power of 3, and divide by 1.1 to the power of 4. We could do this by hand. It would take a minute. I'm going to do it in my fancy financial calculator here. So I just enter cash flow, second function clear. So cash flow at time 0, 360 negative, enter. Cash flow 1, 124, enter. How many times did that one occur? 1, 2, 3. So I'm going to enter 3 as the frequency there. My next cash flow to be entered, that's not cash flow at time 2, that's just the next cash flow after the 124s, is 100,000, and it happened once. And there we have it. So we've done all of our cash flows. I'm going to say, give me the present value of that at a discount rate of 10%. Enter. Hit the down arrow, compute NPV. I get 16,671. 16,671. That is my net present value. It's positive. And so should the project be accepted? Yes. Accept the project. I'll just note that number here, 16,671 positive. That looks maybe like a minus there, so I put a plus beside it. Yes. Okay. So this was at an annual savings of 130. If the annual savings were 80, which is 50 grand a year worse, would you do it? And you can already just see the answer is going to be no way. It's going to be very negative net present value. But let's crunch the numbers to determine just how negative the net present value should be. So here's how I'm going to do this. I'm going to just erase. I'm going to leave everything up, kind of all the number, like all the, for example, sales costs, EBITDA, all the titles up, and I'm just going to erase the numbers and we're going to put new numbers in, but it's the same question, just with slightly changed numbers. So no point in erasing all the guides here. So I'll leave this all up. We have the number 16671, and again, you can just rewind the video if you want to go back to some number that was in there. I'm just going to erase all this. I'll leave the year 1, 2, 3, 4, and we can go again. So everything's the same except for this is not 130. This is 80, right? It's that number changes. Okay, so start from the start and we just do it again. Do it again at 80. The numbers actually come out a little weird here because we're going to end up negative numbers, as you will soon see, but it's fine. So our sales are unaffected. Our costs are reduced by 80,000. So our EBITDA is up by 80,000. Unfortunately for us, our depreciation is 100. So our EBIT is negative 20. This is our first time with a loss before interest and tax. Having a loss, having negative EBIT means we have negative taxes. Our taxes are 20%. So it's 20% of 20,000 is 4,000. But they're negative 4,000 in taxes. We get a refund. It reduces our tax bill from the rest of our business if we're losing money on this one, at least accounting wise. So we end up at negative 16,000. Negative 20 minus negative 4 is negative 16. It is weird operating in negative numbers, but that's what's happening. So in terms of OCF, our EBIT is negative 20. Our depreciation is positive 100, and our taxes are negative 4. So it's minus negative 4, right? We would subtract our taxes, so we're subtracting negative 4. So it's awkward construction here, but negative 20 plus 100 is plus 80, minus negative 4 is plus 4. So it's plus 84 overall. Again, minusing negatives, never a comfortable thing to do, but there you have it. We've done it. So what does this look like in terms of cash flows? Well, suspiciously similar to the last one. The only difference is this OCF. So the year 0 cash flows, still negative 400K, plus the 40 we save reducing our working capital needs. Year 1 plus 84, year 2 plus 84, year 3 plus 84, and year 4 plus 84, but minus the 40 of working capital that we have to reacquire. So again, we reduced our capital at the start. Project's over. The project that caused us to reduce our working capital, we're going to need to reacquire that working capital. Maybe we're carrying more inventory now or something like that. We also do exactly the same calculation for selling the asset, and it means we got 20 grand for it, but 4 grand went out in tax, so we get 16,000. From here is very much the same exercise as before. Minus 360 plus 84 plus 84 plus 84. And then 84 plus 16 is 100 minus 40 is 60. So this is plus 60. And same discounting as we did before. 1.1 to the 0, 1.1 to the 1, 1.1 squared, 1.1 cubed, and 1.1 to the 4th power. I won't do it in my I won't do it by hand, but I'll do it in my calculator, and we'll get the right answer here, hopefully. Let me clear what was in there. Second function clear. 360 negative is my cash flow at time 0. My cash flow number 1 is 84,000 positive. The frequency on that is 3. There's 3 payments of that amount or 3 cash flows of that amount. And my second cash flow is 60,000. My second unique cash flow is 60,000. I only have one of those. Let's compute our net present value. Our discount rate is 10. Hit the down arrow, hit compute, and we get 110,124. And it's negative. So this is a money loser, and we suspected it would be. It was negative 110,124. Would you accept the project? No. Okay. So let's just a bit of a step back here. At $130,000 per year in savings, lost my mouse, at $130,000 a year in savings, this was a great project. We made some money. At $80,000 a year in savings, this was a bad project. The third question, by far the hardest, so if you're struggling so far, buckle up. This is harder step. It says, at what level of savings would you be indifferent as to whether or not the project should be accepted? At what level of savings would you be indifferent as to whether or not to accept the project? Okay, I'm going to erase something. I'm actually going to leave a few things up here, but I'm going to erase this. Again, you can just rewind if you need some of those numbers back up. I'm going to erase that. I'm going to erase these. Actually, why not just erase the whole thing? And the only things I wanted to leave up were the ones that didn't change. So the negative 400 and negative or 40 and what's down here doesn't change between the two. So what is this asking? It's saying, at what level of savings would we be indifferent as to whether the project would be accepted? Well, what's the net present value where we are indifferent? What's the net present value where we go, oh, I could take or leave the project? That would be when net present value equals 0. We are indifferent. So we're looking for NPV to be 0. So we just did a present value on this information, but what we're missing is the savings, the operating cash flow, which is driven largely by the savings. So if I could figure out what is the operating cash flow, and remember, those were the same amounts. In the first part, they were like 124, 124, 124. In the last problem, or the last version, part B, it was 84, 84, 84, 84. So they're all the same amount. So I'm going to just say there's one variable to be solved for. Let's figure out what that X needs to be to make net present value 0. Now, how do I do it? Well, I know that I got to put out $360,000, just adding those two together, right? Negative 400 plus 40 is negative 360. And I can take the present value of these two as well. Negative 40 plus 16 is negative 24,000. Let's present value it up to there. So you just divide by 1 plus the discount rate to the power of the number of years you want to discount it, 1.1 to the 4. So 24,000 divided by 1.1 to the 4 to get that present value. And the idea is we just want to get the X's alone if we could, right? That's sort of, again, I mentioned this is a challenging algebra question. It's challenging for me. You might be seeing that in my explanation. But anyway, well, let's get the X's alone. 1.1 to the power of 4, 1.461. We hit 1 over X. We multiply by 24,000 negative 16,392. And so that goes up here, negative 16,392. So we've moved those out of this section. So the payments that we're aware of, or the present value of all the stuff that we already know, is negative 376,392. That's just negative 400, positive 40, and now 16,392, the present value of the other year 4 stuff. Okay, so if these are negative 376,392, and I want net present value to be 0, it means the present value of these X's has got to be positive 376,392. And what we have is a pretty straightforward annuity, right? Year one, this positive cash flows plus year two's cash flow plus year three plus year four has got to have a present value of 376, 392. We can solve for an annuity. I could do this by hand, right? There's present value of an annuity formula, and we're solving for the payment amount, the regular payment amount. But I've got the financial calculator here, so I'll use it. And I'm just going to fill in information. So what is my N? My N is 4 years. What is my IY? Well, that's the discount, right? It's 10%. What is my PV? Well, we've just said the PV's got to be 376, 392. Because the present value of the other stuff is negative 376, 392. We want it to work out to 0. So 376, 392 positive. PMT, we don't know. That's what we're solving for. And our FV is 0. Okay, so let's figure out what that payment amount is. 4 goes in as our N. 10 goes in as our IY. PV 376, 392. And 0 is our FV. Now we compute the PMT. I get 118,741. 118,741. That is my operating cash flow. That is the OCF. 118,741. Now remember, that's not our savings. Our savings is like up here. We got to go all the way back. So we're just stepping backwards through the problem. Unfortunately for us, we can't recalculate our taxes. We have our depreciation. Our depreciation is $100,000, but we can't recalculate the taxes. There's too many variables out there for us to figure out the taxes because we don't know our costs. Our cost savings, and our cost savings creates our taxes. So it gets awkward. The best way to do this is to actually use the other formula we learned this chapter for calculating OCF. I told you this was challenging. So if you look back to problem 7.1a, you'll see we calculated OCF both the standard way, that's what we're doing here, and we also did it the tax shield approach to calculating OCF. And let me just remind you how the tax shield approach works. So tax shield approach. The tax shield approach, I can already feel I'm 20 minutes deep in the video and we're like, going back to an old problem, it's a stretch. This is a challenging problem, no doubt. So I hope you're up for it. If you're hanging in there, thank you so much for hanging in there. Okay, so the tax shield approach says, take our sales minus our costs times 1 minus the tax rate. And we add in our tax shield, and it's also called the depreciation tax shield because depreciation saves us some tax dollars. So first, let's calculate our depreciation tax shield, which we can do. It's $100,000 a year in depreciation. Taxes are 20%. Depreciation saves us $20,000 in taxes. So the tax shield, $20,000. Sales minus cost, that's an interesting one. Sales, we know are unaffected. We're going after costs here. That's what we want to know. So our sales are unaffected. Our costs, well, that's what we're solving for. Times 1 minus the tax rate. So 1 minus the tax rate is 20%. 1 minus the tax rate is 0.8. Plus 20,000 equals, and this is our OCF. We just calculated our OCF. We said our OCF is 118,741. It's what's in the calculator, 118,741. I know it's in there as a negative number. It's not negative operating cash flow. Just funny things happen as you use your financial calculators. Positive 118,741. Okay, so 0 minus costs times 0.8. So 0 times 0.8 is 0. I'm just going to get rid of the 0. Negative cost times 0.8 is 0.8. Negative 0.8 costs, just multiplying it in, plus 20,000 equals 118,741. Let's take away 20,000, 118,741 minus 20,000. is 98,741 equals 0.8 costs and negative 0.8 cost. So let's divide both sides by negative 0.8 divided by 0.8 negative. And I get negative 123,426. So costs equals negative 123,426. Okay, that's our answer. So I know we took a long journey to get there, but the question said, at what level of savings would we be indifferent as to whether or not the project would be accepted? We would be indifferent. Net present value would be equal if our cost savings was 123,426. If that said 123,426, our net present value would be 0. Whew. This was a big problem and a challenging one. If you got through it, good for you. Thank you so much for hanging in there with me. By the way, I'm going to end the video now. Well, I'll give you permission to leave now. I just want to prove it. I'm going to redo the problem one last time. Again, you don't have to stick around for this, but I'm going to redo it as if this number had been 123,426, and we're going to see that net present value is 0 or close to it. It'll be off by a couple dollars because it's 123,426.25, and I've missed a lot of decimals along the way. We're going to be close to 0 as our net present value. So let's try this one last time with 123,426 as our savings. We've solved the question. What level of savings? 123,426. Okay. Goodbye. This is just for my own fun. I know the things I do for fun, 25 minutes into a video, but 5 more minutes isn't going to kill me. I'd like to sort of see this one through. Okay, so if the question had said, we save 123,426, our sales unaffected, our costs are reduced by 123,426, our EBIT goes up by 123,426, our depreciation remains 100,000. EBITDA is 123,426. Our EBIT is 23,426, and our taxes here 23,426 times 20%, so times 0.2, 4,685. Our net income then 4,685 or 23,426 minus 4,685. By the way, if you can do this, you know these things inside out, right? Like it's challenging for me, and I've done a lot of these. So as a rookie, you should be pleased with yourself if you're getting through this, no problem. Very good chance you're smarter than me. But lots of my viewers are definitely smarter than me. Okay, 23,426 is our EBIT. $100,000 a year is our depreciation. Our taxes 4,685. So I'll subtract that and add that. So 23,426 plus 100 minus 4,685 equals 118,741. Oh, that's a good number. That's a number I remember from when we did this before. Oh, look at this. I think we're going to get it. I have a great feeling about this. Okay, so our cash flows still were 400 negative and 40 positive there, but our savings is 118,741, or our OCF rather, 118,741, 118,741, and 118,741. Oh, this is great. I'm pleased to see it's working. Negative 360 is our total here. 118,741 here. 118,741. 118,741, and the last one, 118,741 minus 40 plus 16 is 94,741. Okay, so again, we could present value this all by hand, divide by 1 plus the discount rate to the power of the number of years. We're not going to do that. I'm going to use my fancy calculator, CF, clear what's in there, CF. 360 negative, enter, down 1. Cash flow 118741, 118741. Enter down. Now we had 3 of them, 1, 2, 3. So I'll put 3 in as my frequency. Cash flow at time 2, 94741. Hit enter, and there's only one of those. And now I'm going to compute net present value. So I go NPV. It asks for the discount rate. It's 10. Hit the down arrow. Please work. Please work. Before we see if it works, just hit one of those buttons for me. It's good luck. It's going to be good luck. We're hoping for net present value to be 0 or close to it, like, $1, $2, under $10. I'm gonna take a W here. I'm gonna take a victory lap. I got to hit compute. Here we go. Compute. 0.67. Yes. It worked, everybody. It worked. Okay. That whole last 5 minutes was just for fun. If you had fun, thanks so much for watching. If you stuck around, a challenging problem, I think, part C. Parts A and B, totally reasonable. Part C, heavy lifting. But if you made it to the end and you lifted the heavy stuff with me, thanks for being here. Thanks for hanging in there. Have a great day. Bye-bye. Let's examine problem 77A, computing a bid price. This is a difficult problem. I find the algebra here to be a little bit tricky, a little bit confusing, but if you get lots of reps in, and my workbook certainly has lots of practice, you can get there. Let's go through it. Digico Gaming has put out a request for proposal asking for a company to supply it with 500,000 USB ports annually over the next 4 years. The USB ports are for use in their handheld gaming system. Your company makes USB ports, and the CFO has asked you to prepare a bid on the RFP. Winning this bid will require significant capital investments for your company, as there are some custom elements to the RFP. Your company will need to invest $2.1 million in fixed assets, and you'll need to increase working capital by $300,000. The fixed asset investment will be depreciated over the 4-year life of the project, down to 0. So if we have a $2.1 million investment that we're depreciating down to 0 over 4 years, that computes to, I think I can do this in my head. Heaven help me, I hope I'm right. $525,000 per year in depreciation. Okay, so I don't know if I'm going to use the number yet, but that is my depreciation, my annual depreciation cost. The assets will have salvage value of $250,000. Okay, so another little calculation we can do here, if we have a tax rate, which we do, is to say, what is my net salvage value? So if I depreciate the thing down to 0, I sell it now for $250,000. There's tax implications. I have a $250,000 recapture for tax purposes, which will be taxed at a 20% tax rate. So that's $50,000 in tax, meaning when I sell a $250,000 item and I pay $50,000 in taxes, my cash flow from salvaging this is going to be $200,000. Okay, so just, again, holding that number off to the side, that's just a number floating in the back of my mind at this moment. Your fixed production cost for the project will be $400,000 a year, and variable cost will be $1 per unit. And we're doing 500,000 units annually for 4 years. So, it's $500,000 in variable costs a year. So our fixed costs were $400,000. Our variable costs were not 900,000, 500,000, and it's just 500,000 units times $1 per unit. So 400 plus 500 is 900, and that is our total costs. Okay. Your company's required rate of return on the project is 10%, and as we said, the tax rate is 20%. So how to solve this thing? It's a lot of information, but it hasn't given us key information because we have to solve for it. It hasn't given us the price, right? What's our sales price? What's our sales going to be on this project? And the answer is, if we want to price the bid aggressively, we have to price it to have a rate of return of 10% on the project. So let's go through our cash flows and kind of see what that looks like. So here's what we know. In year 0, our cash flows are going to be the cost of investing in the new assets, and also the cost of tying up more working capital. So $2.1 million negative cash flow and a $300,000 negative cash flow. In year one, we're going to have operating cash flows of ? It's going to depend on how much we price the product at. So I'm going to call this X, right? We're solving for this. This is the variable we need to solve for to figure out our price. In year two, again, we don't know what our operating cash flows are going to be. Year three, we don't know what our operating cash flows are going to be. Year four, we don't know what our operating cash flows are going to be. But at the end of 4 years, we do have some cash flows that we do know what they're going to be. This was an X. It's the ugliest X of my life. It's you have to you have uniquely messy handwriting when you can't write an X. Very neat. It's a challenge of my life. I write on computer screens for a living, and my handwriting's messy. It's, I don't know, a terrible irony or curse or something. Let's continue. So what cash flows do we know in year four? We know that let's see, we needed to increase our working capital by 300. Well, we get that back at the end of the project. We no longer have this special project, so we no longer have this working capital set aside. We might take on new projects, but we'll deal with those at that time. And the other thing is we're going to salvage the asset, and we said salvaging the asset is going to give us $200,000 in positive cash flows. Okay, so our first step towards solving this is solving for X, which is our OCF, our operating cash flow. So let's try to figure out what our operating cash flow needs to be in order to meet our 10% required rate of return. How do I do that? Well, the first step is kind of a weird one. We'd like to figure out what these lump sums are. In other words, we just want to clear them off the table here. And how do I clear them off the table? I put them into year $0. And then this just becomes an annuity, right? It's an annuity where we don't know the annual payment amount, but it's the same payment every year. So clear these off the table by discounting the cash flows. Like, that's what we do here. We discount cash flows. Let's discount the cash flows that we're able to discount. So this is $500,000 in cash flow in year four. So we go 500,000 divide by 1 plus the discount rate, which is 10%, 1.1 to the power of 4. And whatever number we get there, we will write at the top. So 1.1 to the power of 4 is 1.461. Look at this. I did something funky with my graphics here. Interesting. Anyway, 1.461. I go 1 over X and I multiply by 500,000. 341,507. Okay, so this is a positive cash flow, 341,507 in today's dollars. So again, we're trying to set net present value to 0. This is sort of the minimum, the most aggressive bid price. That's what we're going for here. And we could certainly bid higher than the most aggressive bid price, but we would never want to bid lower. It would result in a negative net present value. But an appropriate bid price is the most aggressive. We'd like to win the bid. So negative 2.1 million minus 300,000 plus 341,507. Let's figure out what that adds to. 2.1 million negative minus 300,000 plus 341,507 gives us 205,843. 205,843. Don't forget the negative. And okay, so that's the present value of our year 0 stuff as well as the year 4 stuff that we knew how to present value. And what we need to say is we want net present value to be 0. So the sum of these 4 cash flows need to add to 205,843. This is an annuity. We know the present value of the annuity is 205,843. We know the number of periods certainly is 4. We know the required rate of return is 10%. We know the future value is going to be 0, so we can compute the recurring annual payment, the operating cash flow in this case. Now, I can do this by hand, and in fact I will at the end of the video. I'll just show you how to do this one by hand, but I do prefer using a financial calculator. Your professor may differ from me, but I would allow my students to use a financial calculator to do this, but if yours doesn't, it's fine. You can definitely do this by hand. There's a few different ways, but we'll just do it with formulas. So 2058493 is our PV, N is 4, 10 is our required rate of return, and 0 is our FV. And now I'm going to compute my PMT. I get 649,394. 649,394. Okay, so that is the annual operating cash flow, 649,394. But this still isn't my bid price, right? This is just my annual operating cash flow. So how do I go from operating cash flow to a bid price? Well, we've got a few different ways to derive operating cash flow. And the one we're going to want to use here is the tax shield method, or the tax shield approach to calculating OCF. Here's the formula for the tax shield approach. And the reason is we have all the information we need if we use the tax shield approach. Otherwise, it's tougher or impossible. So here's the formula for the tax shield approach for operating cash flow. Remember what the tax shield approach says. It says, okay, take your sales minus all your costs, pretend there's no such thing as depreciation, and just figure out the cash flow. So you go sales minus costs, you net out the taxes, and then you say, okay, that's basically my cash flow. And then at the end, the last step is you say, well, depreciation didn't involve cash, but how much tax did depreciation save us from? And so in a separate step, you figure out the depreciation tax shield and add it back in. So that's what we're going to do here, because we have all the information we need. So sales minus costs times 1 minus the tax rate. That'll give us sales minus costs net of tax, plus the depreciation, hopefully I'm good. Depreciation tax shield. How much money does depreciation, how much cash does depreciation save us? So let's start with, sales minus cost. So we know our operating cash flow. Sorry, so I'll start there. We know our operating cash flow is 649,394. We don't know our sales minus costs. I'm going to treat this as a single variable, sales minus costs. We know 1 minus the tax rate. Tax rate is 20%, so 1 minus the tax rate is 0.8. So sales minus cost times 0.8 plus the depreciation tax shield. Well, what's that? Our depreciation, we said, was $525,000 per year. So what's the tax shield? Well, it saves us 20% on taxes, right? It reduces our tax load by 20%. So how much does depreciation reduce your tax burden? 525 times 0.2, $105,000. That's our depreciation tax shield, 105,000. So now let's solve for everything except for our variable sales minus costs. Okay, so let's subtract 105 from both sides. So 649,394 minus 105,000. 544,394 equals sales minus costs times 0.8. Divide both sides by 0.8, so divide by 0.8. And it's 680, 490, I'm going to call it 493. 680, 493 equals sales minus costs. And in fact, we know our costs. Our costs are $900,000. So 680, 493 equals sales minus 900,000. So let's add back the 900,000 to both sides. So we get sales equals 158049, call it 3. Okay, so for us to have a net present value of 0, we need to make a bid that produces sales of almost 1.6 million, right? We need to make a bid that produces $1.6 million in sales. We are selling or bidding on 500,000 USB ports annually. And I need to make a bid that produces revenues of 1.5 million. What do? I just divide this by 500,000, the number of USB ports. And that's going to give me a sales price of, divide by 500,000, 3.161 per port. That's our bid. So that's the most aggressive bid we'd ever want to give. Certainly there might be strategy or whatever, but if you want to sort of place a competitive bid, your best bid is 3.161. You're not going to go below that. So there we go. That would be an appropriate bid price. That's how we compute it. We have solved problem 77A. I promised I'd do some stuff by hand. I'll do it after I give a little self-promotion. If you made it to the end, I hope you'll like and subscribe. As promised, I said I was going to compute this PMT by hand. To do it, we need the present value of an annuity formula. So PV of an annuity equals the amount of the payment times 1 minus 1 over 1 plus I to the power of n, all divided by I. Okay, and now we're just solving for PMT, right? So we know the PV of our annuity, negative 2058493. Or just, I think we just leave it as a positive 2058493. We don't know our PMT. Let's figure out what's in this square bracket. 1 minus 1 over 1.1 to the fourth power, 4-year period, all divided by 0.1. So let's get that, whatever's in the brackets there, that multiplier. 1.1 to the power of 4, 1 over x, 0.68, 1 minus that, so I go minus 1, I hit the plus minus button, I'm at 0.3, I divide by 0.1, and the thing in the brackets is 3.1698, and so on. 3.1699. Okay, so now I divide both sides by 3.1699 and I'll have solved for my payment. So I just go 1 over x times 2058493, 2058493, and I get 649394 as my payment. PMT equals 649394, and then, we're off to the races. So the bottom line here was I just wanted to show you did not need a financial calculator. If you're in a class that doesn't have one, this is still very much a solvable problem. It didn't take me long, right? It took me an extra 30 seconds maybe. All right, we've done it, and for goodness sakes, I hope you liked it, and if you did, I hope you give me a thumbs up. Have a great day. Bye. Welcome to Module 8 in our finance course. This module all about the break-even point and sensitivity analysis. If you've done an accounting course before, and you probably have, you've seen accounting break-even. And accounting break-even is the point at which net income equals 0. So how many units do I need to sell to break even, to have expenses and revenues be equal? Well, break-even point in finance, and we'll finance folks use the accounting break-even point. It's absolutely a useful thing to do, but there's a finance break-even, which is at the point at which it's cash flow neutral, right? Cash in equals cash out. So that's the financial break-even point. So we'll learn how to compute that during this chapter. A second component of the chapter, because this is all about predicting the future, right? You're starting a new business or you have a new project and you want to crunch some numbers related to the project. Well, a break-even point, an accounting break-even point, and a finance break-even point are useful things. Also useful, though, is to say, okay, I've based this on a bunch of numbers. What happens if my variable costs go up a little bit? 10% higher than I expected. Well, how sensitive is my analysis to a little tweak in variable? What happens if I sell 5% fewer units than what I had planned, right? Because these are all just plans for the future. What if our plans are a little bit off? How sensitive are we to changes in each variable, and how closely should we be monitoring each variable? Well, that's what a sensitivity analysis helps with. Underneath the sensitivity analysis, something that a lot of people will consider when they're looking at projects or looking at companies is something called operating leverage. And that'll be the focus of this video. So we'll do lots of videos where we do break-even point and sensitivity analysis. We also do a few this chapter on operating leverage. And that's a concept that my students at least frequently get confused by or don't quite have a good handle on. Here's the gist of operating leverage. Companies with high fixed costs and lower variable costs are swingier. In other words, they're more sensitive to changes. And it sort of makes sense, right? If you have a very, very high fixed cost, so your costs are locked in at a high level, and then you sell a little less than you planned, it really hurts because your costs don't go down. If your costs are mostly variable, well, when your sales go down, so do your costs go down. So that's what operating leverage says, but it puts numbers to it. So here's a little example of operating leverage. And an important thing here is we ignore taxes. We don't ignore taxes for all of our analyses, but with operating leverage, we do. So we've got two companies. We got Variable Inc., which, as the name suggests, has a lot of variable expenses, not so many fixed expenses. And we got Fixed Co. They're the opposite. Now, other than that, it's the same income statement, right? Sales are 100 grand, EBIT, pre-tax profit, because we're ignoring taxes, is 5. And again, sales here 100 and pre-tax profit of 5. And here's how you calculate operating leverage, and I'll show you how to use it, what it means. So operating cash flow is EBIT plus depreciation minus tax. Well, we don't have any tax, so it's just EBIT plus depreciation. 5 plus 15, it's 20. So our OCF here with Variable Inc. is 20,000, and our OCF with fixed is the same. EBIT plus depreciation minus tax, 5 plus 15, but there's no tax, so 20. Operating cash flow is the same. Oops. Now, how do I calculate the degree of operating leverage, or operating leverage factor, or just our OL or operating leverage? Called a lot of different things. I call it degree of operating leverage, DOL. It's 1 plus fixed costs divided by operating cash flow. So 1 plus, what's our fixed cost here? 10,000 divided by operating cash flow, which is 20,000. So for Variable Inc., my operating leverage is 1 plus 0.5, 1.5. And it's just going to be some number like that. 1 point something. Over to Fixed Co. Actually, it might be more than 1. And Fixed Co is going to be more than 1. 1 plus our fixed cost, 70 in this case, divided by our operating cash flow, 20. 1 plus 70 divided by 20 is 3.5. 1 plus 3.5 is 4.5. So, okay, we've got these numbers. What do they mean? And here's what they mean. And you have to, this is why it's a little awkward. You have to think in terms of sentences. So here's the sentence I think of. For every 1%, I'm going to say increase, but it could be decrease as well. Guess I could say change, but I'll say 1% increase in sales, like unit sales, operating cash flow will increase by the operating leverage factor. So, for example, I think this is more easily explained in words or with numbers. That's why we do an example here. If my sales go up by 1%, for variable Inc., my operating cash flow is going to go up by 1.5%. For fixed co, if my sales go up by 1%, my operating cash flow is going to go up by 4.5%. That's what this means. So let's do a 20% increase. Let's assume sales are going to increase by 20%. Well, who's going to swing more? And the answer is, of course, fixed co is going to swing more. It's what fixed costs mean. Your changes to variables affect you more when you have more fixed costs. So let's see what this means. Here's what we would predict would happen. We would say if sales go up by 20%, variable, oh my goodness, my writing, variable Inc.'s OCF, operating cash flow, is going to go up by 20 times 1.5, 30%. So it was 20,000. An increase of 30% means we think it's going to be 26,000 after the change. And we'll prove it in a second. Fixed co's OCF is going to go up by 4.5 times 20%. 4.5 times 20%. It's going to go up by 90%. Good Lord, that's a lot. Well, 90% of 20,000 is 18,000, so it's going to go up by 18,000. It's going to become 38,000. So huge swing, right? They're both the same company. They're both going up 20%. But why is fixed co's operating cash flow going up by so much more? And the answer is because when variable co's sales go up, their costs go with it. When fixed co's sales go up, their costs stay the same because they're fixed. But let's crunch those numbers and prove it. So here's a new income statement plus 20%. So our sales go up 20%. So our sales are going to be 120. Our variable costs move with sales. They're going to go up 20% also. So that goes up to 84,000, just and multiplying by 1.2. Fixed costs remain the same. So fixed costs remain 10. So 120 minus 84 minus 10. That is 26,000. Our depreciation is fixed, so it stays the same. 26 minus 15. That's, what is that? 11,000. And now we say, okay, well, what's the operating cash flow? And it's EBIT plus depreciation. My EBIT is 11, depreciation is 15. Yep, it's 26. I proved it there. It's just 11 plus 15. It is 26, so yes, it worked. It's going to work also for fixed co. If I go plus 20%, we get 120 here. Variable costs go up by 20%, so they go up from 10 to 12. Fixed costs remain the same, 70. 70 plus 12 is 82. So that's 38,000. If I go 120 minus 82, 38,000. Depreciation stays the same. And 38 minus 15, what is that? 23,000, I believe. And once again, EBIT plus depreciation, 23 plus 15 is 38. That's the number we came to. So kind of proved it. Now, the purpose of this exercise was just to say, okay, if a company has, and by the way, if I did minus 20%, fixed co would be way more hurt than variable Inc. So there's a reason a lot of companies, they want to move to more machine-based production, right? If you make widgets or whatever it is you make. And the reason is, as you grow, fixed costs are just better than variable costs. So that's largely why companies try to avoid variable costs. They try to focus on fixed costs because more fixed cost means more operating leverage. All right, that's it for this intro. We're going to be doing lots of calculations on break-even point, sensitivity analysis, and yes, operating leverage too. Stay tuned for our next video. In this video, we're going to work on a problem you can download from tonybell.com. Go to the website, click the PDF link, and you'll notice there's no sign in, no sign up. The PDF just pops right up. You'll scroll down and find whatever problem it is that we're working on. As you scroll through the problems, you'll notice many are free and open, like the one you're watching now, but some are members only. I think the free and open ones are enough for most people. But if you can't get enough of me and you'd like to join and get access to those members only videos, click the join button underneath the YouTube play box. All right. Thanks so much for watching. Let's get started. Let's jump into problem 8.2a. We're doing break-even points again, and we've just done this. If you've done 8.1, you've seen the accounting break-even point. Fixed costs, including depreciation, divided by the price minus the variable cost, I should say, per unit. And this is called the contribution margin in accounting jargon. So let's jump through the problem. We're going to calculate the accounting break-even point. We've already done that. We're going to calculate the cash break-even point. Again, we did that in 8.1a, but the new material here is parts C and D, and pay particular attention to part C. That's the new ground we're breaking. Part D, we're going to explore more in problem 8.3, operating leverage, but we'll get to that when we get to it. Let's jump into the accounting break-even point. So here we have a company that's considering a project with the following information. Selling price of the product they're going to make is $80. The variable cost is going to be $50, fixed cost of $60,000, and they got to make an additional initial investment of $20,000. It's going to run for 5 years. So, assuming they're buying some asset or assets to produce this return, it's 50,000. No, not 50. 20 divided by 5 is $40,000 per year in depreciation, which I will put as depreciation. Assume the company wishes to use straight line depreciation. Well, we just did that. And assume taxes are ignored. Okay. I'm ignoring them now. The required rate of return is 10%. I love ignoring tax. I wish I could ignore taxes in my real life. The required rate of return is 10%. Okay, so discount rate. Now, the discount rate doesn't come into play in these first two calculations. It rarely comes into play in accounting. A discount rate is for finance, where we're doing these longer term projections. Accountants can use a discount rate, but it's less frequently used in accounting exercises. So in any event, the first two parts of this problem, we don't need to worry about that required rate of return. Let's calculate the accounting break-even point. Fixed cost plus depreciation, 60,000 plus 40,000. Divided by price minus variable cost per unit, 80 minus 50. And let's crunch that number. 100 divided by 30, right? 60 plus 40 is 100,000 divided by 80 minus 50, which is 30. 33333. So 3,334 units. That's our break-even point, according to the accountant. And remember what break-even point means. The accounting break-even point is the point where net income is 0. And I always bring this up, like, you don't run a business to break even, so why do you care about the break-even point? You want to make money. And the answer is, you don't run the business to break even, but it's still useful to know. Oh, once I've sold my 3,334th unit, everything after that is gravy. I'm making profits after that. So if you're running a business and you're like, I'm not going to reach 3,000 units, you know you're going to be losing money. You can project based on that information. So it's useful information to have in your back pocket. Also useful information is the cash break even, which is, are we going to run out of cash? That's useful to know. And it's easier to hit the cash break even than the accounting break even. Why is that? Well, look at the formula for break even, the accounting one, fixed cost plus depreciation divided by price minus variable cost per unit. The cash break even just says, take out that one because there's no cash flow, right? And we're in finance, we're worried about cash flow. So take out the piece that has no cash flow. We'll go fixed costs, ignore the 40, 60 divided by 80 minus 50. So let's do that. 60, divided by 80 minus 50 is 30. It's 2,000 units. So it's easier to break even on a cash basis than an accounting basis. What we'll find next, and this is the new concept, is the financial break even is harder to reach, where I'm expecting a bigger number here, usually. I think always, but I'm going to say usually. I think it's always. I think the math makes sense that it's always. But let's figure out what this is. So the financial break even. So accounting break even is when profits are 0. So obviously you want to do better than that. Cash break even is where cash flow ends up being 0. Financial break even is where net present value of the future cash flows equals 0. And again, you generally want to have positive net present value, but this is a useful number to know. So how many units do I have to sell to have my net present value be 0? And so because of that, because we're looking at net present value, this discount rate matters and the project's life matters. And the reason it's harder to get net present value of 0 than to get accounting break even is because of that time value of money. Presumably your projects are making you money, but they're making you cash flows in 3, 4, 5 years from now. Well, you have to discount those positive cash flows. So that makes them less valuable. And so finance takes that into consideration where our accounting break even does not. Okay, so how do I do it? Well, I'm going to do it with my financial calculator. It is just an annuity, right? This project is essentially an annuity. And so we can do it by hand with the present value of an annuity formula. We will do it by hand at the end of the video, but I'll do it with a financial calculator. If you're fortunate enough to get to use one of those, then, this is a slightly easier process, but it's not that hard to do by hand. Okay, so here's what I'm going to enter into my financial calculator. N of this project is 5. I'm just using the same annotations that's on the calculator. IY is the discount rate, 10%. PV, the cost, 200,000 negative. So we're outlaying 200,000 negative. Our PMT, that's what we don't know. Oh, by the way, sorry, what are we solving for right now? I didn't say that. We're going to calculate, we're going to calculate the operating cash flows required to have NPV equals 0. So we calculate, and again, this is building on material from last chapter. If you're shaky on operating cash flow, that's an important concept here. Operating cash flow required to make NPV equal 0. So that's what the PMT is. That's what we're solving for. That's our OCF. And again, we can use OCF in other calculations shortly. Our future value here is 0. And so we got one variable. Let's solve for it. So N is 5, 5 goes in as N, 10 is my discount rate, 200,000 negative is my PV, my FV is 0, and I compute PMT. I get 52,759.5, but I won't take the decimals with me. Okay, so there we have it, 52,759. That's the annual operating cash flows I need, but I still don't have my break-even point. Here's how you figure out the break-even point. And it's actually using a very similar formula to this, and we're just using the cash components of it. So fixed costs, excluding depreciation, are cash. Depreciation is cash, but we have to cover more than our fixed costs because I need to generate $52,759 above my fixed costs. So I'm going to add the OCF, and I just divide by the same denominator. I'm still selling the same product. It's got the same price. It's still got the same variable cost per unit. So it's just subbing in OCF for depreciation, but it makes logical sense, right? You got to cover your fixed costs and you got to generate this much operating cash flow on top if you want to have net present value of 0, as we just sort of calculated. So fixed costs here are 60. Our required OCF to get net present value of 0 is 52,759. P minus VC is still the same, 80 minus 50. All right, so 60. So I'm just going to add 60, and now we divide by 30. And we get 3,759. Now, we're in the ballpark, right, of our other units, so that's always a good sign. If it wasn't like 2 million or something, I'd be like, oh, I screwed something up. So sometimes you get absurdly high or absurdly low answers, and it just means you screwed something up. But we're in the ballpark here, and slightly higher than accounting break-even point, which we figured to be. Our break-even point for finance is 3,759 units. Beautiful. So that was the key for this one. Not 8.3. We're going to move on to part D now. So again, just to reiterate what we're doing, the key to this problem is this financial break-even point. It's how many units I need to sell to have a net present value of 0. And I'll show you how to calculate this OCF by hand at the very end of the video. But let's jump ahead to part D. D says, at that financial break-even point, calculate the degree of operating leverage. This is a new concept. We explore it in some more detail in problem 8.3. For now, I'm just going to give you the formula we're going to solve. I'll explain what it is that we're calculating, what we're doing here. But we'll go into more depth when we do problem 8.3. So here is the formula. I'm doing this from memory. I always screw it up. It's 1 plus fixed cost divided by operating cash flow. That's the formula to get a degree of operating leverage, which is just a ratio. It's just a number, and it's like a number that, well, we'll explain. Let's solve it, and then I'll kind of explain what the number means. So again, this is degree of operating leverage. This is part D that we're solving for here. So 1 plus fixed cost divided by operating cash flow. Well, there's our fixed cost. There's our operating cash flow. So 1 plus 60,000 divided by 52759. 60,000 divided by 52759 equals 1.14. So 1 plus 1.14, 1 plus 1.14 is 2.14. And what you're going to get is a number, and that number is going to be somewhere above 1. Obviously, it's not going to be a negative number. So it's going to be, I don't think it can be a negative number. Just thinking out loud here. Yeah, it can't be a negative number. It would be a weird situation. So it's going to be a number over 1. Typically, it's not a huge number, like unusual to be like over 6. But, between, say, 1 and 5, 1 and 6 is fairly typical. Here's what the number means. For every blank percent increase or decrease, I'll just say change in units sold, OCF will change by 2.14 times blank percent. So let me explain. So let's say units sold goes up by 10%. Okay, my unit sales go up by 10%. I would expect my operating cash flow to go up by 2.14 times 10, 21.4%. So it's a measure of how sensitive our operating cash flow is to changes in sales volume. And it's typically a measure of fixed costs, like what proportion of our capital structure is fixed versus variable. For very, very fixed, this tends to be a big number. If our costs are mostly variable, this tends to be a small number. But it's how sensitive operating cash flows are. And cash flows are really important to us to changes or fluctuations in sales. So if sales are going up, and we have big OCF, this is great news, right? If you're an investor and owner of the company, you're like swimming in cash. If sales go down and this is a big number, it's a catastrophe for you. You're in big trouble. So it's a measure of leverage, right? How much things will move. So that's the discussion point. We explore this more in problem 8.3. So let's stop the video there for those that are not going to follow along when I do the calculation by hand. Just hit the thumbs up on your way out of here. No hard feelings. You can leave now. You're free to go. But for those that are sticking around, you hit the thumbs up too. And let's dig into this. I always think I'm being silly when I do that, but there's a reason people do it. It works. It works. It's really important. It helps me so much that some people hit the thumbs up button. If you're here and you haven't hit the thumbs up button, you should try it. Just try it. It's like fun. It's super fun to do. Okay. So we're just going to recalculate this number that I had done in my financial calculator. Our present value here, $200,000, that's what we're solving for, equals C, which is our payment amount, times 1 minus 1 over 1 plus r. Our discount rate was 10%, so 1.1 to the t, which is 5, all over r, which is 0.1. Okay, so again, put some brackets around everything. We just have to solve for c. C is that payment amount. Okay, so 1.1 to the power of 5. 1.61, I go 1 over x, 0.62, 1 minus that, so I go minus 1 plus minus 0.37. 0.37 divided by 0.1 is 3.79. So what's in brackets is 3.79. So I just divide 200,000 by 3.79 and I'm out of here. 1 over x times 200,000, that's one way to do this. And I get 52,759.49. Well, look at that. 52,759.49. It's the same answer because we're doing the same thing. So that did not take me long. If your professor's making you do stuff by hand, it's not the end of the world. We've solved the problem. I hope this video helped you. And for goodness sakes, if you watched all the way to the end, smash that button. Don't just hit it, smash it. Thanks so much for watching. See you in the next video. Bye-bye. Let's examine problem 8 for a scenario analysis. We're going to look at best case, base case, worst case scenarios for some financial projections. Horizon Creations is considering a new project. Details of the project are below. So we got a cost of 300 grand, some unit sales it's going to generate, and prices and cost information. A project's going to last 3 years with a required rate of return of 10% and the tax rate's 25%. Depreciation is straight line to 0 over the life of the project. So that's giving us depreciation information. We have a $300,000 project. It's going to last 3 years. That's $100,000 per year in depreciation. Just 300,000 divided by 3. The question says, prepare a pro forma income statement based on the projections above and compute the expected net present value of the project. This will be your base case. And in the next one, we're going to have worst case and best case. And so I think a good, sensible way to do this is to prepare our income statement in 3 columns. We're going to have base, we're going to have worst case, and we're going to have best case, all sort of side by side by side, so we can look at them all together and prepare them all together. And there's some efficiencies here in doing it all in sort of one chunk. So let's get to it with our base case, and we'll start with our sales revenue figure. We are expecting to sell 10,000 units, $60 a unit. That would be $600,000 in sales as our base expectation here. Hopefully my math is right there. Yeah, it is. Well, let me just calculate that. 60 times 10,000. Yeah, it's 600,000. Why am I worried? I just did a long problem and I got a number wrong right at the beginning and it screwed everything up and I had to redo it. So I'm a bit shy because of that. Our variable costs here, $20 a unit. So that's 200,000 in variable costs. Our fixed costs, $80,000, bringing us down to earnings before interest, tax, depreciation, and amortization of 320, right? Just our sales revenue minus our costs give us EBITDA. Our depreciation, we just said, was 100K. So our EBIT is 220. Our taxes are going to be 25% of 220. $55K, $55,000, giving us net income profits, 220 minus 55. I should be able to do this in my head, but I can't. 165. I'm going to say 165. Let's see. 220. Yeah, I feel pretty good about that. 165. Okay. I still got it. I'm getting old and slow, but I can still subtract 220 minus 55. Pretty impressive. Okay. Let's continue. So to figure out, we're asked to do net present value. And so, of course, to figure that out, we need to figure out our operating cash flow. I'm just going to move this over a touch. I guess I could have moved this one over a touch. That would have been smarter. Well, now I've moved them both over a touch. So we're really on fire here. Our operating cash flow is EBIT. We'll do this the standard method of figuring out operating cash flow. You start with EBIT, 220. You add back your depreciation, because of course depreciation is a non-cash item that went into EBIT, which is 100,000. And then you deduct your taxes, which is 55,000. You can do this different ways, and you might get there quicker than me. That's fine. 220 plus 100 minus 55. 265. That is our OCF, our operating cash flow. We're almost to the point where we can compute net present value. What do I need to do now? Summarize my cash flows. So in year 0 times 0, I have an initial project cost of 300,000. But in years 1, year 2, and year 3, I have money coming in. I have 265 coming in. I can see this is going to be positive net present value. So I have to discount these cash flows. To discount them by hand, you just divide by 1 plus the discount rate, 10%, the required rate of return, 1.1 to the power of how many years you're discounting. So 1.1 to the 0th power, 1.1 to the first power, 1.1 squared, and 1.1 cubed. And there you have it. So you just add those together. Of course, we have financial calculator, so I will use that. CF, 300,000, negative, enter, down arrow. Cash flow at time 1, 265, positive, enter, down arrow. How many times did that occur? 3 times, enter. That's it. I hit NPV, 10, 10% discount rate, down arrow. I hit compute on NPV, 359,016, 359,016. Okay, so my base case says, let's do this project. It's a project worth doing. We're going to make a bunch of money above and beyond our required rate of return. Anything positive is certainly worth strongly considering here for NPV. We should do it, is the general belief in a finance class, right? Plus EV, plus NPV. EV is like gambling talk. Plus net present value is something you ought to do. Okay. Let's look at the best and worst case. So it says, assume that the following variables are accurate to within 10%. Annual sales in units. So it means it might be plus or minus 10%. So if this is, let's do worst case first. Worst case scenario for annual sales in units is down 10% below what we projected. For price per unit, it could vary by up to 10%. So a bad case there would be the price is 10% lower. In other words, we're not able to get customers to buy it at full price. We got to discount it by 10%. Variable cost, what's the worst case scenario there? Well, it's 10% higher. And fixed cost, the worst case scenario is 10% higher. Now, this question is fairly simple. We could have worst case scenarios where not everything's 10%, right? Worst case scenarios, our variable costs go up by 40% and our sales in units go down by 10%. You could project it any which way, right? And we're doing it by hand, one step at a time, but in a spreadsheet, you could imagine, you could play with the scenarios very quickly, right? You could say, well, what about 15%? What if our sales are off 15%? What does that look like? Run the numbers. And it's like, you don't have to rewrite an entire income statement and do all this. You just change one cell of a spreadsheet and there it is. Okay, but we're doing it by hand because often in finance tests, you're asked to do stuff by hand. And I'm a believer just you learn it better doing it by hand. Maybe I'm too old. You can tell me in the comments. Okay, assume the variables are accurate. So annual sales could drop by 10%. So let's look at best. No, this is not best case. We want to do worst case. Pardon me. Let me change ink to worst. So worst case scenario, our project still costs $300,000. By the way, that's another variable we could change. We could make the project cost more or less, right? Projects overrunning costs all the time. Annual sales in units. Well, again, worst case scenario is 9,000. Sales price. Well, 10% down from that is $54. Variable cost rising by 10% is $22. Fixed cost rising by 10% is $88,000. Our project length is 3 years, 10% required rate of return, 25% taxes, even in the worst case. Okay, so then it's just like pretend the problem said this and rerun all the numbers. So that's what we're going to do. Our annual sales in units, 9,000 times 54. So we're selling fewer units and we're able to charge less for what we sell, $486,000. Our variable costs are 22, but we're selling fewer units. So 22 times 9,000, 198. That's a place people go wrong. They go 22 times 10,000. They screw that up. Our fixed costs, $88,000 a year. So 486 minus 198 minus 88. 486 minus 198 minus 88. 200,000 even. That's amazing. Nice even number. Our depreciation is 100, and therefore our EBIT is 100. Taxes on 100,000 are 30,000. It's got me second guessing things. The numbers are going so smoothly. 25%. I said 30%. 25,000. 100 minus 25,000 is 75,000. Okay, so there's our worst case. EBIT in the worst case is 100 grand. Depreciation, 100 grand. 100 plus 100 is 200 minus 25,000 in taxes is 175. So what do our cash flows look like here? Minus 300. Minus 300 plus 175 plus 175 plus 175. So our cash flows are worse in this scenario. They don't look catastrophic, though. Let's crunch the numbers. So CF, clear what's in there. CF at time 0 is 300. Negative, enter. Time 1, 175. Positive, enter. And there's 3 of them. So enter 3 is my frequency. I'm going to NPV, my I here, my discount rate is 10. And let's compute NPV. I get 135, 199, 135, 199. So 2 things popping into my head here. First, if this is as bad as it gets, this is a great project. We ought to be doing it, right? Like worst case scenario is positive. The second thing though is if everything looks rosy, I don't think, oh, what a great project projector I am. I think, I must have missed something. This is too good. Like, this is something wrong with this. So that's just something to be aware of. It's like, that just because the numbers are great doesn't mean the situation is great as you're projecting. You maybe are missing something if it just seems too easy. And this is borderline seeming too easy. I would stop here, honestly, if this were my project and I'd be trying to reevaluate some of my judgments. I wouldn't do a best case very often because who cares? Like, I don't know. I don't make project decisions based on everything going perfectly. I suppose you could be saying, well, this is the maximum upside of this project, but I'm a downside guy. I mentioned this in another video, but when I walk out of a test, a final exam, I'm always the guy saying, oh, I failed it. Oh, what a disaster. Oh, no, woe is me. And so when I'm projecting some project I'm working on, big financial stakes, I'm always like, considering the worst case. I'm not considering what happens if it's an absolute home run. But best case scenario, it's an absolute home run. What does that look like? Okay, well, our cost for the project is the same. We sell 10% more. We sell 11,000 units, not 10. We are able to charge more, $66. It costs us 10% less. Variable cost, 10% less is 18. The fixed costs are 10% lower. They're 72,000. Still 3 years, still 10%, still 25%. So some of those went up, some of them went down, right? Costs go down, revenues and sales go up. But there you go. We just have to do one more projection. Let's do it, and we'll wrap up. So 11,000 times $66, $726,000 in revenue. Variable costs, 11,000 units times 18, 198,000. Fixed costs, 72,000. 726 minus 198 minus 72, 456. Our depreciation is 100,000. So that brings us down to 356 in EBIT, and you can see significantly higher than the other two. And because of that, our taxes are higher. 356 times 25%, it's 89,000. 356 minus 89,000, 267. All right, so obviously way more profitable, obviously going to have a very high net present value. This is sort of the max upside scenario. Our EBIT here, 356, add depreciation of 100, deduct taxes, which were 89,000. $367. Okay, so what are our cash flows? Minus 300, plus 360 and plays back within the first year. This is like the no-brainer decision of all time if you could get these numbers. And let's figure out where our net present value is after all of that. So cash flows, second function clear, 300,000 negative, enter, down arrow, 367 positive, enter, down arrow, and there's going to be 3 of those, enter. And now we go NPV. So the required rate of return is 10, down arrow, and I compute NPV. I get 612,675, and this seems like a no-brainer project. We should be doing it, right? Like our worst case is making us money. Our best case and base case are expected to be very high positive net present value. So this is a project worth doing. If I got numbers like this, it would have me questioning the numbers because they're just a little too rosy. I'd be like, what am I missing? So anyway, hope this video helped. Hopefully you're not missing anything, and hopefully you're not missing that like button on your way out of here. Hit me with a thumbs up, and I'll see you in the next video. Bye-bye. Welcome to Module 9. This module is called Calculating Returns and Variances. And, you know, we've been buying bonds, buying stocks, making investments in projects. How can we talk about our returns? How are our investments doing, and how do we compare one to another? That's what this chapter is all about. And you may think it's simple, but in fact, I have a true story from my real life where I got in a big fight with a friend over this very topic. So here's the story, and I think you'll understand what's happening. So my friend and I were, follow the stock market, and we're interested in various stocks. And we both sort of eyed up stocks. And I said, I think Blue Company is a terrific company. And obviously I'm making up the names of the stocks. It's not blue and green, but you get the idea. And my friend, he said, no, Green Company's the much better company. It just so happened their stock prices were around the same, but for our conversation, let's pretend the stocks were both sitting at $100. And I said, well, let's make a friendly bet. A year from now, I bet you if you had invested in Blue Company, you'd have a better return than you'd get out of Green Company. He said, no way, Green Company's going to have the higher stock price. I'd pick Green Company all day. And so we shook hands and made a bet. Little did we know, we bet on two different things in that moment, and it caused drama. So a year goes by, 1 year later, and these were the stock prices. And so, my stock appreciated to $110, his to $112. And you might think, open shut case, Tony loses the bet. But a big part of my investment hypothesis was I liked dividend paying stocks. And so my stock had in the meantime paid a $5 dividend, $5 per share, 5% dividend. And so in my mind, my stock had returned 15%, 10% in capital gains or stock appreciation, $10. So again, the math here is 110 minus 100 is $10 over 100. That's 10% gain in the stock going up, and 5 on my $100 investment, 5% is my dividend yield. So my total return on the investment is 15%. My friend said, no, number go up. My stock went to 112. That's a 12% return. Last time I checked, 12 is greater than 10. I win. And I said, the fight was unresolved. And I think the reason was we thought we were betting on different things. I said, I think my stock will have better return. He said he thinks his stock's going to a higher number. We kind of said different things. But as an investor, I think most investors would prefer this situation, right? You would be happier to have owned stock blue for a year than stock green. That's what I left convinced of that, and I said as much. And he said, no, I didn't lose. I think he was being, not being cool in not giving in on the bet. So in any event, it caused a bit of a fight in my friendship because we couldn't agree on how to calculate returns. Well, after this chapter, you're going to know how to calculate returns. I think you'll think I won the bet, but maybe not. I wonder what you think. Anyway, stay tuned for a whole series of videos on doing just that. See you in the next video. Bye for now. Let's run through problem 9.1a. We're computing returns on our investment, return on a stock that we purchased. This is talking about the percentage change or the percentage return on our investment. You purchased one share of XYZ Company stock for $50. XYZ Company, I'm Canadian. After 1 year, the stock price is $54 and the company will pay you a $1 dividend. Okay, so it asks first for us to calculate the percentage total return. And the total return is, well, the stock went up by $4 and we got a dividend of $1. It's a terrible circle I was about to do, so there's one more dollar there. So overall, we're $5 ahead of where we started on a $50 investment, right? We've gained $5 on a $50 investment. So this is a 10% return, positive 10% return. 5 divided by 50 is 0.1, and that's 10%. The dividend yield is, well, we got a $1 dividend on our $50 stock. That's 2%. And capital gains yield is how much the stock went up or down. In this case, it went up by $4. It went up by 8%. And it shouldn't be lost on you. There's a relationship here, right? The total return is the dividends plus the capital gains. That's our total return on our stock. Our stock returned to us 10%. All right, we've finished the problem. And before you finish watching, hit me with one of those. Have a great day. Thanks for watching. See you in the next one. In this video, we're going to work on a problem you can download from tonybell.com. Go to the website, click the PDF link, and you'll notice there's no sign in, no sign up. The PDF just pops right up. You'll scroll down and find whatever problem it is that we're working on. As you scroll through the problems, you'll notice many are free and open, like the one you're watching now, but some are members only. I think the free and open ones are enough for most people, but if you can't get enough of me and you'd like to join and get access to those members only videos, click the join button underneath the YouTube play box. All right, thanks so much for watching. Let's get started. Let's take a look at problem 9.2a. We're being asked to compute bond returns, and to compute the bond return, we got to actually be able to compute bond prices, which is a bit of a rehash of material we've covered earlier, but that happens in courses. You do something several weeks before and you have to recall how to do it. So let's work through it. You can see I've got formulas up here. Let's just remind you, bond is, we lend a company some money. They pay us typically semi-annually some interest back, and then at the end they pay us our money back. It's a loan between two parties. And of course, because those payments are happening way in the future, or can't be way in the future, we have to do the present value of all those future interest payments, as well as the payment of the money back at the end that we loan them. So because of that, there's present value of an annuity, which is just the present value of those interest payments, and the present value of a lump sum. We will solve this first, in our financial calculator, I'll complete the whole problem just using the financial calculator. Then we'll solve the present value part by hand just to show you it can be done, but we'll save that for the very end of the video. Let's jump into it. 1 year ago, you purchased a 5-year 10% coupon bond. You paid $10.20 for the bond, and it had face value of $1,000. The bond makes annual coupon payments. So most bonds we've looked at in the course make semi-annual coupon payments. This one is annual. Just makes our life easy. The math is a little bit easier. Today, you sell the bond at a time when the bond required rate of return is 9%. So first comment here, I didn't mention, but it's $1,000 bond. We paid $10.20. We paid a premium on this bond, and we're selling it. It's a 10% bond, and we're selling it when the required rate of return is 9%. We're also going to sell it at a premium. The question is, how much are we selling it for? It never told us. Are we selling it for exactly $10.20? I don't think so. Are we selling it for exactly $1,000? I don't think so. We've got to compute the price of the bond when we sell it, because we want to know, did we make any money on this bond? We bought it for $10.20. Did I sell it for more than $10.20? Less than $10.20? What did I sell it for? We need to know the price. So we'll use our financial calculator to figure out the present value of this bond. And so I'll just punch in some numbers. We know the number of periods. Well, we purchased it 1 year ago. It was a 5-year bond 1 year ago. How many interest payments are left on the bond? 4, because we would have received one of the interest payments during the year. Our IY is the discount rate, which is 9%. Our PV is what we're solving for. We don't know the PV. Our PMT, well, it's a $1,000 bond that has 10% coupon, so it means there's a $100 payment every year. Often we're doing this semi-annually, we would divide by 2 and we'd get $50 payments, but our N would be higher. Anyway, we're not doing any of that. So makes our life easy. PMT is just 100. And our FV is how much we're going to get paid back at the end. And we loan them $10.20, but they only got to pay us back $1,000. So $1,000 is the future value, or face value, but future value of the bond. So let's crunch those numbers. 4 goes in as N. 9 is IY, 100 is PMT, 1,000 is FV, and I compute the PV and I get 1032.4. Let's just call it 1032. Okay, so I bought this bond for $10.20. It's worth $10.32 today. The bond price went up by $12. That's a part of my return, right? Not only do I get the $100 coupon payment, which is part of my return, I also get $12 just by bonds. The bond went up, and the bonds don't always go up, right? If interest rates in the economy go way, way up, our bond price actually goes down. But in this case, our bond price went up a little bit. How much did it go up as a percentage? Well, it went up $12, and I invested $10.20. Went up by about 1.2%. Our investment yield is plus 1.2%. The coupon yield, well, it's a $100 return on a bond that I paid $10.20 for. $100 coupon, they sent me a $100 payment. So again, $100 on a $1,000 bond, it's 10%. But $100 on a 10-20 investment is going to be less than 10%. It's going to be 9.8%. So overall, my return on the bond is 1.2% because it went up, and 9.8% because I got $100. My overall return on the bond is 11%. And there we have it. So those are just useful calculations to know and to understand where our money's coming from, where our yield is coming from. We have solved 928. I will go back and do it by hand, but if you want to drop off now, hit the thumbs up on your way out of here. If you want to stick around, hit the thumbs up now anyway, and let's get into just calculating this by hand. So I mentioned the 2 streams of cash flows. One is every year we get a $100 payment. That's this one. So let's calculate that one. This is the $100 payment that comes in every year. 100 times 1 minus 1 over 1 plus r, so 1 point, and the r is our required rate of return. It's our 9% discount rate. 1.09 to the power of t, which is to the power of 4, because there's 4 more payments left. We're trying to figure out what the bond price is after a year of ownership. So 1 over 1.09 to the 4 divided by 0.09. All right, let's compute that piece. Clear. 1.09 y to the x 4. 1.41. I go 1 over x. I get 0.708. So then 1 minus 0.708. It's going to be 0.29 minus 1. 0.2915. Divide by 0.09. 3.23. So what's in this bracket is we're 3.23 in this big square bracket. Multiply that by 100 and we're done. This piece, oops, I was going to multiply by 110. Multiply by 100 and it's 324. We'll call it 324. So the present value of the $100 payments, remember I'm getting $400 payments over the next 4 years. The present value is $320, $324. I'm also getting $1,000 at the end of 4 years. So 1,000 divided by 1.09 to the power of 4. What's that worth to me? 1.09 to the power of 4. I go 1 over x times 1,000. $1,000 in 4 years is worth $708 today. All right, so $708 lump sum plus $324 worth of payments here. 708 plus 324 is 1032. And that's exactly what we said the present value of our bond was. So you can calculate this by hand. You can calculate this in a calculator. But whatever you do, hit the thumbs up button before you go. Thanks for watching. See you in the next video. Bye-bye. Let's take a look at problem 9.3a. This problem has us looking at variance calculations, and variance is a measure of variability. So we're going to look at a stock price and how it's changed over time, and we're going to calculate the variance of that stock price. And this is a statistical concept. If you've taken a stats class, you've probably calculated variance and standard deviation. This is just that. So this should be review for anyone that's done statistics. Now, why does that play into finance? Well, first, if you're an investor, the variability in stock prices is of intense interest to you. But investors look at a concept called beta when they measure variability as compared with the rest of the market. So we'll look at beta next chapter, and it's based on this variance calculation. So this variance calculation is core to beta, and beta is a core concept in corporate finance. So anyway, let's get going. And when we do this, it's very much like a stats class. So here we go. The percentage returns of XYZ company's stock over the last 5 years are shown in the table below. And there's XYZ's stock, and you can see it's, had some good years and had some bad years. So it says during that time, the average T-bill rate was 4.2%. That is the risk-free rate. In other words, without putting our money into some stock that could go negative, which it did, and we could just give it to the government, the U.S. government, and they'll give us 4.2%. And that's as close to a guarantee as exists in the world. So calculate the arithmetic average return of the stock. Okay, we'll ignore that risk-free rate for the moment. The arithmetic average, I think of as just the average. We're going to learn in a future question something called the geometric average. That's a little more complicated. Arithmetic average, though, you just add the numbers up and divide by however many you just added up. So we're going to go 20% minus 8% plus 17% plus 14% minus 3%. We're going to divide by, there's 5 years. And we'll get an average, right? What's the average return in any given year? So 20 minus 8 plus 17 plus 14 minus 3, it's 40. So 40 divided by 5 is 8. Our average here is 8%. The arithmetic average return on our stock was 8%. What's the risk premium? Well, the risk premium is you invested in a stock that fluctuates in value. You expect a higher return than, because otherwise you just give it to the government and they give you 4.2% on your money. You'd lend it to them. So we got paid 3.8% more than what we could have got if we bought T-bills, right? 8 minus 4.2 is 3.8. That's the risk premium of this stock. Okay, so now it asks us for the variance of the returns. Here's how we calculate the variance. It's the sum of the squared differences. Such an awkward turn of phrase here, and I'm sorry to say it in this way. The sum of the squared differences divided by n minus 1. It'll become easier when we do it a few times, but that's an awkward turn of phrase. So when I say the sum of the squared differences, I mean the difference between the given year and the average. So the average was 8%. So I just take 20% minus 8%, negative 8% minus 8%, 17% minus 8%, 14% minus 8%, and negative 3% minus 8%. Okay, so let's take the difference between the year and the average. So 20 minus 8 is 12. Negative 8 minus 8 is actually negative 16, right? Minus 8, minus 8. 17 minus 8 is 9. 14 minus 8 is 6. And negative 3 minus 8 is negative 11. And again, I'll just show you that in my calculator, make sure we're on the same page here. Negative 3 minus 8, negative 11. Okay, so that's the difference between our given year and the average. And, think about the variance. The variance is like how high or below average you are. If we're 8 every year, then our average is 8, and there's no variability. It's just the same every year. But here there's variability. So this already is a measure of variability. How different are we in 1 year compared to the average? Now we square those differences. So actually I'm going to restate these as decimals because punch them in the calculator as a decimal. So 0.12, negative 0.16, positive 0.9, positive 0.6, and negative 0.11. And now we square those. So to the power of 2. So not negative, just 0.12 to the power of 2, 0.12 squared, 0.0144. We have big long decimals. Try to keep as many decimal points as you can. 0.16 negative squared is 0.0256 positive. When you square a negative number, it of course goes positive. 0.9 squared. Oh, I'm glad I looked here. This is not 0.9, it's 0.09 squared. This is 0.06 squared. I'm happy I double checked that. 0.09 squared is 0.0081. 0.0081, 0.06 squared, I can already guess 0.0036, but let's crunch it. 0.06 squared, yeah, 0.0036. And 0.11 negative squared. 0.11 negative squared is 0.0121. Let's sum the squared differences here. So sum it up. 0.0144 plus 0.0256 plus 0.0081 plus 0.0036 plus 0.00121. And I get 0.06, 0.0638. I was just crunching the number in my head saying, does that make sense that that's adding up? Because sometimes you miss a 0.0, you miss one of the zeros there and end up with a number that's off. Okay, we divide this by n, the number of years or the number of items we're looking at, minus 1. So and you might think, well, why don't I just divide by 5, right? I took an average, I divide by 5. Why don't I just divide this by 5? And the answer is somewhat statistical. The idea here is we're looking at the percentage of returns of the company's stock over the last 5 years. Well, the company's had more years than 5 years, presumably, that it's existed. So because we're not looking at the entire population, we divide by n minus 1. If we're looking at the population, you just divide by n. Why? I watched a statistics video for 10 minutes on this concept. Why is it n and n minus 1? And they're talking about degrees of freedom. And I got to tell you, I lost the plot at about minute 2 of a 12-minute video. I was like, I want to explain this in my video. I couldn't. So you Google it. You can say, why n or n minus 1 when doing variance calculations? And you'll get an explanation. For me, it's just, if it's a sample of years, not the whole population, n minus 1. In our class, it's going to be n minus 1. Okay, so 0.0638 divided by n, the number of years, 5 minus 1. 5 minus 1 is 4, right? 5 minus 1 is 4. So 0.638 divided by 4 is a long-winded way of saying that. And I get 0.01595, or I have 1.595%. So what's the variance? It's 1.595%. Is that big? Is that small? What does that mean? The only way to do this would be to compare to other similar companies or companies in the industry. And you can say, oh, that variance is very high for this industry, or that's very low for companies of this sort. We don't know is the reality. We don't know what it means unless we can compare to something else. So we'll just take it as a number at this point. So the variance is annotated as this. I think it's a sigma symbol. I could be wrong. I don't know my Greek alphabet very well. This symbol squared. And the next part asks us for standard deviation. Well, standard deviation is just that symbol. So to get from this symbol squared to this symbol, I just take the square root of whatever my variance was, and that'll give me my standard deviation. So the square root of 0.01595, take the square root, and I get 0.1263 or 12.63%. That's my standard deviation. Now, again, is this big? Is this small? It's going to depend on the company, the industry, what's going on in the market at that time to know if that's big or small. The real key calculation here is variance. Once you get variance, standard deviation is easy. The reason variance is key, though, is because it's very useful in computing beta. And beta is a concept we explore in some detail next chapter. Let's stop 9.3a there. This is enough statistics for me. I hope you liked it, though, and I hope you'll give me a thumbs up. Thanks so much for watching. See you in the next video. Bye-bye. Let's take a look at problem 9.4a. We're doing arithmetic returns and geometric returns. Remember, arithmetic returns is just taking a simple average. We figure out what our return was for a given year or for several years, and we take the average just in the conventional way. Geometric returns are we don't take the average in a conventional way. We consider compounding principles. And you know, we are looking at the stock market. Stock returns tend to be compounding returns. We've looked at compound growth, or year-over-year returns. So here's why arithmetic returns can be problematic. I'll give you an example where using arithmetic returns or arithmetic average just gives you a ludicrous answer. So let's say I start with a $100 stock that's in year times 0. A year goes by and my stock goes down to $50. Actually, let's make it $60. And then another year goes by and my stock goes back up to $100. So year 2, I'm back up to $100. Okay, so you and I can look at this and say, over the 2 years, my return is 0, right? I put in $100 at the start. 2 years later, I've still got $100. I've had 0 return. But unfortunately, if we calculate arithmetic return as the way we've learned to do it in this course, we're going to show a funny number. So we went from $100 down to $60. This is minus 40%. we went from 60 back up to 100. I actually don't know the math here. Well, actually, I do know the math. Let's see. So we went up by 40 on an investment of 60, 66% growth, right? So we grew by 40 on our $60 investment. 40 divided by 60 is plus 0 or plus 66.7%. So what is our average return? Well, we total these two and divide by 2. So let's see, let's do it this way. 40 negative plus 66.7 positive equals 26.7, divide by 2. It's 13.33333 is what the answer would be. 13.333%. So if I did an arithmetic average here, I would say, oh, we had 13% return. You and I know, just looking at it, we had 0% return. So I'll teach you a technique here called geometric averages, or geometric average returns, that gets over that. If you run these same numbers at the end of the video, once you know how to do geometric returns, you'll see it works out to 0, which is sort of what a normal human would think of this investment. So anyway, I just wanted to introduce this concept to you to say arithmetic returns don't always produce reasonable results. They usually do. Usually arithmetic returns are fine. I think in most finance textbooks, most questions, you're expected to calculate arithmetic returns, but if you're asked to do geometric returns, you're going to learn how to do it in this video. Let's go ahead and calculate, though, the arithmetic average returns. So we got year 1 to year 2. Year 1 to year 2. And what's happened with our stock? It went from $50 to $52. So the stock price went up $2. And so change in price. And then the dividend. And then we'll do total return. And then we'll do percentage return. I know it's a lot to sort of take in here, but let's look at this one. Actually, let's go through each of them. So year 1 to year 2, there's a $2 price change. Year 2 to year 3, it's a negative $3.5 price change, right? From 52 down to 48. From 48 up to 61.75, it's a big number, 61.75 minus 48.5. It grew by 13.25. So that's year 4, and into year 5, it grew by $3.25 more. So if all we had to do is the price change, that would be fine. But we also have dividends. That's part of our return. So our dividend was plus $1, plus $1.25, plus $1.25, plus $1.40. So that's part of our return too. So our total return we saw in year 2 was $3 positive. Total return in year 3, we lost money even with the dividend. 3.5 negative plus 1.25 is 2.25. Zoom in on this a bit. 1325 plus 125 is 1450. And 325 plus 140 is 465 positive. Okay, so those are all my returns. The percentage return, to figure that out, you just take the return, divide by the stock price in the previous year. So I got $3 on a $50 investment. 3 divided by 50, 6%. I got $2.25 negative. Why did I put a positive there? $2.25 negative on a $52 investment. 2.25 negative divided by 52 is negative 4.33%. I got $14.50. Again, this is year 4 return. So on an investment that started the year at $48.50, I returned 14.5. So 14.5 positive divided by 48.50, 29.9%. So positive 29.9%. And year 5, 4.65 on an investment that started the year at 61.75. 4.65 divided by 61.75, 7.53%. Okay, so there we have our returns. Now, the average return, the arithmetic average, you just add these up, divide by 4. So let's do that. So 6 minus 4.33 plus 29.9 plus 7.53 is 39.1. I sum up that list, I get 39.1% as my total. Divide by 4, 9.775%. Wonderful. Okay, so that's the arithmetic return. The arithmetic average return on the stock, 9.775%. The geometric return works a little differently. You take your percentage return, and here's how I do it. I state that one as a decimal, so I'll just put decimal as my header, and I'm going to go over a couple more columns here. So 0.06, negative 0.0433, positive 0.299, and positive 0.0753. Okay. Add one. We're going to take one out at the end here, but we add one. So I'll just call this my plus one column. So 1.06. 1 minus 0.04. Let's see, 1 minus 0.0433 is 0.9567. 1.299, 1.0753. Then I compound the growth. Compound. I always just I say compound $1. So pretend I invested $1 in this stock. After 1 year, I would have 1.06. I would have $1.06. So I go 1 times 1.06 times, so after 1 year, it's 1.06. After 2 years, so times 0.9567. After 2 years, it's 1.014. After 3 years, so you might be saying to yourself, okay, I invested $1, right, in this $50 stock. Well, you can't invest $1, but just pretend. I invested $1. I get 6% return in year 1, so I'm up to 1.06, including my dividends. I lose money on the stock in year 2, and I'm back down to $1.01. You may be saying to yourself, well, wait, at 50, the stock's down to 48. If I invest $1 at 50 and now I'm down to 48, shouldn't I have less than $1 today? And the answer is no, because of the dividends, right? We had $1 and $1.25 in dividends, which more than make up for our $1.50 loss. So in any event, let's continue. You just compound this number. So you multiply this number. So you just multiply 1 by each number in this, and you just keep going down the list. So 1.014 times 1.299 is 1.317 times 1.07. 0753. And I get 1.4165. Okay, so there's my number. Now, this is a funny little mathematical thing. You might think, okay, I minus the 1, I divide by 4. We actually don't do that. We raise this to the power of a fourth. Because we're compounding the growth, and we want to say, okay, well, this is 4 years of growth, got us to 1.41. What does 1 year of growth look like? You go 1.4165 to the power of 1 divided by the number of years of growth we're compounding here, in this case 4. So 1.4165 to the power of a fourth. So now let's go y to the x, 0.25. I get 1.09095. 1.09095. Take away the 1. We put the 1 in arbitrarily. Now we take it away. We get 0.09095 or 9.095%. And there we have it. We've computed the geometric average. And it's just a different way of averaging that takes compounding into consideration. And of course, so much of finance is based on compound growth. So geometric average will sometimes produce a better answer than arithmetic average. Hopefully I've produced a reasonably good answer for you. And if I have, hit that button. Thanks so much for watching. See you in the next video. Bye-bye. Welcome to Module 10. Here we land on another fundamental concept in the world of finance, CAPM. CAPM stands for the Capital Asset Pricing Model, and it examines the relationship between risk of an investment and the expected return of an investment. And of course, it's very mathematical, as so many things in finance are. So there's this CAPM formula that you'll want to be familiar with. If I had like a cheat sheet or a formula sheet I was allowed to use, this would be on the list of formulas I would write down and have knowledge of heading into my finance exam. I want to explain the components of the CAPM formula. So here's the formula, but it's a bunch of Greek to me anyway. There's some literal Greek letter in it. Here we go. So the first, what we're solving for is the expected return of an investment, of an individual investment. And so obviously that's something you're very interested in. As an investor, you want to know what what kind of return you can expect. So that equals RF, the risk-free rate. And the idea with the risk-free rate is you could invest in, the typical example given is U.S. government T-bills. And let's just say the U.S. government T-bill is giving you 4%. Well, if you want me to buy shares of a company or bonds of something else, you want me to buy some other investment, you got to beat 4%. If it's not going to beat 4%, no reasonable person would invest when they could basically risk-free invest in the U.S. government and get their 4%. So the risk-free rate is just a baseline rate. So you better be making more than 4%, plus beta of the investment. So the lowercase I is like the investment that you are analyzing, right? The company you're considering. I'm thinking about buying stocks in Coca-Cola, right? The beverage. Okay, so the expected return of Coca-Cola stock equals the risk-free rate, the U.S. government T-bill rate, plus beta of Coke. And we'll put some numbers in here in a minute. And what is beta? Beta is a measure of risk, and it's really a measure of variability. And the idea here is, let's say the stock market goes up by 5%. What do we expect Coke stock, Coca-Cola, or whatever individual investment we're going to examine? Do we expect Coke stock to go up by more than 5% or less than 5%? Is Coke stock swingier or less swingy than the average, in the market? And I'll just tell you, Coke stock is traditionally less swingy. So if market's going up or market's going down, Coke is steady Eddie. And I guess the idea is whether the U.S. or the world is in an economic boom or an economic recession, we buy about the same amount of Coca-Cola, right? Coke isn't swinging up and down. It's just very steady. And so it would have a very low beta because beta is a measure of variance. So a beta of 1.0 means the stock is exactly as swingy as the market. If the market goes up, we expect the stock to go exactly the same. If the market goes down, we expect the stock to go down exactly the same. So Coke, we would think the beta here would be less than 1. In other words, 1 is exactly the same as the market. 0.6, say, would be less than the less swingy than the market. And if it was like 1.6, that's much more swingy than the market. So stocks like Coke, or maybe utilities, like the electric company or electric companies you can invest in. Well, whether, there's a recession on, well, you still got to keep the lights on. You still got to, turn on your air conditioner when it's hot. So the electric company utilities are thought of as low beta investments because they're not swingy. Well, what are high beta investments? Tech companies are a great example of a high beta investment. If markets are ripping, if markets are going up, typically tech companies are outperforming. And when markets dip, typically tech companies fall faster. So Netflix is an example of a company that, when things are good, Netflix goes up faster. When things are bad, it goes down faster. And you can think of myriad other tech companies that would fit this description. So B is for beta. And that's just the word we use, beta. And that's a measure of the volatility of a stock. And the volatility is a risk measure. So beta of the investment, right? Coke in our example. Times the expected market return. So again, sort of an average market return. Minus that risk-free rate again. Now, what's in brackets, actually has a phrase. So the expected market return, let's just say we expect the market to return 10%. I'm talking round numbers. The market return is 10% on average. The average company listed in this index or whatever in this stock market, we would expect to see the total market be 10%. And our risk-free rate, the US T-bill rate, let's just say it's 4%. So in my pretend example, let's use Coke as our pretend example. So, let's figure out the expected return of Coke. Let's say the risk-free rate is 4%. Coke's beta is low. Let's just say it's, again, I'm making up numbers, but let's say it's 0.7. And that can be measured, right? You can look at the historical performance of the company and say, well, when the stock market went up, one day to the next went up by 2%, Coke only went up by 1%, say, and then you take that relationship. It's variances and covariances, and it's for a more advanced finance class to actually calculate that. In our class, you'll be given the number for beta, but Coke is less swingy, and let's just say the measure is 0.7 times expected market return minus risk-free rate. Let's say the expected return in the markets right now is 10%. The risk-free rate is, again, 4%. They call this, what's in brackets, the market risk premium. And the idea is, how much money are you getting by having your money invested in the markets as opposed to buying U.S. Treasury bills or something risk-free? And the answer is, you're getting a 6% bonus by taking on risk. That's why they call it a market risk premium. So let's look up the expected return for Coke. 4% plus 0.7 times 6%. 0.7 times 6 is 4.2. 4 plus 4.2 is 8.2%. So there you go. That's it. We have solved, we've used, and so the math here isn't hard, right? We've used the CAPM formula. This is the capital asset pricing model. And coming up with those components can be challenging, especially beta, although any big public company, you can just look up the beta, right? You can find the betas of various companies. Okay, so it shouldn't be lost on you. This actually has the components of the formula for a line. If you think back to your algebra class, y equals mx plus b. Well, here's our y equals mx plus b. It's a little out of order here, but this is y. This is b, right? This is our intercept. This is our x. And what's in brackets is our M. So the risk, market risk premium, sort of this whole thing is M. So we got a formula for a line, and some smart person said, well, why don't I show them the CAPM formula as a line? And they gave it a name. It's called the security market line, Y equals MX plus B. And here is roughly what it looks like. So I'm going to assume our risk-free rate is 4%. And so I'm going to put a point there on my line. And the point there says at 0 beta, at no risk, I can get 4% by, again, buying U.S. Treasury bills or whatever the equivalent risk-free investment might be. And it might be lower than that right now, but let's just say our risk-free rate is 4%. It gives us something to talk about. Let's say the market average return, as I discussed last time, maybe 10%. It's probably less than this. Again, I'm not giving exact numbers here because it can change over time, but let's just say the return in the market is 10% of the overall market. Well, I've got 2 points in a line here, right? I've said, well, at 1, which is the average risk in the market, I get the average return of the market, which I've said is 10%. Again, we can figure out what those actually are. Well, now I can draw a line, right? Like literally a line. I got 2 points in the line, and I can draw a line. Let's see if I can make these connect. There we go. Good enough. So there we go. I've got my security, and they call this line the security market line. And the idea is, if you've got a stock, and let's just say I have a stock with a 0.8 beta, and for whatever reason, it's getting 12% return. Well, what's going to happen to that stock if our markets are efficient? And I think we can assume they are reasonably efficient. They're not perfectly efficient, but they're reasonably efficient. Well, people will see, investors aren't stupid. They will look at this and they'll go, my God, that stock is wildly outperforming expectations, right? A stock with a beta of 0.8 should be returning like 8.75% or something. You could put the numbers into the CAPM, and they'll look at it and they'll go, my God, it's returning 12%. And what will they do? They will buy the stock, and there will be pressure on the stock price pushing it up because there will be demand for the stock, right? More and more people buying, and the bidding price will go up. And what will eventually happen is the stock price will rise. And once the stock price rises, returns are inversely correlated to that. The return will go down. So in other words, if I have a $100 stock that is giving a 20% return, and it's the exact same stock, but the market realizes, oh my God, it's a 20% return, and they start bidding it up, and they bid up the price to $200. Well, okay, 20% return on a $100 stock is $20 annual return. Well, if they bid up the price to $200 and it's still the same $20 return, all of a sudden it's a 10%. And so that's how markets work, right? And so if the expected return of a stock is above the line, markets will just pound it down to the line. They'll if we assume markets are efficient, and we do, the price will adjust. And the same thing if the price is below the security market line, right? If it's somewhere down there, what'll happen is people aren't stupid. They'll look and they'll go, I'm not getting sufficiently rewarded for the risk that I'm taking on, and they'll sell the stock. There will be downward pressure on the price. And if there's downward pressure on the price, it's an inverse of this. There will be upward pressure on the expected return. So I know it's a bit of a long intro video this time, but I hope it was useful because it's a fundamental concept. You're going to want to understand this CAPM formula. You're going to be working with it this chapter for sure. And it would be useful if you understood how the security market line worked. Lots of examples this chapter. I can't wait to get started. In this video, we're going to work on a problem you can download from tonybell.com. Go to the website, click the PDF link, and you'll notice there's no sign in, no sign up. The PDF just pops right up. You'll scroll down and find whatever problem it is that we're working on. As you scroll through the problems, you'll notice many are free and open, like the one you're watching now, but some are members only. I think the free and open ones are enough for most people, but if you can't get enough of me and you'd like to join and get access to those members only videos, click the join button underneath the YouTube play box. All right, thanks so much for watching. Let's get started. Let's take a look at problem 10.2a. This one's a challenging problem. I think it'll take us a while here. If you look at the bottom of the scroll bar, I bet you I'm over 20 minutes, maybe 21 minutes and 18 seconds. That's my prediction. Wouldn't that be amazing if I hit the nail on the head? But we'll see. The reason it's challenging is calculating variances. And variances are required to calculate standard deviations. Calculating variances and standard deviations by hand is time consuming, and you just got to be slow and careful, and that's what we will be. Let's jump into the problem. Below is information about 2 stocks and various possible economic situations. So there's a 20% chance we'll be in a bust, and if we're in a bust, stock X gives us 10%, stock Y gives us negative 20%. There's a 70% chance this economics will be normal, and those are the expected returns in that situation. And there's a 10% chance of a boom cycle. So the first question is compute the expected returns for the individual stocks. I've just moved this to where I can scribble all over the screen, but it's all the same information. So what's the expected return of stock X? Well, the way you would do this, you'd say, well, there's a 10% chance, or rather, there's a 20% chance that we're going to get a 10% return. You just multiply those two probabilities, 20% times 10%. So 20% times 0.1, and that equals 2. Now, the 2 doesn't mean much, but what we do is we take the sum of these things and we get a weighted average. 70% chance of a 15% return. So 70 times 0.15 or 0.7 times 0.15. Anyway, it's 10.5, and 10% chance of a 20 is 2 again. So I get 14.5%. That is my expected return of stock X. So 14.5% is that is hideous. Expected return of stock X. My expected return of stock Y, I go, okay, well, there is a 20% chance we're going to have a negative 20% return. So negative 20% times negative 20% is negative 4%. 70% chance of a 20% return, that's positive 14, and 10% chance of a 55% return, that's 5.5. Just doing some math here. So let's add that up for stock Y. 4 negative plus 14 positive plus 5.5. 15.5%. So our expected return for stock Y is 15.5%. Now, you might look at this and say, well, I want to get more return, therefore I want stock Y. But of course, not every investor would agree with you. Lots of investors would say, I'd rather have stock X, which seems like way more stable returns. You know, a worst case scenario of a 10% return is really, really good. So I'd sign up for that. But you may sign up for stock Y, but there's a reason that investors aren't just piling into one stock or another, and it's the variability in those returns. So variability in returns is a useful information to have, and that's where this question leads us. It asks us for the variability of the return, and it asks us to calculate the variation and standard deviation in the return. So that is an economics or statistics concept. So let's do it. We're going to calculate the standard deviations, and to do it first, we calculate the variance of the return. So stock X had an expected return of 14.5%. So we deduct our expected return from the projected return in these various scenarios, and we get a difference. So 10 minus 14.5 is negative 4.5%. 15 minus 14.5 is 0.5%. 20 minus 14.5 is positive 5.5%. I'd like these all to be decimals when I put them into my calculator. So negative 0.045. This is 0.005. And this is positive 0.055. Okay, so we've converted our percentages to decimals. Now, calculating variance, it's the sum of the squared differences. So we took the difference between our projected return on stock X and the average or mean return, the average return, and we got a difference of 4.5%. Now we square those differences. So 0.045 negative squared. And we're going to get very small numbers here. 0.002025. This is going to be an even smaller number. 0.005 squared. 0.012345. And now 0.055 squared. 0.003025. Okay, so again, very small numbers. That's life. Now, making matters a little more difficult for us is we want to apply the probabilities of the situation. And so again, our numbers are going to get microscopically small to the point of not meaning much to me. When we work back to standard deviation, that number means something to me. Even the variance number, in my heart, I don't have a strong feeling when I see a variance. I want to see the standard deviation. That gives you better information. But in any event, we're getting to the variance first. We apply our probability. So we multiply this one by 20%, multiply this one by 70%, multiply this one by 10%. And again, we get very small numbers. I'll start with the bottom because it's already in my calculator. Multiply that by 0.1, and we're at like 0.1233025. Okay, next one, 0.012345 times 0.7. 0.1234175. My Lord. 0.002025 times 0.2. Oops, missed the button. 0.2. There we go. 0.123405. And now we just add these up, and this is our variance. So that number plus 0.1234175. Just got to be careful. We just go slowly here. 0.01233025 equals, holy cow, we got there, 0.000725. That is our variance. Again, that number, it looks to me like a very small variance, and that's what we expect. There wasn't a huge variance between the options, especially if 70% of the time you're going to land on that. That's not a huge variance. Even when we hit our outliers, it's not a huge variance. So standard deviation gives us this number as a percent. I take the standard deviation by just taking the square root of the number, and I get 0.0269, which I'll just convert to a percentage right now. I'll call it 2.7%. So our standard deviation here, 2.7%. So again, we're expecting a return of 14.5% plus or minus 2.7% is the standard deviation. Okay, so in any event, it's a measure of the variability here of our returns. Okay, let's move along and do the same thing for stock Y. So stock Y's expected return was 15.5%. And what we're going to find is, look at these returns, way more variance, way higher standard deviation. So I subtract my expected return for that stock. Negative 20 minus 15.5 is negative 35.5%. 20 minus 15.5 is 4.5%. And 55 minus 15.5 is 39.5%. Just doing the math in my head. We square the differences. So I'll state these as decimals. Negative 0.355, negative 0.045, actually positive, doesn't really matter, and positive 0.395. The reason I say it doesn't matter is because we're going to square them, and so negative numbers become positive when squared. So 0.355 negative squared 0.12. I'm going to stop here. 0.1260. I'll just stop after 4. 0.1260. 0.045 squared, 0.0020, and 0.395 squared, 0.1560, 0.1560. Okay, so we've squared the differences. Now we apply the probability of a situation, 20%, 70%, and 10%, and we will sum that up to get our variance. So let's go to it. 0.126 times 0.2, 0.0252, 0.002 times 0.17, no, not 0.17, 0.7, my goodness, 0.0014, and finally 0.156 times 0.1, 0.0156. We're going to sum those up, so we'll add that to 0.14 and add that to, oh, that seems off. Hold on. Let me just cool my jets. The number seemed weird. 0.156 times 0.1. It's 0.0156. I'm going to add, I think this is where I screwed up, 0.0014. There we go. And I'm going to add 0.0252. So I get 0.0422. And now I square root it to get my standard deviation, which again, our last standard deviation was 2.7%. This is going to be way bigger than that. Let's do a square root and figure it out. 20.5%. So it's like 10 times bigger. So yeah, much bigger standard deviation here with stock Y than stock X. Now, what do we use this for? Well, it's used a lot in the variability of a stock is like useful information for an investor to know. And so these are the statistics behind the scenes, right? This is the math behind the scenes. Okay, so we've computed the standard deviation. We've solved part B. Moving on to C, and this is another sort of challenging part. There's actually two pieces. The first part's easy, the second part's harder. It says, assume your portfolio is weighted 70% to stock X, 30% to stock Y. Compute the expected return for the portfolio. So we've said stock X is going to give us 14.5%, and 70% of our money is going into stock X, 30% is going into stock Y. So you just multiply 70% times our expected return there, 14.5. 14.5 times 70% gives us a number, 10.15. And we're going to add that to 15.5 times 30%. And we get 4.65. We add them together. 10.15 plus 4.65, and I get 14.8%. That's the weighted average return in the portfolio. So that answers part C. The first part, compute the expected return. It's 14.8%. Now on to the expected return and standard deviation. Okay, this one, it's a multi-step process, but we'll get there. 70% of my stock is stock X. 30% of my stock is stock Y. So let's just go through the economic situation of a bust. Let's say, again, I've got 70% of my money in stock X, 30% of my money in stock Y, and there's a bust cycle. What happens to me? Well, stock X, 70% goes up by 10%. So 70% of my stock goes up by 10%. That means it's a plus 7% to me. Again, 70% goes up by 10%, 7. 30% goes down by 20%, that's a negative 6. So overall, plus 7 minus 6, I'm plus 1%. My portfolio, my wealth is going up by 1% in a bust. What's happening to my wealth in a normal situation? 70% of my stock's going up by 15%. 0.7 times 15. That's a plus 10.5 to my wealth. And 30% of my stock is going up by 20%. I think I was pointing at the wrong 70. 30% of my stock is going up by 20%. That's a plus 6. So in the event of a normal cycle, I'm expecting my portfolio to go up 16.5%. What about a boom cycle? Well, 70% of my stuff's going up by 20%. That's plus 14. And 30% is going up by 55%. 3 times 55, that's 16.5. 14 plus 16.5 is 30.5. And that's another plus. So good news for my portfolio. It looks like it's going up no matter the cycle. But what is the, sorry, I have to now apply, just hold on, I need to think for half a second. Oh, I got it, sorry. I was like, okay, so these are the states of that might be. I might go up 1%, I might go up 16.5%, or I might go up 30%. So all I do is I take away my expected return to figure out the variance from expectation. And it's just a pretty straightforward variance problem from here. So 1% minus 14.8% is negative 13.8%. 16.5 minus 14.8 is 1.7 positive. 30.5 minus 14.8 is 15.7. All right, let's state these as decimals, then we'll square them. So this is negative 0.138. This one is positive 0.017. And this one is positive 0.157. We square those. So 0.138 negative squared is 0.190, 0.0190, 0.017, we square 0.0003, and the last one 0.157 squared, 0.0247. Okay, so we've squared those. We also need to apply the probabilities here. So we multiply here by 20%, by 70%, and by 10%. We'll answer that. We'll sum those all up, and that's going to calculate our variance. Okay, let's do it. And again, we're going to get very small numbers here, but that's what we're after. 0.019 times 0.2 is 0.0038. 0.0003 times 0.7. Oops, missed the times 0.7 is 0.0002. And we'll leave off the 1 point. I'm going to 4 decimal places here. 0.0247 times 0.1 is 0.0025. Okay, let's add up our list to get our standard or our variance. 0.0038 plus 0.0002 plus 0.0025. So the sum there is 0.0065. That is my variance. Square root to get the standard deviation. Square root of that number is, let's see, 8.06%. So our standard deviation of these returns, sorry, these ones is 8.06%. To answer the question again, what's the expected return for, oops, I'm looking at the wrong thing here. What's the expected return? 14.8%. What's the standard deviation? 8.06%. The last piece, actually a very short one, mercifully short, given how long that took. Assume a risk-free rate of 2.5% for the portfolio above, same portfolio. What is the expected risk premium? Okay, well, our expected return, so the risk premium is just the expected return minus the risk-free rate. That gives us our risk premium. So this one's easy. Our expected return of that portfolio is 14.8%. That actually wasn't that hard to get. Our risk-free rate, 2.5%. So what's the premium for taking on risk? It's 12.3%, just the difference between the two. And there we have it, folks. We've solved a big one. I hope this problem helped. I know it's difficult. Some of these variance and standard deviation things can be tough, but I hope I'm helping you get through it. Thanks so much for watching, and I'll see you in our next video. Bye-bye. Let's examine problem 10.4a, and to do it, I'm going to have to discuss the capital asset pricing model. A fundamental concept in a corporate finance class is this CAPM model. So let's explain the model, and then we'll solve the problem. We'll use it, and hopefully that'll help. The model's about pricing or determining the value of investments, and one way of doing this is calculating the expected return of the investment, how much the investment would be expected to return. We do that. Here are the components. We take the risk-free rate, we add, and now this is all a chunk, right? Beta times the expected market return minus the risk-free rate. That's the market risk premium. So let's start with the risk-free rate. Of course, it's risk-free rate plus something, because if it wasn't going to return more than the risk-free rate, I would just buy T-bills, right? Save myself a lot of time and hassle. I don't have to think about an investment. I can just buy T-bills and get the risk-free rate. So any investment you're contemplating, the risk-free rate is like the starting point. It's got to be at least returning the risk-free rate. So what's in the brackets? The plus beta. Well, beta is, again, a measure of risk within the investment, and it's sort of saying if the stock market moves by 5%, we would expect the investment to move by beta times that. So if the beta is 2, stock market moves 5%, our stock we would expect would move 10%. It's way swingier than the market, which means riskier than the market, but also expected returns are higher with a higher risk tolerance. What's in the brackets? Well, it is the market risk premium. It's that amount we expect the market to return above the risk-free rate. Okay, let's apply that to our problem and just sort of crunch some numbers. I'm going to erase this heading. We're going to solve. So stock number 1. Let me just do number 1 here. So our expected return on stock 1 equals, what's the risk-free rate? 3.5% plus, what's the beta of that stock? 1.3 times the expected market return minus the risk-free rate. Well, I'll just do the number here. 12 minus 3.5 is 8.5%. So times 8.5%. Okay, so now we can solve for the expected return of stock 1. I go 1.3 times 8.5% plus 3.5. The expected return of stock number 1 is 14.55%. Now, as our betas drop, our expected returns are going to drop as well, because we're taking on less risk. There is less return needed here. Let's do stock number 2. I guess I'm working upwards here. Our expected return of stock 2 is same risk-free rate, 3.5%, plus our beta is the only thing that changes here, 1.1 times 8.5%. 1.1 times 8.5% is 9.35. We add that to our 3.5. We get 12.85%. Our last one, make it red pen. Number 3, our expected return on stock 3. Again, our risk-free rate's the same. Like, you can buy T-bills the same amount no matter what investment you buy. The only thing different here is the beta is 0.8. We multiply that by, again, the market risk, which is 12, minus the risk-free rate, which is 3.5. So it's still 8.5%. So let's run the numbers. 0.8 times 8.5%, 6.8 plus 3.5, and it's 10.3. And this is our first one, by the way, where the expected return is lower than average for the market, right? You can see the market average return is 12. We're only getting 10.3. Why is it? Because we're less risky than the market. So there's less of a premium for us. Okay, there we have it. Our first look at CAPM. CAPM. That's how I say it anyway. Thanks for watching. See you in our next video. Bye-bye. Let's have a look at problem 10.5a. We're just using our capital asset pricing model to CAPM to solve for a missing variable, essentially. We're given details of a stock. We got the expected return of the stock. So we got this one. We got the risk-free rate. So we got this one. We got the beta. So we got this one. We also have the risk-free rate there. We're just missing that one. And that's what it asks us to compute. Well, if we have all the pieces except one in a puzzle, you can solve the puzzle, right? This is an algebra puzzle. Let's plug in the information we've got and see how we solve it. So the expected return of the stock is 14%. The risk-free rate is 3. The beta is 1.2. We don't know our expected market return. That's what we're solving for. But we do, again, have the risk-free rate of, 3. Okay, so, again, we got an algebra puzzle in front of us. I'm going to actually move this stuff down just to give myself a bit more room to operate. Let's solve for what we can solve. I'm going to move the 3 over because just subtract 3 from both sides. So 14 minus 3 is 11. That equals 1.2. Times our ERM minus 3. So let's multiply the 1.2 into the brackets. 11% equals 1.2 ERMs minus 3 times 1.2, which is 3.6 minus 3.6. Let's add 3.6 to both sides. So this is 14.6 equals 1.2 times ERM. Now let's divide 14.6 by 1.2, and we've solved it. 14.6 divided by 1.2 equals 12.17. So, well, that equals ERM, I guess. ERM equals 12.17%. So my expected return in the market here is 12.17%. I can check if I did the math right by just like plugging the numbers back in, so solving for ERI by going, okay, well, my ERM is 12.17%. My risk-free rate was 3. My beta was 1.2. Risk-free rate is 3. And so I can work backwards and get that is 14. Hopefully it is. Let's see. 12 point, and I'm going to actually leave all the decimals, 12.16666, just because I'd be off by maybe a little bit. Minus 3 times 1.2. It's 11 plus 3 is 14. So yeah, the maths. We've solved it. There you have it. Thanks so much for watching. As always, have a great day. Bye-bye. Let's take a look at problem 10.7a. We're doing lots of calculations. These calculations have us doing weighted averages. There's a little bit of algebra here, but I think it's an interesting problem. Let's jump into it. So 50% of an investor's portfolio consists of one stock with the following characteristics. The expected return of the stock, 17%, the risk-free rate, 4%, and the stock has a beta of 1.4. That means if the market moves by 10%, we would expect our stock to move by 14%. We've got a swingier and riskier stock than the average in the market. The other 50% of the portfolio is invested in U.S. government bonds, which earn 4%. And we all know the beta of these risk-free bonds is 0. And the reason is there's no swinginess to them, right? The market swings, they're still going to return 4%. Okay, so what is the expected return of this portfolio? We've got our stock, and we've got our government bonds. And our stocks are expected to return 17%. Our government bonds are expected to return 4%. And we got half stock, half government bonds, so our return's going to be just in the middle. Now, we'll do this as a weighted average calculation, but you could do a simple average, 17 plus 4 divided by 2. It's 10.5. I did it in my head. But this is how I'd advise you to do these types of calculations, because the weight's not always going to be equal. So you take the weight, which is 50% in our portfolio. It said we're 50% of the portfolio is stock, 50% is the government bonds. You multiply them through, 17% times 50% is 8.5. 4 times 50%, half of 4% is 2%. Then you add them together, 8.5 plus 2, 10.5%. We got it. We got part A in the bag. Let's move on to part B. I'm actually going to scroll down just to clear off some space. If an investor desired a portfolio beta of 9, what would the relative weights of the stock and government bonds need to be? Another weighted average calculation. This time, we'll compare our stock and our government bonds, but not along the expected return line. No, along the lines of betas. So the beta of the stock is 1.4, and the beta of the government bond is 0. Now, had we been 50-50, let's just estimate that. So if the weights, now this is not going to give us the right answer. Don't write this down. We'll write down the right answer in a minute. This is just to illustrate a point. Had we been 50-50, 1.4 times 50 is 0.7. 0 times 50 is 0, so 0.7 plus 0 is 0.7. The weighted average beta of our portfolio is 0.7, and it's saying, no, we want a beta of 0.9. We're going to have to take on more stock, right? Because adding government bonds to this portfolio doesn't add risk. So we're going to have more than 50% in stock. But what's the number? So here's how you do it. I'll change my ink here, maybe. Let's change this, and let's change this, and we can erase that too. Okay, so we're sort of starting from scratch again. We are desiring a beta of 0.9. We know whatever number goes in here, and we don't know the numbers yet, but we know whatever number goes here in government bonds, 0 times whatever is going to be 0. That's one of the cool things about multiplying by 0. So we know 1.4 times this number, it's got to be 0.9, right? It's got to work out to 0.9 to make our portfolio beta 0.9. So how do I figure that out? Well, I just go 0.9 divided by 1.4, and we'll get there. 0.9 divided by 1.4 equals 0.642857. Oh, nice even number. I like when I can write a question that's beautiful, even numbers like this. Okay, well, 64, let's call it 64.3%. Okay, well, if we've got only 2 items in our portfolio, stock at 64%, the government bonds got to be the rest. So I just take away 1 plus minus. It's 35.7%. There we have it. We've solved part B. If an investor wants a portfolio with a beta of 0.9, what's the relative weight of the stock and government bonds? We'd have 64% stock, 36% government bonds, and we'd be right on our 0.9, our desired beta. Beta, if you're in the UK, I think. What do you say, beta or beta? I wonder. They talk about software betas when I listen to podcasts with UK hosts. I call them betas, though. Okay, let's continue. I could get very sidetracked there. If an investor desired a beta of 3, What would the portfolio weights need to be? Oh, we need way more stock. So it's exact same question. I'm going to just erase what I've got here in blue. And I'm going to say, okay, we want to have a 3 over here. Well, okay, well, we're solving for this. Again, the weights. 0 times whatever that weight is going to be 0. 1.4 times something it's got to be 3 down here. So 1.4 times what is 3? I go 3 divided by 1.4. 1.1428. 9 maybe. 2.14. I'm going to say 2.143. 2.143. Now, what is that as a percentage? It's 214.3%. Okay, this is confusing. And look at the question. It says, if investors are beta of 3, what would the portfolio weights need to be? This produces a funny looking result. Yeah, it is funny looking to have 200% of my portfolio in stock. How can you have more than 100% of your portfolio in anything? And in fact, if I want this to work, I need to have negative 114.3% in government bonds, because of course my portfolio's got to add up to 100%. You know, if I had 30% stock, I would need 70% bonds, because 30 plus 70 is 100. Well, if I have 200% stock and I have well, I know my this plus this has got to equal 100%. So I know this one's got to be negative 114.3. It's a crazy number, right? It's a strange number to see. What does it mean? It means to get this much beta, and this is a lot of beta, right? This is high volatility, high risk. We need to borrow, and we need to borrow at that government rate, the 4% rate. We need to borrow money to invest more money in stock than we even have. So it means you need to lever up, right? You need to get leverage and buy more stock. You know, maybe you're buying options or you're borrowing money to buy the stock, but it means you need to be taking even more risk on if this is what you want to do. So the implication here is we're borrowing. You know, if you had, let's just pretend these are thousands of dollars, right? You have $100,000 in your portfolio. You got to invest all $100,000, plus you need to borrow another $114,000 to invest in that stock to get sufficient risk and sufficient variance to get a beta of 3. Okay, that's what produces that funny looking answer. Let's move on to D. D says, what relative weights between the stock and government bonds would be needed to produce an expected return of 9%? Okay, this kind of goes back to the first calculation. Maybe I'll scroll up there and do it on top of that. Is this the one? Yeah, this is the one. So what this one is saying is, you know, okay, the stock has return of 17%, the bonds have a return of 4%. And if they're 50-50, our overall return is 10.5. Now it's saying, well, I want a return of 9. What relative proportions do I need to get a return of 9? I'm going to write this out slightly differently. So I'm going to say, okay, our stock is 17%. Times its proportion, which we're going to call P in this example. I called it X, but then I had a times X when I did this question previously, and I got confused. I'm going to call it proportion, plus 4%, 4% times 1 minus the proportion. In other words, if the proportion here is 70, the proportion here is 1 minus 70, it's 30, right? So we're only solving for one variable, thankfully, right? It looks kind of like we might have two variables, but it's really only one, and that needs to equal 9%. Now we just solve for our proportion variable. So 17% times proportion. So I'm just going to get rid of the percent signs because there's percent signs all through it. I'll multiply both sides by 100 just so we're dealing. The numbers are going to work out. So I'm going to have 17p proportion plus 4 minus, I'm multiplying the 4 in, minus 4p equals 9. Okay, so now I can really solve here. 17 minus 4, right? 17 minus 4 is 13p. Equals 9 minus 4 is 5. So 5 divided by 13 38.5%. P equals 38.5%. What does that mean? It means we want to have 38.5% of our money tied up in stock, the rest tied up in government bonds. Let's figure what that is, minus 1. 61.5% of our money tied up in government bonds. Let's make sure we're right. So we can just calculate this through 17 times 0.385, 6.545, and 4 times 0.615, 2.46. All right, so it's 2.46 plus 6.545 equals 9.005. There's some rounding going on, right? We rounded a couple of numbers, but we got there. This, if we had 38% of our portfolio in stock and 61% in bonds, we would get a 9% expected return. There we go. If you made it to the end, as always, I genuinely appreciate a thumbs up. If you loved it, maybe hit the subscribe button. Thanks for watching. Have a great day. Bye-bye. Let's take a look at Module 11, Weighted Average Cost of Capital. So it's all in the name, but the name might not mean much to you. Weighted average, so basically the average, and we'll talk about what weighted average means here in a second. Cost of capital means how expensive is it for us to get long-term funding, right? Funding for our projects. And if you raise money from shareholders, that has one cost, the cost of equity. If you raise money from debt holders, that has a different cost of debt. And so the idea is we're going to figure out the company's cost of equity, their cost of debt, and then figure out their overall sort of cost of capital for the company, and that's the weighted average cost of capital. Now, why do I need to know what's the cost of capital for the company? And the answer is it's useful in considering the discount rate for projects. Now, this isn't used, well, it could be used as a discount rate, but every project's going to be a little different, but it's a good baseline for the company to say, well, this is how much it costs us to get long-term funding. So when I'm figuring out a long-term project, it's often used as a baseline for the discount rate. Now, they might calculate this number and tweak it higher or lower depending on the risk of the project, but this is a useful baseline number for the discount rate, the required rate of return of a project. So it's a fundamental concept in finance, and it's actually a pretty straightforward concept in finance. So we look at a company's balance sheet and we say, okay, here's this, fake company I made up with $2 million in liabilities and $3 million in equity, balancing to $5 million in total assets. And we want to say, well, our long-term funding, our liabilities and equity, what is the cost of that long-term funding? So we would determine the borrowing cost by looking at things like our bonds and the yield to maturity on our bonds. That is our borrowing cost. So let's say we did some calculations, and you will likely have to do this when you do the chapter. You'll have to figure out, okay, well, with bond math from chapter 4, figure out the yield to maturity, the I on the bond, the rate of return on the bond. And let's say our bond rate is 8%. What's the cost of borrowing on a bond then? Well, you might think, well, it's 8% because that's the borrowing cost of the bond. But because bonds create interest expense, and that 8% is an interest cost, actually, we don't pay the full 8%. It reduces our tax bill by 25%. We pay 8% times 1 minus the tax rate. 8% times 1 minus T is 1 minus 0.25 is 0.75. We pay 6%. 8% times 0.75 is 6%. So on our $2 million of liabilities, the cost of capital is 6%. On our cost of equity, and how would I determine cost of equity? Well, with borrowing cost, you do bond math, typically. It might be given in your question in your class, but very often the professor will make you do some math related to bonds, and you figure out the yield to maturity, and that's the I in your financial calculator. With cost of equity, again, the professor likely won't give you that number. We are doing it here because it's the intro to the chapter, but you'll see in chapter question, I make you calculate it. With cost of equity, it can either be derived, depending on what information is given, by using the dividend discount model we introduced in previous chapters, or more likely what we did last chapter, CAPM, capital assets pricing model, and that's the expected return on an investment. That is our internal cost of equity. For the shareholder, that's how much money they're getting. For us, that's our cost of equity. So typically going to be derived using the CAPM formula, which if you're not sure what that is, you're going to have to revisit last chapter's material. I revisit again this chapter, but just so you know, this number, it might be given to you in the question, but it's very often something that the professor makes you calculate. So let's just say we say our cost of equity is 12%. Okay, so if I were to take a simple average here, 6 and 12, the average, and cost of debt, liabilities, is always going to be cheaper than cost of equity, if for no other reason than its interest is tax deductible. So it always tends to be cheaper. If I were to take an average between 6 and 12, I would go 6 plus 12 is 18. 18 divided by 2, my average cost here is 9%. But I have more equity than I have liabilities. So this is where the weighted average comes in. If I look at my total liabilities and equity, it's $5 million, right? Just add the two together. And my debt is 2. And my equity is 3 to total 5. Well, of this $5 million, you can do some quick math. The 2 divided by 5 is 4, 40%. And 3 divided by 5 is 60%. I'm 40% debt, 60% equity. That's the relative weight. So to figure out the weighted average, we just multiply. We don't add together and divide by 2. We multiply this one by 40%. We multiply this one by 60%, and then we're going to add them together, and that'll give us our weighted average cost of capital. So 6 times 40 is 2.4%. 12 times 60 is 7.2%. Add them together. 2 plus 7 is 9. 4 plus 2 is 6. 9.6%. So you can see our average cost of capital was 9, but that's not a relevant number. The weighted average is 9.6. And why? Because equity has more weight than debt in our average, because there's more equity than there is debt. So assuming the company is going to continue with the same sort of fine debt to equity ratio, this is the cost of capital. And so this number, 9.6%, can be used as a baseline in determining discount rates and things like that. So that's why weighted average cost of capital is a core component to the question. You're thinking about, long-term financing, right? You're thinking about new projects, as we are all the time in finance, and you're saying, well, what's the discount rate of this? And this is a great starting point. Well, this is how much it costs us to get money, 9.6% on average. So, we're going to want to make more than that in our returns. And you might make it much higher if it's a very risky project, maybe a little lower if it's not a very risky project. But this is a great starting line for that required rate of return. There you go. The weighted average cost of capital. We're going to do tons of calculations this module. Stay tuned. Let's run through 11.5a. It says the company's target capital structure consists of 60% debt, 30% common shares, and 10% preferred shares. And some facts are below. And our cost of debt, 12%. Common equity 18, preferred equity 10, and the tax rate is 25%, meaning our cost of debt isn't 12. Well, our pre-tax cost of debt is 12. What's our after-tax cost of debt? We multiply that by 1 minus the tax rate. So I'm going to multiply that by 75%. 12 times 0.75 is 9. And now I just apply the weights. I go, okay, well, debt is 60% of my portfolio. It's 9%. So let's do a weighted average here. These weights have to add up to 100. 18 times 30% and 10 times 10%. Let's crunch those numbers. 9 times 60%. What is that? 65.4 times 0.09. 5.4. I always get it as I'm like putting it in the calculator. 18 times 30. Also 5.4? That would be weird. I should change the numbers next time I revise this. 18 times 0.3. Yeah, also 5.4 in a strange coincidence. 10 times 10, not 5.4. It's 1. Okay, so there we have it. Add them up. 10, 11. It's 11.8%. That's our weighted average cost of capital. That number is the number the company ought to be using when it does the, it's looking at a project and it has to compute its required rate of return. That number that we've taken as given the whole course. Well, this is how the company figures out the number, and we've figured out how to do cost of debt and cost of equity in previous questions. So you just figure out, well, this is my capital structure, desired capital structure, and this is what the weighted average cost of capital is at that structure. And now when I think about future projects, my required rate of return for this company is going to be like 12%, 11.8%. So there you have it. One other thing students sometimes wonder is they go, well, that's 9%. It's cheap, right? Equity's like 30. Why don't we just go like all in on debt? And the answer is because as that changes, your risk levels change, right? If you go all in on debt, you're so highly leveraged, nobody's going to lend to you at this 12%/9% after tax. So you change a variable significantly and it can throw the whole thing out of whack. And, your bankruptcy risk is just through the roof. If it's almost always debt. Debt is cheap. So, almost always it would be like, well, why don't we just take on more debt? And the answer is because your cost of debt will go up as you take on more debt. Anyway, there we have it. We've solved 11.5a. Hopefully it doesn't cost you much to smash one of those buttons. Thanks for watching. Goodbye. In this video, we're going to work on a problem you can download from tonybell.com. Go to the website, click the PDF link, and you'll notice there's no sign in, no sign up. The PDF just pops right up. You'll scroll down and find whatever problem it is that we're working on. As you scroll through the problems, you'll notice many are free and open, like the one you're watching now, but some are members only. I think the free and open ones are enough for most people, but if you can't get enough of me and you'd like to join and get access to those members only videos, click the join button underneath the YouTube play box. All right, thanks so much for watching. Let's get started. Let's take a look at problem 11.6a, weighted average cost of capital. This might be my favorite question of the chapter. If I were a professor of your class and I were giving an exam, I would likely give a question that looks like this. Why? Because it requires us to calculate the cost of debt, calculate the cost of common equity, calculate the cost of preferred equity, and once we have those costs, figure out their relative proportions, their relative weights, and take a weighted average. So it's a multi-step problem. It'll take us 10-15 minutes to get through, but it's a good one. I bet you most intro finance classes have problems like this. Let's go. The following information is known about the company's balance sheet. It gives us info about liabilities, common shares, preferred shares, and some tax rate info, risk-free rate, market risk premium. It says compute the weighted average cost of capital. Okay, we're going to compute the cost of debt. Now, as we've gone over, what we're looking for here is always rates, right? And so we're looking for the required rate of return is for an investor is the same as the cost for the company. And so when we're calculating rates for a bond, unfortunately, it's just too awkward to do by hand. You have to do a lot of trial and error. So I'll lean on the financial calculator here. You could also use present value tables here, but I think primarily you'll either be given it or given ways to calculate it easily, or you'll have to use a financial calculator. So let's use our financial calculator. I've got the inputs sort of to match my BA2 plus financial calculator. Let's figure out what our inputs are in this question. So liabilities, we have 1,500 5% bonds outstanding, quoted at 96.5, $1,000 par value. So this is 96.5% of $1,000. So the price today is $965, and in fact, that's the PV. $1,000 par value means in however many years we got to pay back 1,000. Oh, and they're 5% bonds. So $1,000 times 5% is $50 in interest per year, but they make semi-annual payments over the next 10 years. So semi-annual means half that in interest, right? That's $50 per year. It would be $25 per 6-month period. And the number of periods, well, it's 10 years, which is 20 semi-annual periods. So we've got all the pieces. We're solving for IY. That's our missing number. Let's get it. And this is the required rate of return, or the cost of equity for a 6-month period, because we're doing everything based on 6-month periods. So let's get it. 20 goes in as N. We don't know our IY. 965 goes in as PV. 25 negative goes in as PMT. 1,000 negative goes in as FV. And the reason I put the PMT and FV in as negatives is because we're the borrower, so we're making these payments. We're also paying back the $1,000 at the end, so that's why those go in as negatives. And I compute the IY, and I get 2.73%, but that's for 6 months, so let's multiply by 2 to get an annualized rate here, and I get 5.46%. 5.46%. Now remember how debt works. A beautiful feature of debt, something that makes debt attractive to companies, is interest is tax deductible. So this cost of debt reduces their tax bill. And so we always, when we're coming up with our weighted average cost of capital, do the after-tax cost of debt. So we're going to take 25% out of this. So our cost of debt is not 5.46%. It's 5.46% times 1 minus the tax rate. It's 5.46% times 75%, right? 1 minus 25% is 75%. So 5.46% times 75% is 4.09%. So our after-tax cost of debt is 4.09%. That's the number we're going to use in our calculations. I'll just write it up there. Cost of equity, it's going to depend on the information given to you in the question. If you're given information about dividends and a dividend growth rate, you're going to use the dividend discount model, and this is how it would look. But we aren't. Let's read what we're given. We're given other information. It says common shares, 10,000 common shares outstanding. The market price is $50 per share. The beta is 1.05. And whenever you're given the beta, that's a sure sign they want you to use the CAPM model, the security market line model, to solve this thing. So we're given a beta. So the CAPM, here's the CAPM formula. The beta is 1.05. It says the risk-free rate is 3. So 3 plus 1.05 times RM minus RF. That is the market risk premium, and we're given the premium of 9%. So RM minus RF is the market risk premium. So I don't need to say 9 minus 3. That's probably the only tricky part of this one. You have to know the risk-free rate, 3%. If it said the expected return in the market, they would have to say 12%, and then you'd calculate the market risk premium. But here, no. They gave us the market risk premium of 9. So 3 plus 1.05 times 9, 1.05 times 9, 9.45 plus 3, 12.45%. So our cost of equity, 12.45%. Last, we're doing preferred equity. Let's read the thing. It's just up here. The company has 2,000 preferred shares outstanding. The annual dividend is $12 per share, and per share, and shares sell for $110 per share. Okay, so remember, preferred equity is a perpetuity. The math around preferred equity tends to be the easiest because it's just like a recurring cash flow is all we're counting on. That guaranteed, well, typically guaranteed dividend should be very consistent. And so present value of a perpetuity is the amount of that recurring payment divided by the required rate of return if you're an investor. Well, now we're the company, we want to sort of rearrange the formula. And for us, it's not a required rate of return, it's a cost of equity. So our cost of equity equals the dividend amount divided by the price today. So the dividend amount is $12. The price today is $110. 12 divided by 110 is 10.9%. Okay, so we have our costs. Our cost of equity, 12.45%. Our cost of preferred equity, our cost of common equity, 12.45%. Our cost of preferred equity, 10.9%. We're good to go. So the next step in calculating the weighted average cost of capital is to calculate the relative weights in our portfolio, or not our portfolio, but in our debt and equity portion of our balance sheet. So let's figure out the size of that portion of our balance sheet. How many dollars do I have in bonds? How many dollars in common shares? And how many dollars in preferred equity? So I have 1,500 bonds. They're quoted at 96.5. So I have 1,500 bonds. That's value today is $965 each. I have 1,447,500 in bonds. I have 50,000 shares. The value of the shares is $50. I have 2.5 million in shares. And in preferred shares, 2,000 preferred shares at $110 per share. $220,000 of preferred shares. Okay, so the total there, the total value of my, on the balance sheet of my common shares, preferred shares, and debt, 1,447,500 is 4.1 million, 4,167,500. I need relative weight, so I just divide each number by 4.1 million, and I'll get the relative weight. So 1,447,500 divided by 4,167,500, 34.7%. So the weight is 34.7%. Let's do the next one. 2.5 million divided by 4,167,500. 59.98%. I'm going to call that 60. 60% it's going to round up to. And 220 divided by, slippy mouse here. 220 divided by 4,167,500 is 0.0527, 5.3%. And good news, I can just see it in my eyes here. This adds up to 100%, which it must. That's the idea of these weights. So now I just apply the weights to the costs. So I just go, okay, 34.7% of my portfolio costs 4.09%. 60% of my portfolio costs 12.45%, and 5% of my portfolio costs 10.9%. Multiply those through, add them up, and that's how you get the weighted average cost of capital. So we got the cost of capital for each individual item. Now we just want to know the average. But we can't take a simple average because 60% of our portfolio, 60% of our balance sheet essentially is made up of common shares. So that gets more weight in the weighted average cost of capital. So this average is going to be closer to 12% than it will be to 4%. A simple average between the 12 and 4 would say 8. Well, it's going to be higher than 8. I promise you that. It'll be 9 or 10 or something like that. Maybe 9.5. We'll see. Let's crunch the numbers. 34.7% times 4.09. 0.347 times 4.09. I get 1.42. Now this number does not mean anything to me. 60%, 0.6 times 12.45. 7.47. And last 5.3 or 0.053 times 10.9. 0.58. 0.58. And we would expect that to be small because the weight is so small. So we're expecting a small number there. If you end up with a big number, like a number that's larger than any other two, you should just go, oh, I got decimals in the wrong spot. I screwed up. That is by far the most common screw up, is people just put the decimal in the wrong spot. 1.42 plus 7.47 plus 0.58. We ended up at 9.47%. That's our weighted average cost of capital. That's the answer to the question. That's what this company, when they're sort of calculating their required rate of return on future projects or purchases or investments, they should use 9.47% as their discount rate. We've done it. We've solved 11.6a. As always, I work hard on these videos. I do them to help you, and I hope they help. And if they help you, I hope you'll help me. Have a great day. Bye-bye. Let's take a look at problem 1111A. We're talking about rights offerings. So the last few problems, we've looked at flotation costs, the fact that you have to pay investment banks, and if you want to issue shares, it can be very expensive. And to save money, one of the benefits of rights offerings is that it's less expensive. So we're talking about cost of capital and how flotation costs should be considered. Well, this is a way to reduce costs, but it's just an interesting finance mechanism that we're going to explore in this problem. So let's jump into it. And this is, before I jump into it, again, explain what it is. You're not issuing shares just to the general public. You're issuing shares and giving your existing shareholders the right to buy some of your shares at a discounted price. And the fact that you discount the price means every single one of those shareholders is highly incentivized to buy, because you're just saying, well, I'll give it to you for cheaper than the market price. Every shareholder should buy and will likely buy. So it's a way to raise money, and it's a way to raise money from your existing shareholders. Let's read the problem. Smith Company is preparing a rights offering. The company wishes to raise $10 million. The stock currently sells for $75 per share, and there are 1.2 million shares outstanding. The subscription price is set at $50 a share. So the market price is $75. We're saying, hey, you want to buy new shares for $50? Here's your chance. So we want to raise $10 million, and we're going to do it at a $50 per share increment. So how many new shares are going to exist in the world after this offering? If everything goes well, 10 million divided by 50, there's going to be 200,000 new shares. Okay, so I'm going to be issuing 200,000 new shares, $50 a share. I'm going to get $10 million. Good for me. What happens to my shareholders? I don't just go first come, first serve. I don't say, okay, well, first come, first serve, and because then I'm just totally advantaging some shareholders over others. And so here's the deal. We go, well, we have 1.2 million shares out there in the world. We want to have 200,000 new shares. That means for every 6 shares you own, so 1.2 million divided by the 200,000 new shares, well, every share you own, you get a right, and 6 rights entitles you to purchase. If you have 6 rights, you can exchange them and buy one $50 share. And so this is a good deal. If you are a shareholder, you own 6 shares, you should want to do this because, again, you're getting a discount on something that it's $50, costs you $75 to buy in the open market. Why the heck not, right? You should want to do this. Now, something that you're probably astutely observing is if everybody buys up all these, $50 shares, doesn't that reduce the value of my $75 share? And the answer is yes, this is dilutive, right? It dilutes down the value of our $75 share. So the question says, what's the X rights price? That's saying once everybody exercises their rights, and everybody's gonna, what is the new price going to be? What's the price going to settle in at for a share of stock? Because these $50 shares are just the same as the $75 shares. They're going to trade just the same way. So it's going to drive the price down. What's the new price going to be? And the easiest way to contemplate this is to consider one shareholder who owns 6 shares. So again, obviously people own hundreds or thousands of shares potentially. This person owns 6, okay? So they own 6 shares, and they have an asset that's worth 6 times 75, $450. And they take my finance course and they go, oh, Tony Bell said you better exercise those options. And so they do. Let's just say that they do. So they buy one more share at $50. So that's a $50 share. Now these shares are all, part of the same family. So now they have 7 shares, 7 votes. And the value of their shares is $500 in total, right? What they've paid here. So 500 divided by 7 means the new value per share is $71.43. So that is our X rights price. Once everybody exercises their option, as we think they will, it's going to be $71.43. But what if I don't want to, right? What if I don't want to? Well, I got 6 rights. And there's another way of thinking about these rights. I got 6 of these rights. And they dilute down the price from 75 to 71. The difference is 75 minus 71.43. So let's subtract 75 from that. I'll hit the plus minus. They're worth $3.57 each. That's the difference between the price before and the X rights price is $3.57. That is the value of a right. That's how much a right is worth. So again, let's go at this from a different angle. Let's say I take my 6 rights at 357. So what's 6 times 357? It's 2142. And if I want to exercise it, I got to give the company $50. So plus 50. I'll put the plus 50 there. What is the value of what I've bought? Well, 6 rights cost $357 each. Plus the $50 I give the company, I have $71.40. Now there's a rounding thing going on here, but you can see it's the X rights price. So I'm kind of going at the calculation from 2 different angles. The bottom line is the X rights price is $71.43. The value of the right is $3.57. Now, is the shareholder better off, worse off, or the same because the offering? They're in the exact same place. And this math kind of shows it. So before the offering, they had, I'm going to write it out again, 6 at 75 for 450. Let's just say they exercise. So that's scenario 1. They exercise. 1 times 50 is 50. So they have 507 shares, and we said the value per share is 71.43. 43. Well, let's think of where they were before. They had an asset worth $450, and they had $50 cash in their pocket. Now they have $50 less cash, but they still have $500 worth of value in the company. So they're no worse off if they exercise their shares. What if they don't exercise those or their rights? What if they don't exercise their rights? Well, then they can sell them. So they end up with 6 shares at $71.43. They didn't exercise their rights. Now we said that's going to be the value afterwards. 6 times 71.43, 428.58. But remember, they would have sold 6 rights at $3.57 a piece. 6 times 3.57 is 2142. And they have $450 of value from that. $420 of stock, and now $21. They've liquidated $21 of cash value out of their shareholdings. The only way the shareholder would be worse off because of the offering is there's really three things they could do. They could exercise the right, which is fine. They could sell the right, which is fine. If they did neither, if they just said, okay, I got this option, I'm not going to exercise the option, and I'm not going to sell the option, I'm just going to hold on to it and let it expire, then they are worse off. Okay, there we have it. We've solved 11A. As always, thanks for watching. Goodbye. Let's jump into Module 12, M&M Propositions. This is Modigliani and Miller are the famous M&Ms of corporate finance. And they had two propositions that are so fundamental that 70 years after they made them, it's still taught in corporate finance classes around the world. There are problems with these propositions, but they're fundamental insights into the world of finance. So let's get to it. I'll run through at a high level both of these propositions, and as we go into exercising the chapter, we'll get more of a ground level view of how the propositions work. But at a high level, Proposition 1 says, in terms of firm value, the value of a company, whether they have lots of debt or lots of equity, however their capital structure is in terms of the balance between debt and equity, it shouldn't matter to the firm value. And why shouldn't it matter? Well, let's just assume a company has no debt, and we're looking at it as an investor going, they need more leverage. They should be using more leverage. Debt is cheap. They should be using debt, and they're not using enough. Well, M&M say, well, the investor can take on debt. Right? We can borrow to buy their stock, and therefore, for us, their stock has leverage because we've leveraged ourselves to get the stock. So it's not only that insight, like, oh yeah, they could do that. They mathematically show it, right? Like that's what made it worthy of a finance course and worthy of, downstream of their work came many Nobel Prizes, or a couple of Nobel Prizes anyway, are sort of downstream of this insight. Now I put star there because their assumption initially when they formulated this was it shouldn't matter if you ignore the effect of taxes. But of course, everybody would go, well, companies can't just ignore taxes. Once you put taxes in, the implication here is actually taking on more debt raises firm values. And again, star on that, because then you need to consider bankruptcy risk, and there are different risks that come into play that they don't model in their proposition. So in any event, I think the fundamental insight here at a high level is if a company doesn't have enough debt, well, the shareholder can make their own capital structure by taking on more debt. If the company has way too much debt, well, the shareholder can actually use some of their money to become a lender. They can buy government bonds to balance that out, right? They can buy lower risk investment to balance that out. Proposition 2, more debt leads to higher equity cost. Again, probably an insight you or I might have, right? If a company has way more debt, there's way more risk there, and therefore there should be a premium on their cost of equity. And the insight here was they prove it mathematically, and they say, the weighted average cost of capital. So if the company takes on more debt, yes, it raises the equity cost, but their weighted average cost of capital stays the same. Why? Because they have more debt. Debt is cheaper. Having more cheaper debt and more higher cost equity, at the end of the day, when you take the weighted average, it should say the same, star, ignoring the impact of taxes. So, and their insight here, again, I think you or I would have thought the same thing. More debt means higher risk. Higher risk means higher rate of return required by investors. All that should make intuitive sense. Their insight was they proved it with math, right? This was sort of like a lot of finance was like gut feelings, and M&M put numbers to it and proved it with math and formulas, and it holds up, 70 years later, those insights. So there are stars with both of these where it's like, it's imperfect, but the ideas are fundamentally useful ones. So we'll put some numbers to this as the chapter goes on. Let's get started with Module 12. In this video, we're going to work on a problem you can download from tonybell.com. Go to the website, click the PDF link, and you'll notice there's no sign in, no sign up. The PDF just pops right up. You'll scroll down and find whatever problem it is that we're working on. As you scroll through the problems, you'll notice many are free and open, like the one you're watching now, but some are members only. I think the free and open ones are enough for most people, but if you can't get enough of me and you'd like to join and get access to those members only videos, click the join button underneath the YouTube play box. All right, thanks so much for watching. Let's get started. Let's have a look at problem 12.1a, all about leverage, all about M&M, Modigliani, and Miller, some Nobel Prize winners, and they won their Nobel Prize for this concept. And it's a little weird, actually, that they won their Nobel Prize for this concept, because as we'll discuss at the end, there's lots of problems with this proposition. But let's jump into the problem. We'll solve the problem, then we'll just discuss M&M a little bit more at the end. XYZ company has no debt and is financed 100% through equity. Sorry, I'm just clicking on something here. The company has 800 common shares outstanding, and the price per share is $150. EBIT is expected to be $10,000 per year. Okay, you invested in this company because you love their debt-free capital structure. You're a fan of Dave Ramsey. Google Dave Ramsey if you don't know who that is. That's a person who hates debt. So you've invested in a company because you like them, because they don't have any debt either. You own 120 common shares. So that's what you bought. Assuming a dividend payout rate of 100% and assuming no taxes, it's a big assumption. That's one of the big problems or challenges to this M&M proposition. What's your cash flow from owning the shares? Okay, so they're going to pay 100% out of their profits, and it said their EBIT is $10,000 per year, and then that's earnings before interest and taxes. So their interest, if they have no debt, is zero. Their taxes, if we assume away taxes, one of the big critiques of this method, is zero. So their profits are $10,000, and they're going to pay it all out. So the question is, how much of the company do I own? I own 120 shares. There are 800 shares out there. I own 120 800ths of the company. 120, I don't know why I said 800ths like that. I own 120 of 800 shares. I own 15% of the company. So I'm entitled to 15% of that when they dividend it out. So 15% of $10,000 means this thing's going to be giving me $1,500 per year in perpetuity. So that's my ongoing cash flow from owning the shares. That's the answer to question 1. Okay, question 2. The company is debating borrowing money in a way that would make its capital structure 25% debt and 75% equity. We don't like that because we invest in this because we love that they're debt free. Maybe we still love the company, but we're not happy with this. The interest on the debt, we only own 15% though, so we can't tell them what to do. The interest on the debt would be 6%. After borrowing, the total assets of the company would remain the same. The money would be used to buy back shares. You intend to keep all 120 of your shares. What would the cash flow be under this new capital structure? Okay, let's compare the capital structures. I'll do one in maybe blue. So let's do it in red. The old one. Old structure, and then we'll have a proposed structure over here in green, just to kind of lay out what the balance sheets are going to look like before and after. I think it'll be very helpful in understanding what on earth is going on here. So we know balance sheet looks like this: assets equals liabilities plus shareholders' equity. So let's think about it for the first version of the company. Company had 800 shares. Shares were $150 a share. So 800 times $150 a share means $120,000 of equity. It had zero debt, So what are the assets? Well, 0 plus 120 is 120. The assets must be 120 or this balance sheet doesn't balance and accounting doesn't work and my whole life was a fraud. So I think it works. I think that's makes our balance sheet balance. Let's look at the proposed structure. Our assets, liabilities, shareholders' equity. In the proposed structure, it says the company is debating borrowing money that would give a capital structure of 25% debt, 75% equity. The interest is going to be 6%. After borrowing, the total assets of the company would remain the same. Okay, so our total assets are still going to be 120. We're just going to take on some debt and get rid of some equity. So it said 75% of this is going to be equity. So 120 times 0.75 is 90,000 is going to be equity. And 30,000, then I'm just doing the math, 90 plus 30 is 120, and 30,000 is 25% of 120. So that's what it's going to look like afterwards. Now, we keep all 120 shares. How many shares have to get canceled here? Our shareholders' equity goes down by $30,000. How many shares is that $30,000 reduction in equity? So we said that the shares are $150 each, and we reduced our equity by $30,000. How many shares did we cancel? Looks like 200, but let's run the numbers here. 30,000 divided by 150. Yeah, we must have canceled 200 shares. Bought back 200 shares. So company buys back 200 shares, leaving it. It had 800. Well, now it got bought back 200. So now there's 600 shares out there in the world. And we still own 120 of them. We own 120 now out of 600 shares, not 120 out of 800. We own 120 600ths of the company. 120 divided by 600. I don't know why it sounded funny to me. Maybe just me. We own 20% of this company. Okay, so this newly, restructured company. Now we own a bigger chunk of. We own 20%. Let's look at its income statement from EBIT down. So our EBIT is going to be $10,000. It's expected to be $10,000. Our interest, now we do have interest. We borrowed 30 grand, 6% annual interest, 30 times 6%. $1,800 in interest. Our taxes we're still assuming are assumed away to be zero. So our company's new net income is $8,200, 10,000 minus 1,800. We own 20% of it. So 8,200 times 0.2, we own 1,640. So what would your cash flow be under the new capital structure? Our piece of the pie is 1,640. Now, this will happen when a company takes on more debt. It generally will always look better for the shareholder in this type of proposal. And as we saw last chapter with weighted average cost of capital, debt capital is cheaper. So often you're encouraged here to take on more and more debt. But there may be reasons we don't want to. Maybe we don't want to take on the risk in our portfolio, right? We have a portfolio of companies, and this was meant to be our lowest risk play, and now they're taking on debt. We don't like it. Or we could be like Dave Ramsey, that guy I was telling you about. He's a YouTube celebrity. He's a famous personal finance person. He just hates debt. He's allergic to it. So he would hate to invest in a company that takes on a bunch of new debt. So maybe he's opposed to it in that sense, or whatever. We're just opposed to taking on new debt. So here's what Miller and let me pronounce the name right. Miller and Modigliani say. They say, whatever the company does, it doesn't matter if they take on debt or not, if they have lots of debt or if they have lots of equity, because you as a shareholder can just move your portfolio around and adjust around it. So for instance, if you were investing in a company and you wanted them to take on more debt and they had no debt, well, what you could do is borrow money yourself and buy more shares, and you're leveraging yourself up. Or if is the case here, they borrowed money and you don't want them to, you can take money out of that investment and invest in something safer. Or even, as we're going to propose here, become a lender. Like you just take the other side of the bet. They're borrowing a bunch of money. You don't want it. Well, you lend a bunch of money to somebody safe with a similar profile to this company. So If the company borrows as proposed in Part B above, how could you make use of homemade leverage, so you just make your own leverage, to adjust for this? Well, the way you would do it is you would say, okay, they've taken on 25% debt. We don't like that piece of the investment. We're going to sell 25% of our shares to adjust for that, right? That piece of our investment we're unhappy with, and we're going to maneuver that piece and just take the opposite bet with that piece of the pie. So we had 120 shares. We're going to sell 25% of them at, so 120 times 25%. I think it's 30. Should do this in different color ink. Well, I think that's wrong. 120 times 0.25. It's got to be 30. Yeah, 30. I don't know how I got 31.25 there. Let me do this in blue ink. So it's 30 shares to sell at $150 each. That's $4,500 in cash. And the idea is we should become a lender with that, and it counteracts the other side, right? It counteracts what the company has done because we are on the other side of the bet with that piece of the portfolio. So 4,500, and let's just say we can get 6%, same rate here. We're just in the exact equal and opposite position, and it just cancels out, and we end up in the exact same place we were. That's the idea here. 4,500 times 6%. It's $270 coming in as far as interest revenue on that loan goes. So there's our interest rev on the loan. Now, what's the other piece? Well, this company's still the same. They still have net income of $8,200. If we sell 30 shares, how much of the company do we own? We own 90 shares. Now, we owned 120. I'm all over the page here. We owned 120 out of 600. Now we own 90 out of 600. So we own, what percent of the company? 90 divided by 600. We own 15% of the company again. So we own 15% of this $8,200 profit. I think it's probably behind my head. Let's do the math. 8,200 profit times 15% is $1,230 in dividend income. We have $270 in interest revenue. We have $1,230 in dividend income. We are $1,500 in revenue from our investment. And because we're on opposite sides of the same bet, we're in the exact same place, right? As far as risk goes, we've laid off that risk. We've passed along the risk, I guess. Counteracted it might be the best way of saying it. So we've solved 12.1a. A quick comment on this M&M proposition. It's a very interesting insight and a useful insight, and it's worthy of its Nobel Prize win. So if I sound like I'm criticizing it, I'm really not. But you need to use it as a thought exercise. So the idea is, I think, a really smart insight, and that is, if you're invested in a company and it's not taking on enough risk, you just take on more risk yourself. Let the company do what it's going to do. And as an investor, you're rational to just take on more risk yourself in your own portfolio. If they're not risky enough, well, it's on you to, if they're too risky, rather, it's on you to reduce the risk. And again, make portfolio adjustments to reduce the risk. They sort of say, therefore, because we assume investors are rational and markets are efficient, that's what will happen. And therefore, it doesn't matter what the company's capital structure is. In reality, a big factor here is income tax, which people are taxed differently than companies, and debt is tax deductible in the hands of a company, not in the hands of an individual. The interest on debt, I should say. Bankruptcy is a thing that is just really not contemplated in their proposition. And finally, markets aren't always efficient, and people don't always behave ethically and rationally. So a lot of things cause this to fall apart. On a fundamental level, though, it's like, you have to assume no taxes for it to work this way. I think as a thought exercise, very insightful though, very insightful. You as an investor are rational to shape your portfolio around the company, and you can certainly do that. And I think that's a reasonable insight, and I think obviously a Nobel Prize worthy insight the way it's laid out. And I don't think I've done it justice here, but in reality, it sort of falls apart when faced with real world, what's the word here? Constraints, I suppose. It assumes away many real world constraints that are all too legitimate. Anyway, I've rambled long enough. Thanks for watching, and I'll see you in our next video. Goodbye. M&M Proposition 2, we'll do one version without any tax. That's easier. We'll do a slightly harder version with tax. But let's get down to business. Flyer company has zero debt and can borrow at 4%. The company's weighted average cost of capital is 8%. Scenario 1, assuming no taxes, answer the required below. Required A, what's the cost of equity? Okay, well, if the company has zero debt and the weighted average cost of capital is 8%, the cost of equity is 8%. But let's prove it with a little bit of math. So there's our assuming no taxes M&M Proposition 2 formula that we introduced in previous videos and showed you how to derive this in previous videos as well. I wonder if anybody sat through that explanation. It was pretty long, but I would expect you're either in a test situation going to be given this on a formula sheet, or being allowed to prepare a formula sheet, or being expected to memorize this. I would not expect anybody to be deriving this formula from the weighted average cost of capital formula. Anyway, let's get down to business. We're given the formula here. Okay, so our cost of equity is the cost of capital, 8%, plus 8% minus 4%, 8 minus 4 is 4, times debt divided by equity. Well, here we go. Debt is 0. Equity is 100%, so 0 divided by 100 is 100. So 8 minus 4 is 4. 4 times 0 is 0. Our cost of equity here is 8%, right? 8 plus 0 is 8. So in scenario 1, the cost of equity is indeed 8%. Okay, let's continue. And so what we're going to do is, what's the cost of equity? 8%. Let's do B. B says, if the company changes its capital structure to be 25% debt, what's the cost of equity here? Okay, so scenario part B, right? So there's A, here's B. Our cost of equity here is the 8% plus 8 minus 4. I'm just going to put 4 here. 8 minus 4 is 4. Times, and what was the borrowing here? 25% debt. So the debt to equity ratio is, if it's 25% debt, it's 75% equity. And there we have it. So we just got to do the math. 25 divided by 75.33333 times 4, 1.33333. So 1.33333 is on the right, 8 is on the left. It's 9.33333%. Let's look at C. C says, now we're going to 75% debt. What's the cost of equity? I haven't forgotten, we're also asked to calculate the weighted average cost of capital at these various debt levels. So we'll do that momentarily. Our cost of equity here, though, is 8% plus 4% times, now what's the ratio? Well, it's flipped. Now it's 75 debt, 25 equity, and so the math here is 75 divided by 25, it's 3 times 4 is 12, 12 plus 8 is 20%. Okay, so our cost of equity is rising as our debt levels are rising. That should hit your intuition as right, because of course, more debt means more risk. More risk means the shareholders are going to require more return. So cost of equity will, of course, rise. Now let's look at the weighted average cost of capital, because again, this is our cost of equity, 8. So again, this is our E, right, our cost of equity, but we want to know what is the weighted average cost of capital, and let's do some math. In scenario part A, if we have 8% is our equity, and equity is 100% of the portfolio, then it doesn't really matter that we can borrow at 4% and that's 0% of our portfolio. Just 8 times 100 plus 4 times 0, it's 8%. That's our weighted average cost of capital. In the second scenario, 9.33333% times, in the second scenario, it was 75% debt, 25% debt, 75% equity. So 9.333, it's 75% equity, and 4 times 25% debt. Let's do the math here. 0.933333333 times 70. Oh, I screwed that up. Actually, let's do it this way. 9.3333333 times 0.75. We get 7, right? 6.99997. 4 times 25%. That's 1. 7 plus 1 is 8. And what we find here is the weighted average cost of capital is the same, no matter what. And we'll do it for the last one just to prove that out. Our cost of equity is 20%. And in the third scenario, we have 25% equity. Our debt remains 4%, but in this scenario, we have 75% debt. 20 times 25% is 5. 4 times 75% is 3. 5 plus 3, counting on my fingers, 8. So our weighted average cost of capital is 8. Our firm value is the same here, no matter what, right? The weighted average cost of capital sort of drives firm value, and certainly a key number for any firm, and our firm value is the same no matter what, regardless of the debt to equity ratio. Now, what we're going to see is once we incorporate tax, companies that take on debt end up being more valuable. And the reason is their weighted average cost of capital goes down. And the reason for that is debt causes interest, and interest is tax deductible. And so the tax deductibility of interest causes the WACC to go down and firm value to go up. Let's go ahead and solve this in scenario 2. So scenario 2, exact same thing, but this time we assume a tax rate. So that brings into us to a new formula here. And formula is pretty familiar. It's pretty similar to the previous one, just a couple of minor, significant but minor tweaks. Rather than RA here, you can see it says RU. That is the cost of capital or cost of equity of an unlevered version of our company. In other words, the company with zero debt. What's the cost of equity or the cost of capital? Same difference when there is zero debt. And in this case, it's 8% is our RU. And then 1 minus the tax. And so tax rate is 20%. 1 minus the tax rate is going to be 80%. 1 minus 0.2 is 0.8. So we'll plug in 80% here. Let's just plug in our number. So what is the company's cost of equity at a time when we have zero debt? Let's run the numbers here. So our unlevered cost of capital is 8 plus 8 minus 4. So 8 minus 4 is cost of debt is 4. 8 is RU. 4 is RD. 8 minus 4 is 4. I'm just going to put 4 here. Times the debt to equity ratio. Well, if we have zero debt, our debt to equity is 0 over 100 times 80. So what will end up happening is the things I'm writing in brackets here just multiply out to 0 because we're multiplying everything by a 0. So our cost of equity at a time when we have zero debt is going to be the same as our weighted average cost of capital. That should make intuitive sense, right? If you have no debt, your cost of equity is your cost of capital. Let's move on to part B. So that was part A. Part B, gets more interesting. Our cost of equity remains this unlevered is 8% plus 4 is RU minus RD is 4. Times, now what's the ratio? 25% debt, 75% equity, so 25 75ths times 80%, 1 minus the tax rate. So again, let's take the middle stuff. I always do the ratio first. I don't know why. You don't have to, of course. 0.33333 times 4, so 1.33333 times 0.8. 1.07. So 8% plus 1.07 is 9.07%. Okay, let's move on to C. C says, same calculation, just flip the debt and equity. Now we're 75% debt, 25% equity. So same type of math, 8 plus 4 times 75 25ths times 80%. Let's run the numbers here. 75 divided by 25 is, of course, 3. 3 times 4 is 12. 12 times 0.8 is 9.6. 9.6 plus 8. Our cost of equity here is 17.6%. Okay, so we've done our cost of equity, and well, they were different from the ones up here, right? 8, 9, and 20, and this is 8, 9, and 17, like slightly lower 9.07 versus 9 point, I think it was 33. So it's slightly less, our cost of equity, as we climb the ladder here. But still the same story is told, right? You end up in a situation where you borrow more, well, equity costs more because the risk is higher. So there's a premium placed on that, and shareholders will want a higher return given that they're taking on higher risk. Okay, so that's sort of the story there. But weighted average cost of capital tells a more interesting story. So let's figure out our weighted average cost of capital. So in scenario A, it's pretty simple, 8%, and we have 100% equity in scenario 1. We had 0 debt. Again, I keep circling the same thing. And our cost of debt, or our debt cost, is 4%. But remember, we want to know the after tax. Now we got a tax rate to deal with. So we actually do 4% times 1 minus the tax rate, which is 80%. 1 minus T, 1 minus 20% is 80%. So I'm actually going to use 4% times 80%, 4 times 0.8. I'm just going to put it in 3.2 as our sort of after-tax cost of debt, and then times the proportion of debt, which in scenario 1 is 0%. So I went through all that work for a 0 at the end of the day, but I'll use 3.2 as our after-tax cost of debt times the proportion of debt. So 8 times 100 plus 3.2 times 0 is 8. Our weighted average cost of capital in the first default scenario is 8. Let's look at the Part B scenario. The Part B scenario, our cost of equity is 9.07%. Our ratio here is 25 debt, 75 equity, so times 75%, our proportion of debt, plus our after-tax debt times the proportion of debt. So 3.2 times 70, what is it? the 25%. Jeepers creepers, easy for me to say. Okay, so let's run the numbers. 9.07. My goodness, 9.07 times 0.75, 6.8 plus 0.032. No, so let's do 3.2 times 0.25, 0.8. 6.8 plus 0.8 is 7.6%. So we're seeing a little difference here, right? Up above, it was 8% every time for our weighted average cost of capital. Here, because we're taking tax rates into consideration and because we now have some debt, well, guess what happens? Our weighted average cost of capital falls from 8 to 7.6%. All right, let's do the last one. We'll see the weighted average cost of capital will fall further still. So our cost of equity went way up, 17.6%. Wow. But we only have 25 equity and 75 debt this time. The cost of debt remains just as cheap as ever, 3.2% times 75% in this scenario. So let's run the numbers here. 17.6 times 0.25, 4.4 plus, well, it's the same, 3.2 times 0.75 is still 0. Oh no, what am I talking about? Let's do the math. 3.2 times 0.75 is not the same. It's 2.4. So 4.4 plus 2.4 is 6.8%. Okay, so what is this telling us? What does this even mean? If our weighted average cost of capital is going down, the value of our firm is going up, right? We're able to take on more projects. It's better for the firm, and just having a lower weighted average cost of capital implies a higher firm value. So the implication of this is clear. Firms should just take on as much debt as humanly possible. But wait a second. I'm an accountant. I'm a frugal guy by my nature. I think debt is on a personal level. Why would I recommend this? And the answer here is, well, that's what the math will tell you to do. And finance is math and money. And so if you're just going a pure math game, the math game says, my goodness, our weighted average cost of capital goes down. The value of our firm goes up. Let's take on more debt. But and finance books will tell you this as well. It's kind of a fool's game if you take it to its logical end. And the reason is, if you take it to its logical end, you will go bankrupt. The risk of bankruptcy becomes more and more significant the more debt you take on. And I always think of this like a role-playing video game. If you're a video gamer like me, you might have played a role-playing game, and you might have even decided, I want to be a magic user, a wizard in this role-playing game. And so here's what happens to wizard characters that do the logical thing and take it to its logical end. Because I'm a numbers guy, and I go, all right, my wizard just leveled up. Let's see, I can add to his or her strength, I can add to their dexterity, I can add to their magic power. And I will always add to their magic power every time I level up. More magic power, more magic power, more magic power, more magic power. And what inevitably happens to my characters is I just start killing all the bad guys because I'm so powerful. My magic spells are spectacularly strong. And then I come up with a bad guy who can withstand one of my spells, and they go up to me and they go, tink, and they kill me in like one shot because I have 0 hit points, right? I've invested everything in magic power, nothing in hit points, and they go, tink, and I'm dead. That's what happens to companies that take this to its logical end. They go, we're going to lever up to the extreme degree, right? We're going to take on more and more and more debt, as much debt as humanly possible, and then one little problem, tink, and they're bankrupt. So lenders know this. They're not going to lend to the logical degree, and investors and even owners of the company know this. But it's very tempting to look at this formula and say, I should borrow to the hilt because it maximizes firm value, and I should be trying to maximize firm value. Bankruptcy is the thing that sort of prevents this from being the greatest infinite money strategy you've ever heard of. All right, I hope this video was helpful. I hope you don't take too much risk as you're headed towards your midterm or final exams, and I hope you'll hit one of those buttons for me. Thanks for watching. Have a great day. See you in the next video. Bye-bye. Welcome to our 13th module, lucky number 13. In this module, we talk about the strategy of a company paying dividends versus doing stock buybacks. So a company has excess money, excess cash. What do they do with it? They want to get the money to shareholders. They want to show shareholders a return. They could pay a dividend. They could buy back their own shares. Those are both ways of enriching shareholders. What should they do? What we find is dividends versus buybacks, it really makes no difference. Asterisk. Let's read the small print. It makes no difference in theory because, again, we are sending capital back to our investors, and that should not change the firm's value, the company's value. And so it shouldn't make a difference to shareholders which method we use. And we'll crunch the numbers and we'll say, oh, this is why we're kind of equal off no matter what we do. We'll show you the math behind why it doesn't make a difference to pay a dividend or do a stock buyback. But if you've followed the news or followed your favorite companies, many, many more companies are doing stock buybacks these days than dividends. And the reason is there are advantages. So in practice, it does make a huge difference for two reasons. One, tax implications. There are significant tax considerations, and it's going to depend country by country. So I can't break it down for everybody in every country, but generally speaking, there are tax advantages for the investor in a buyback situation versus a dividend situation. And the second big difference is timing. In the event of a dividend, you don't call the shots as the investor. The company pays a dividend. They paid it in this tax year. It's going to be taxable in this tax year. If the company does a stock buyback, Well, you don't have to sell your stock back to them. So you get the time when you have a taxable event. With a dividend, you don't get to call the shots as an investor. The company paying the dividend gets to call the shots. So again, in theory, dividends versus buybacks doesn't really make a difference, and we'll crunch the numbers from a company perspective why it doesn't make a difference, but it actually does make a huge difference, particularly to the investors, and there's a reason why buybacks have been in vogue and our investors view them pretty favorably. So we'll discuss those as well in this, our 13th module. Stay tuned for all the number crunching related to this. Bye for now. In this video, we're going to work on a problem you can download from tonybell.com. Go to the website, click the PDF link, and you'll notice there's no sign in, no sign up. The PDF just pops right up. You'll scroll down and find whatever problem it is that we're working on. As you scroll through the problems, you'll notice many are free and open, like the one you're watching now, but some are members only. I think the free and open ones are enough for most people, but if you can't get enough of me and you'd like to join and get access to those members only videos, click the join button underneath the YouTube play box. All right, thanks so much for watching. Let's get started. Let's go through problem 13.1a. This has us exploring stock dividends. So a stock dividend is when a company issues new shares to existing shareholders. It's a dividend, so they're not paying for it. They're not buying in to be part of the dividend. They're just given new shares. Well, if a company gives new shares, issues new shares, but they don't get paid for those new shares, the company doesn't really change. They don't have any more assets. They don't have any more firm value. There's just more shares out there in the world. And so what does that mean? Well, it means the price of a share is going to go down because it's the exact same asset underneath, the exact same value of company underneath, but there's more pieces, right? You're cutting the same pizza pie into more slices. You can cut the pie into 6 slices. Oh, I got a big piece. Cut it into 8 slices. Oh, my piece is a little smaller. That's what's happening here. Acorn Tools has 1 million shares outstanding at a price of $50 a share. That means this is a $50 million company, right? That's the stock or the market cap or the value of the company. Theoretically, what will the price be after the following independent events? Okay, we do a 10% stock dividend. So that means we had 1 million shares, but now we're giving away 100,000 more shares. 10% of 1 million is 100,000. So we have 1.1 million shares out there, but we still have a $50 million company. So we just go, okay, it's $50 million divided by 1.1 million shares. What's the value per share? 50 million divided by 1,100, $45.45. What about a 40% stock dividend? Okay, well now, rather than 1.1 million, we have 1.4 million, right? We go from 1 million, 40% is 400,000, so 1 million plus 400,000, 1.4 million. We still have a $50 million company though. Our company is the exact same company today as it was yesterday. We have no new money, no new nothing. So we have a $50 million company, and now we have 1.4 million shares outstanding. So the price per share, $35.71. That's the value per share. The final situation, we issue a 3-for-1 stock split, meaning we go to 3 million shares outstanding. You can trade your 1 share and get 3. We'll have 3 million shares after this happens. Our company is still a $50 million company. 50 million divided by 3. 3 million. I was going to divide by 3 and get a strange answer. $16.67. Now, you could, in any of these, actually just take your stock price. So the first case, $50 per share divided by 1.1 because it's a 10%. And you get 45. So 50 divided by 1.1. This one is 50 divided by 1.4. And this one is 50 divided by 3. And you end up right answers across the board. I think of it in the other way. I go, and again, mine is kind of silly. It's an extra step, but it's the way my brain processes this stuff. So why does a company do this? Like, why would a company bother to do this if shareholders in the same spot afterwards, right? Rather than having one $50 share, I have three $16 shares. It's like, okay, I still have $50 worth of shares in the company, and what's the difference? It's an interesting thing. Sometimes companies do it because their stock price is getting too high. It might be unattractive for people to invest. If a stock costs, let's just say, $10,000, I'm probably, as an investor, just not buying it. My net worth isn't so high that I would want to buy a single $10,000 stock, even if I thought it was a pretty good company. I would rather buy stocks in smaller pieces. And so there's some amount of retail investors like me that will just shy away from a stock with a very, very, very large price. So that's part of the reason. That's a reason I can come up with for these stock dividends. But perhaps you have a better reason. If you do, leave it in the comments just after you're done liking this video. Thanks for watching. Bye-bye. Let's take a look at problem 13.2a, dividends versus share repurchases. So part 1 has us looking at dividends. Part 2 is similar share repurchase, and then we're going to compare the two. Switch company has assets with market value of $600,000. So its assets are $600K. Because the company has no liabilities are zero. Because there's no liabilities, its equity also is $600K. So there's sort of the balance sheet laid out, a very simple balance sheet. The company has 10,000 common shares outstanding. Okay, so if we have 600 grand in equity and we have 10,000 shares, the price per share is going to be, 60, right? $60 per share. The company is considering declaring a dividend of $3 per share per day, with the stock going ex-dividend tomorrow. Assume the company declares and pays the dividend as planned. What's the stock price today? Oh, we just did that, 60. What will be the stock price after the dividend? Okay, well, again, in a perfect world, right, where there's not, other reasons for moves in stock price like earnings or just news events or whatever might move a stock price, in a sort of theoretical world, what's happening here? Well, we have $600,000 in assets, but we're going to but issue dividends of $30,000. So we go from 600 to 570 in assets. Our liabilities don't change, and our equity, therefore, has to fall to 570. We still have 10,000 shares out there, but now we only have 570 grand in equity, meaning our stock price drops to $57. You could have also gone 60 minus 3 is 57. That's not how I think about it, though. What will be the change in assets and equity as a result of the dividend? Okay, so we've kind of done that as well. I'm jumping the gun on the problem, but our equity, our assets, when we pay a $30,000 dividend, well, it's cash, so our cash goes down by 30 grand, our assets go down by 30 grand, and our equity, therefore, necessarily also falls by $30,000. So what will be the change in assets and equity? Both fall by 30K to 570, right? We were at 600K. Now we're at 570K. Okay, so assume instead of the dividend outlined in part 1, the company uses that $30,000 and buys back shares. Lots of companies are buying back shares instead of paying dividends these days. Consider how this will affect the company's equity by answering the following. What's the new market value of the company's equity? Well, same balance sheet situations going on in scenario 2 as was happening in scenario 1. Let me copy and paste this. Oh no, things have gone south. Microsoft OneNote sometimes does wacky things, although I think that one was my fault. So what's happened with the balance sheet is exactly the same here. We had $600,000 in assets. We're paying $30,000 to buy back shares, so we're giving shareholders $30,000 of our cash, and we're taking their shares back and canceling those shares, essentially canceling those shares. But in terms of a balance sheet, our assets go down by 30, our equity goes down by 30. So what is the new market value of the company's equity? 570, right? We have $30,000 less of assets, therefore $30,000 of less of equity. How many shares are we buying back? Well, let's see. How many shares did we have? 10,000 shares. Okay, let's do some math here. Our company before this, our company's market value was 600,000 divided by, I did this already, 10,000 shares. And that is $60 per share. And so how many shares can we buy back for $30,000? Well, $30,000 divided by $60 a share. It looks like we can buy back 5,000 shares, right? 30,000 divided by 60. 500 shares. I was way off. 500 shares get bought back. Okay, so how many shares will be repurchased? 500. Well, I had 10,000. I bought back 500. How many do I have now? 9,500. How many shares will be outstanding after this? 9,500. What's the new price per share? Well, let's do some calculating here. Our company value, our equity value is 570,000. We now have 9,500 shares out in the world. So 570 divided by 9,500 is $60 a share. The share buyback should not affect the stock price. So there we have it. We've solved D. Now it says explain the key differences and similarities between the repurchase and the dividend. Repurchase from part 2, which we just did, and the dividend from part 1. Okay. So our dividend, before the dividend, our shareholders had $60. I'll just do this in the blank screen. So before the dividend, our shareholders had a $60 in value. And what happened was the stock price after the dividend dropped to 57, but they got $3 cash. So again, old stock price, new price, cash. So they're in the exact same spot. With the buyback, before the buyback, the stock price was $60. After the buyback, the stock price is still $60, although some percentage of our shareholders have accepted $60 cash. So some of our shareholders have $60 worth of stock. Some of our stock, S-T-O-C-K. Some of our shareholders have $60 worth of cash. In either scenario, our shareholders have $60 in value, and they're in the exact same position they were in before. So why would one do a buyback over a dividend? Well, the reality is there are tax reasons for it that just aren't explored in this course. If you pursue your finance or accounting career further, that will be something that will certainly be covered. But in an intro class, that's the reason buybacks have become much more popular. There are just tax advantages. Shareholders can decide whether they want to participate in the buyback or not, right? So they can decide if they want to trigger a tax event or not. A dividend simply triggers a tax event for the shareholder. And so not everybody wants that. So there are some advantages to buybacks. Let's leave it at that. It's a complicated subject that goes over my head at times as well. But I hope this video helped. And if it did, I hope you'll hit one of those buttons for me. Thanks for watching. Bye-bye. Well, you've made it to the end of this 11-hour course. Just thought I'd give you a little tour. This is where I make the videos. So I edit here and I record them here using this tablet. Just thought you might be curious. There's a green screen behind me and some studio lights. I spend many hours in this room, but I do enjoy it. And I guess if you've made it to the end of this long series, you've enjoyed it too. So just wanted to give you a special Easter egg. Thank you for watching. Bye-bye.